Oopsie.
I think we've just lost that line with Sonal. But that is the important clarification that Reliance did say that they will be complying with all international regulations, including, of course, the sanction of the latest Russian entities, saying that if there is any cargo that is arriving after the 21st, then it will be processed in the domestic tariff area refineries, not in the SEZ, so not for exports. So that's clarification coming in from Reliance Industries. Well, let's quickly recap our list of top stocks to watch. The ones that have positive news flow are Godrej Properties, TCS, IRB Infra, Alchem Laboratories, VIP Industries, JSW Energy, and Reliance Industries. Stocks with negative news flow this morning would be Max Financial, AWL Agri, and Hindalco. Okay, well, let's go across to Manisha now for the latest commodity cues of the morning. Manisha, I'm wondering what you're tracking, but I'm sure you're also tracking the fall in Bitcoin, right? What a decline in some of these cryptocurrencies along with the fall in tech stocks.
Oh, well, absolutely. When you look at this year, it clearly is divided in two halves when it comes to crypto. The first half is all about very strong U.S. push, institutions buying, corporates giving it to their clients, and banks facilitating trades as well. And that took the crypto to all-time highs. But second half is clearly a different story and continues to be like that. Yes, a lot of profit-taking continuing for Bitcoin, Ether, Solana, etc. So much so that we are in a bear territory for many of those. But also what we are seeing a decline in is a lot of commodities as well. If you look at the crude oil prices, well, we've seen a 4-week lows come in for this one. It's headed for a weekly decline. The U.S. crude inventory rise, China stockpiling crude, Ukraine president signaling a move to peace talks are some of the factors which have led to crude oil prices continuing to decline. Well, let me remind you that this is going to be a third straight year that we are looking at negative crude prices for the year as well. But the declines also have come in for many of these commodities. So whether it's gold, silver, that has seen a decline. Many of the base metal prices like zinc, copper, iron. And this is majorly because there is improved risk sentiment across equities. The US dollar index is trading on a firmer note. And markets almost believe that there is not going to be a rate cut in December. That is what is bothering many of these commodities.
Okay, all right. Thanks a lot for that, Manisha. Well, hopping across to Sudarshan, who's here to tell us some brokerages calls of the day. Hey, Sud.
Hi, good morning, Nigel. So Mahindra & Mahindra held Investor Day yesterday, and company has set ambitious targets for FY26 to 30. So organic growth over FY22 to 25 was 25%. Now going forward till FY30, they are targeting organic growth in the range of 15 to 40%. Today, brokerages have come out with the notes, and most of the brokerages maintain their positive stance. So CLSA has an outperform call. Target is 4,417. It says that company is confident on maintaining market leadership position on SUVs, tractors and LCVs. And I told you organic growth now they are seeing in the range of 15 to 40%. Group companies also have they have increased or upgraded tractor outlook to 9% CAGR from earlier target of 7% CAGR, and they have aggressive growth target for their growth gems. So in FY20, so M&M's share in the growth gems was around 8,000 crore. Now that has increased to 48,000 crore. That is M&M's share, and total value of growth gems has increased to almost 56,000 crore. That is 7 times growth if you compare from FY20 level. Citi has a buy call. Target is 4,230 per share. It says it's surprised by the teaser that company has given for the two EV launches that it has planned for November 26, 27. Earlier, there was a plan to launch one EV just ahead of Investor Day. Company has said not only one, they'll be launching two EVs. And Nomura maintains buy call. Target is 4,355 per share. It says valuations are still attractive as far as M&M is concerned. Morgan Stanley also maintains overweight and target is 4,407 per share. Now coming to Vedanta, Nuvama has written a note. It maintains buy call and target is 686 per share. It says focus on demerger, delivery and deleveraging is on course to pay off for the company, and support will also come by tailwinds of commodity prices. It's expecting EBITDA to increase at a CAGR of 16% over FY25-28, and net debt, that is consolidated net debt, is likely to fall to 61,000 crore by FY27 end.
All right. So two names, right? Vedanta and Mahindra. Sud.
Yeah, correct.
Okay, and we will, and Sud is going to come back and talk to us in more detail about individual targets within the Mahindra group of companies, right? A little later on the show. Thanks very much, Sud. Appreciate it. We'll take a quick commercial break here. We're going to come back in just a bit. Excerpts of our exclusive conversation with Anish Shah, Group CEO and Managing Director of the Mahindra Group, coming up.
Well, as Mahindra Mahindra holds its Investor Day with 14 CEOs and business heads all under one roof, let's listen in to their 5-year plan.
We did mention to investors that we would look at one new area in the next 12 months with a very high bar. We had exactly the same slide that we put up a year ago. And at that point, we had said insurance is one area we would look at. We have gotten into insurance in a space where we feel we can create very meaningful value for our shareholders. And similarly, if we find a space we can create meaningful value, we will look at it. We do play in 70% of India's GDP growth over the next decade. And therefore, our current businesses have huge room to go. And you're seeing that room to grow with holidays. You're seeing that room to grow with many of our other businesses. We've also talked about organic growth. Organically, we've grown 25% a year for the last 5 years across the group, despite being in some tough industries as well. And we plan to grow 15 to 40% organically for the next 5 years across businesses.
I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously it will take a lot of time and attention, but scaling the core remains important.
Okay, all right. We'll keep getting you bites with regard to that conversation that we had with the Mahindra and Mahindra's top brass. Well, let's focus on another company then, Medplus. We have with us Mr. Gangadi Madhukar Reddy, the MD and CEO at Medplus Health Services, who joins us. Hi, Mr. Reddy. Good morning. Thanks a lot for joining in. Well, give us a few details then. You know, your SSG growth for the past quarter, I think it was low single digits. But for the year, you've been talking about high single digits. I think you were guiding for around 9 to 10%. Is the SSG growth likely to come in at the 9 to 10% mark for the year on the whole?
No, I said we'd actually start growing to that number by the year end.
Okay.
For the whole year, maybe not. I don't think it'll actually happen. You know, this year, because of our intense focus on private label, I think some of the SSG has been a little muted actually. This is an effect of last year's thing actually.
Okay.
Our private label.
So Mr. Reddy, you get to the 9 to 10% by quarter 4 is what you're telling us. It'll gradually start scaling up. Is that correct?
So it'll probably stay there. So it'll gradually start scaling up by Q4. High single digits is what I said, 9 to 10, not necessarily, but slightly lower. But the thing is, we will start seeing an improvement in our SSG as we go forward.
Okay, all right. And you mentioned that, the larger contribution from private labels is one of your focal points. I think the last number that we have is it's close to around 19% of GMV. How do you see this number scaling up? And if you could help us out with the impact on gross margins as well. What is the guidance? So private label as a contribution and gross margins. Please go ahead.
Sure. See, for every 1% increase in private label, we'll actually see a bump of around 0.2 to 0.3% overall gross margin. This is on the MRP sale normally. And obviously, we make more money on this than what we make on the brands. So the focus is to improve it as we go forward. But I think we probably will see, I wouldn't say a slowdown, but I would say the early adopters have come in. They've actually now shifted over from the brands to the private label. The rest will take some time to convert. The growth will be slightly slower, but it will be continuous. Given the fact that countries like US have got 90% generic, I see no reason why India should not get there over a period of time. It'll take a little while, but that's it'll be a slow but steady march towards that number eventually.
Yeah. Mr. Reddy, good morning. Thanks very much for joining us, Prashant here. So I have a slightly different question, and this is actually I want to understand this. There's another company called Zota, right? Which is kind of in your same thing what you do broadly.
Not really. So we are a retailer, in the lines of let's say a Walgreens or a CVS. We sell all brands. Everything is available. We sell FMCG. We sell all the brands. We also have a significant portion of private label.
Right.
But we don't ever believe that, private label is going to be the only thing, but there's always going to be new drugs which will come out, drugs like Monjaro and the GLP-1 and all the other things out there. So if you restrict yourself to basically selling only your own brands, you'll never take advantage of the overall, set of products out there. No, we are not the same at all.
Yeah. Okay. No, I mean, in the sense that, I mean, they're also into, generics and private labels and that kind of stuff, right? So it's limited to that kind of point, I was just wondering, I was looking at, talking to a few investors, and they were actually, the feedback came from them that, I mean, Zota, if you just look at what the stock has done, is just phenomenally well over the last couple of years. It's basically at a new high, and you're actually building out this solid, very large enterprise. And I think from the time that we started talking to you on the air, you always maintain it's like, what you're trying to do is what we have in large pharmacy chains in the US. So what should we expect, sir, from an investor's point of view? I mean, I don't know how you answer that, but yeah, go on.
It's like this. I really don't want to comment on the market. True value will eventually basically get reflected out there. You can see from our EBITDA and all, it has been growing continuously. Our PAT has been growing continuously and all. And we've been adding stores continuously. The overall sales which we have is far, far higher than anyone else out there.
Correct.
So while the market can basically go this way, that way for a couple of quarters out there, I think the true thing will eventually come out. For us, the goal is to become the #1 pharmacy chain in the country. And that is by putting in as many stores as we can across the country. As we go there, benefits of scale and everything else will automatically accrue, and we will, start. Hopefully, it'll start getting reflected in the share price as we go forward.
But in terms of strategy, you're clear. You kind of are on the. There is no change in strategy or anything of that sort. I mean, this is essentially what you're building out.
Absolutely not.
And that continues.
Absolutely not.
Yeah.
So today we have a gross margin of around 25%. That gives us the freedom to actually expand through franchisee stores. There's enough money for us, enough for the franchisee who actually comes in. The fact that we are able to give something like 30% overall. I'm talking about both FMCG and pharmacy by volume comes from the Medplus brand. Means that a franchisee who actually comes in to take a store has something unique to actually sell. And not just that, we sell our products at a price which is way less than the market. So which means he'll also have a chance to basically beat the competitors around. So great value proposition for a franchisee to come. We have the brand and the basically ability to actually start growing and building the back end. I think going forward, you will see us basically focusing more on growth through franchisee, and that will be a far faster growth.
Okay, all right, Mr. Reddy, we'll leave it on that note for today. Thank you very much for joining in, and good luck for the rest of the year. We'll take a break on that note, come back on the other side. We'll have our technical experts joining in. Also, Siddharth Khemka of Motilal Oswal will be with us to discuss some fundamental stock ideas. Welcome back. As promised, let's get that conversation going with Siddharth Khemka of Motilal Oswal Financial Services. Sid, good morning and happy Friday to you. So let's talk TCS, putting a lot of money to work, getting in TPG. And this is what we're seeing globally as well, right? That's what a lot of the global giants are doing, getting private equity to fund this rapid growth of AI and data centers. Your thoughts earlier when the company announced its own investment, at the time of results, there was some issue and market was wondering whether this is unrelated, etc. How are you looking at it?
Good morning. Happy Friday to you as well, Surbhi. I think, yes, I think the investors were looking for some of these IT companies. They're generating a lot of cash and they're looking for the next phase of growth where they will find. And as you rightly said, globally, AI is the space to be in, AI data centers. I think at the time of results, they did announce investments, capex into the data centers, and now the global PE fund TPG to support its data center business. So I think that only adds to the credibility that investors would like some of these large Indian tech companies which are generating a lot of cash flows to diversify into the future or new age businesses for sure. So we are looking at it very positively. Again, as I said, there was a big investment announcement, and now with TPG coming in, they will share a portion of it. And I think the shareholding has also been decided between both the entities, so a JV will be formed. But nonetheless, that's a positive step in the right direction in future growth business.
So it's a buy, TCS?
TCS is definitely a buy for us. More from a long-term perspective, as I said, things are falling in place. And here we see a good recovery for IT companies. Although within the IT space, our top tier one preferred pick is HCL Tech, given its more diversified business model, more business coming in from the digital side of the business.
Okay. The other interesting event of the day is going to be these numbers that we get from Grow, right? Finally, we'll get quarterly financial performance. So much is going on. What is your sense? Okay, let's not talk about technically what's happening with the stock and whether there was a short squeeze or not. Let's leave that aside. Let's talk fundamentals. I mean, how do you rank the performance, and what sort of a growth run rate and margins will Grow have to show to keep investor faith intact at a price of 150, 160 where it's trading right now?
So unfortunately, Surbhi, we were one of the investment bankers, so I think I should not talk about it right now.
Okay, all right. We'll let that pass then. Any new stocks on your radar? Anything that comes to mind?
Yes. So I think a lot of stocks that are coming, especially the Mahindra Group, they have been announcing a lot of long-term vision and plans. That is something that we are looking at today morning. Apart from that, I would say NBFC is something which is doing very well. We hosted the management of Poonawalla FinCorp, the MD and CEO, for a meeting with some of our investors to discuss the company's future trajectory, as well as what is the progress that has been achieved in the past 1 year of the new leadership. So what we see is that continuously the company is delivering on its stated ambition of being a digitally enabled multi-product, high ROE lending franchisee. We believe that Poonawalla FinCorp is well positioned to sustain its 35 to 40% AUM CAGR guidance that it has given with an improving profitability. The company is also targeting to achieve its guided ROAs of 3.5% by June of 2028, which only goes on to say that apart from growth, profitability, as well as return ratios, they are on track to achieve all of them pretty comfortably. Valuation-wise also, I think with that kind of growth, we see a lot of comfort in valuation. So we have a buy rating on Poonawalla FinCorp with a target price of 600.
Okay. All right, Siddharth, thank you very much for that. We do have to take a quick break. Come back on the other side. We'll have the pre-opening rates. And, of course, we have to get our technical guests and give you some technical perspective for today's action. And then Axis Capital's Manik Taneja joins in. We discuss IT full throttle, the AI boom, some of the stocks that are beneficiaries here in India, and, of course, TCS, looking at this big splash in data centers itself.
Well, will the global scene make a difference is the question. And let's get Siddharth Rai of Stockbox Technologies and Sudeep Shah of SBI Securities in this Friday morning to answer that question. And of course, I mean, help you with what you should do. I mean, if you're trading this market. Gentlemen, great to have both of you here. Sudeep, you go first. How's the setup looking?
Good morning, Prashant. Prashant, see, yesterday we have given a close above that all-important level of 26,100, which the markets have been resisting for quite a while in the last 1 month. Several failed attempts there, and finally yesterday we have seen that breakout, led by large caps, especially IT, banking. So what we feel is that the setup from a Nifty perspective looks stable. Even if we get some kind of a softer opening today, dips should be utilized to buy. And overall now, we feel 26,050, 26,080 zone will act as an important support. On the upside, we feel the levels of 26,400, 26,600 could be visible in the next 4 to 6 trading sessions. And coming to Bank Nifty also, 58,800, 58,600 now becomes an important support. Until this zones are guarded, we may see an upside up to 60,000, 60,300 levels. The only disconnect here, Prashant, is that we are not seeing that follow-up moves in Nifty small cap. As we see a ratio chart of Nifty small cap compared to Nifty, that is hitting lower lows. So the only thing is that the broader markets are not performing. But from a Nifty perspective, these are the key levels, 26,050 as well as 58,600 on Bank Nifty.
Okay, got it, Sudeep. Let's go across to Sid. Sid, what do you make of the trading action? Global markets in a bit of a tizzy. I think the bulls out here will say, "Apna number aa gaya." It's our time has come. What do you think, so?
Hi, Najal. Good morning, and thank you for having me on the show. First of all, see, Najal, if we talk about Nifty, the past couple of sessions have been very good for Nifty, definitely. And since we also saw closing about 26,100 yesterday, just like Sudeep said, definitely I do think that will probably be taking over the all-time highs in very soon, probably in the next couple of sessions. But having said that, Nigel, right now the risk rewards for taking a fresh long position do not seem to be very favorable for the index, because for one reason, the global markets have not been very favorable, not been very supportive. The PCR is overbought in Nifty. So the better way to approach the index right now would be to take the buy on dips approach. Just like Sudeep said, a good support is around 26,100, 26,050, those regions. Once Nifty comes down around those levels, we can start accumulating the index again, because the positional on a positional basis, Nifty looks definitely very good, and it'll be pretty favorable for us to say that Nifty will be hitting the all-time highs in the next couple of sessions.
Okay, got it. All right. Siddharth, you go first then. Tell us about your top picks.
Yeah, definitely, Nigel. See, two stocks, both of these we have to buy. The first one on my radar is Dabur. See, it is only one of the very few FMCG counters which has held on to its supports very nicely. And we also saw a breakout coming in yesterday's session in this counter. So Dabur looks very good. It can be bought. Yesterday's closing was around 525. The stock can be bought. We'll keep the stop loss at 518. And our targets being the first target 535, the second target being 540. The second stock is Mazagon Dock. See, we've started seeing a turnaround with this counter probably in the last 10-12 sessions. Yesterday, there was a very nice breakout, so a fresh momentum is building up. Again, Mazagon Dock can be bought here. The spot is trading around 2830-ish right now. We can buy it here. The stop loss will be at 2799, and our targets being the first target 2885 and the second target 2910.
Okay, Sudeep, what about you?
Nigel, two stocks from my side too. The first one is from the insurance space. ICICI Lombard closed at around 2035 yesterday. This stock has given a decent breakout on weekly charts backed by volumes. And what we are seeing is that this is outperforming most of its insurance peers. And here we feel that 2000 could act as a decent stop loss, and on the upside levels of 2100 can be achievable. The second stock is Mahindra and Mahindra. Another large cap here. The stock is hitting newer highs, has been seeing good momentum and outperforming even within the auto space. So what we feel is that this stock could do 38.50 in the coming few weeks. And on the downside, the stop loss could be 36.50.
Okay, all right. Thank you very much, gentlemen, for all of those trading calls. Well, the pre-open session continues. Let's see what TCS is doing. The market's down about 80%. Sorry, beg your pardon, 80 points. TCS, which is a stock in focus this morning, seems flat on my screen. Yeah, actually, we don't have a raters yet, so we'll have to wait for it. Manik Taneja joins in. He tracks the IT space very, very carefully at Axis Capital, and there's so much to discuss. Manik, thank you for being with us this Friday morning. So, there's an overall AI debate that's raging around the world, whether this is a bubble bursting or not. But before we get to that, I mean, let's talk about what TCS has done. They're really showing their commitment, right? And now they've got a big partner in the form of TPG. How do you view this 18,000 crore rupee investment that was announced in data centers yesterday?
No, I think this basically just marks progress on the initiative that was called out with the prior quarter's numbers in terms of TCS looking to bring in an external partner either in the form of equity and debt, and thereby this announcement essentially does confirm progress on that front. And I would say this is a long gestation project on TCS's behalf, and otherwise, does it have any immediate bearing on the stock? I would say presumably.
Not immediate, but if we talk strategic direction, I mean, does it move the needle at all? Because one thing that Indian IT services companies have been called out for is lack of innovation, lack of really stepping up R&D in the next, cutting edge areas of tomorrow. So I'm not saying 1-2 quarters, it obviously doesn't change anything. But if these investments continue and if they start committing more, if the company starts committing more capital towards either data centers or anything else on the AI front, I mean, how should it be viewed?
Certainly a move in the right direction. The only thing that I would say is that TCS has been very categorical in terms of saying that that they will limit the capital commitments from the cash flows of the services business in any of these initiatives. And even if you have to do some rough maths, the kind of cash flow that TCS generates and the commitment that they have with regards to return to shareholders, they will still have some balance cash flow to commit to these initiatives. And this is something that will play out over a 5 to 7 year period. The bulk of the value for TCS still comes in from the services business, and thereby I would just say that this is just a progress in the right direction, but does not move the needle in the near term.
Manik, correct me if I'm wrong, but I think your large cap preference is more with Infosys and Wipro.
Yes.
Over TCS. Explain why?
So that's been the call for a fairly long amount of time. The reason for not preferring TCS has been both some of the portfolio aspects and the internal changes at the company, because of which TCS has been struggling on relative revenue growth compared to peers. We've seen them lose out in certain vendor consolidation exercises compared to competition. And I would say that will keep their growth performance in check compared to competition, even for the foreseeable future. So that's been the reason for not preferring TCS to other tier 1 companies over the course of last, I would now say, 24 to 36 months.
All right. Hi, Manik. Good morning. Good to see you in. What about Emphasis? It's going to go the Coforge way. The large P in there has gradually started selling. Everyone feared, right, when that happened in Coforge. And all of it got lapped up at half the price, at 1/3 of the price, and the stock just continued as growth continue. Do you believe this is an overhang, or do you think that, things will progress in the similar direction and prospects will come?
So Nigel, the difference between a Coforge and Emphasis, at least when the P was selling, was that Coforge continued with their growth momentum. In case of Emphasis, they've struggled through a majority part of the last 36 months. A combination of high exposure to BFS, high concentration of top 10 clients, some headwinds from the cyclicity of the mortgage business exposure, all of which, in my view, are turning around. And just like some of these portfolio issues were a drag on growth through the course of last 3 years, they might probably be end up being tailwinds on growth on a go-forward basis. And that's the reason why we had upgraded Emphasis to our top pick in March of this year and still retain that. So I would presume that as long as the business performance continues to chug along well, investors will lap up the liquidity that comes in from PE sale.
Manik, no, absolutely. You know, I'm going to sort of segue out maybe just a little bit. This is the persistent management on CNBC network. You know, addressing, of course, the big question of our times right now, right? I mean, which is AI. I mean, the question here in India is what AI will do to Indian IT services companies. The question in the US, of course, is whether it's gone too far, at least in terms of valuations and the big explosion of interest in that space. So here's the persistent management.
Bubble that we all are talking about is about the valuations. I don't think it is about the AI part being real. I definitely think the AI momentum is real. We are in a very early innings of this whole, percolation of AI into enterprises, into the way we do business, and so on. When we look at our customers, they have all been doing proof of concept. Some of them are going big. So this is going to be a multi-quarter, multi-year journey. So it's not about the market, the addressable market not being there. Now, as far as the valuations are concerned, markets are the best judge. Whether the Nvida valuation or other valuations are the right valuations at this point in time or not, we'll let that be the market, place. Now, as far as AI and the entire reskilling is concerned, obviously, the way generative AI and AI at large work, and they are getting infused into every part of business that we do, whether we are a tech services firm, whether you are an enterprise in healthcare, in financial services, and so on. So the amount of reskilling, the workforce transformation, that is real.
Yeah, it's real. Sometimes, of course, with markets, as they say, right? I mean, what is worth doing is worth overdoing, and markets have their own do their own thing. But that's the persistent CEO earlier. Manik, we'll leave it there. Thank you very much for joining us. Thank you very much for sort of being here on CNBC-TV18 this morning. Just a quick look at the opening first kind of rates as they will start to come in, and I think we're about a minute away to that. So, it's a broad sell-off last overnight. The pre-open has ended with about an 80-odd point cut, 26,100. So it's basically back to that kind of, that number which the market was struggling to get out of. Yesterday, of course, in that big rush, took that level out, got to within 30 points of a new high. So we'll see how it goes. So, optimism as far as India is concerned, but globally there is a bit of a red on the screen. So we'll have to see how much of that matters. A third lower, 26,120 is where we're at. The Nifty Bank is starting about a third of a percent lower as well, 59,130. The small cap index is down 0.16%. The mid cap index will come up on your screen. And there as well, there's about 200 point cut. That's about a third of a percent cut there, 0.4% actually on the mid cap index as well. So almost 100 points now. So exactly at about 26,100. The Nifty heat map will give you a sense of where we are opening up as far as the 50 stocks go, and then we'll pick it up from there. So it's just about 4 or 5 names in the green, and TCS after that TPG deal is the top gainer. Otherwise, I mean, stuff opening on the downside. Hindalco, Nigel was telling us about that Novalco news and Novelis news, beg your pardon. And actually just 45 odd names, 46 odd names in the red at the word go. Surbhi.
Okay, indeed, Hindalco is down about 3%, making it the poorest performing stock on the Nifty right now. There's a whole lot of red on the screen. And it's across the board, really. Shriram Finance, ICICI Bank, Axis Bank, Bajaj Finance, SBI. So all of your financial space is weak. Bank Nifty is down about 0.4%. There's HCL Tech on the downside, I can see. There are some consumer names like Eternal, Tata Consumer on the lower side. Reliance itself is lower by about 0.5%. Yesterday, remember, Reliance was a great support for the market. It's starting about 0.5% lower. On the upside, there's Mahindra and Mahindra. Almost all brokerage notes that I saw were calling for levels, well over 4,000, ranging from 4,200 to 4,400 in some cases on that stock. So that's doing pretty well. A little bit of green on Asian Paints. TCS barely positive, just about 0.3, 0.4% up. And then it just starts fizzling out. So right now, this is a down morning. There's no taking away from that. 80 points lower. But the question is, if this dip gets bought and if we can have a green close, that'll be some Friday, Nigel.
Yeah, that will be. The bulls on the back foot to start trade. But hopefully by the end of it, they're going to go into the weekend with their dancing shoes. That said, let's focus on a few stocks on the broader markets. I thought Surabhi will highlight there. It's growing at least for now. It's up 3.5% in today's trading session. So good uptake is what we're seeing. Physics wala, yesterday I think the low was around 122 rupees. From there, the stock has seen a good recovery. Remember, there is limited float on all these stocks, but That one for now is up close to around 3%, and it's recovered all of yesterday's losses. So at least some green on that particular name. What's losing out? Hindalco. That's seeing some selling. And since there is some strength that we're seeing on the dollar index, which is at a 6-month high, you have, LME-related names, aluminum-related names, Nalco as well is a little bit softish. I think you have NMDC that's a little bit soft. Even Tata Steel actually has seen some kind of profit taking just to kickstart trade. Other stocks that are in focus today, well, Lakshmi Dental, that's up close to around 4%, but volume's not very, very high on that particular name. While on the losing end, Hindalco's, yes, one of the top losers out there. But besides that, not too much to talk about. Netweb is giving up some part of the weight that it put in yesterday. It's down close to around 3%. And you have JTL as well, that's down close to around 2%. Promoter has been buying, I think, more than 10 lakh shares in this week itself. AWL, agribusiness, 6.6% equity has changed hands. Vivek had alerted us. Likely to happen. Bang on. It's happened.
No, absolutely. And, lots of transactions and deals, etc. will continue. 1,600 stocks are lower and about 700 stocks are higher as we start. So that's the picture overall in that sense. We've, of course, addressed Netweb once in a while. That's kind of the licensed player to sell Nvidia gear in India and actually around Southeast Asia as well. That is down 3% after that big AI sell-off last night. But as somebody was pointing out, I mean, this TCS deal with TPG to build out the data center, that's the other side, right? Which basically shows that, and that's what I think the Persistent CEO was telling us earlier, the business momentum is there. And I mean, the story is absolutely right, but markets, of course, try to discount all of that now, and that sometimes becomes a problem. Too much upfront, perhaps. Keep an eye out on Reliance as well, because RIL was one of the big reasons why the market looked so buoyant, right? I mean, Wednesday's close was 15.18 or so. It closed at about 15.50 yesterday. This morning started lower, is recovered 10 rupees, 11 rupees already, RIL. So that's a big one, right, to keep an eye out on. Otherwise, I think the market breadth is slightly negative. It's still too early, nothing dramatic. Hindalco is down 2.5%. Some of the silver Bs is down about 1.6%. Supreme is down about 2% or so. So just kind of scattered kind of price action as we look at things at this point. TBO Tech on the upside. TBO Tech is coming up with about a 2.5% pop. There is Anupam Rasayan, which is up 2%. Rights is up 3% this morning. South Indian Bank is up about 1.33%. Sammaan Capital, it's coming up with about a 1% pop. Pretty violent price action last 3 days. But it's coming up with, it's the fourth largest volume-led gainer. In terms of volumes, it's the fourth largest. And so that's the reason why I'm mentioning it. Credit Access is up about 2%. So yeah, there's enough and more which is coming up on our screens as we start this day. 60 points lower is what we have on the index, all told, with about 3 minutes into market open. Harsha Upadhyay is Chief Investment Officer, Kotak Mahindra Asset Management Company. He's with us here. Harsha, thank you very much for joining us. Characterize the environment, Harsha, if you will. Global markets have done so well that you're seeing a bit of a pullback. I think that's the simplest, maybe the neatest explanation. And I think that encompasses everything which is going into the mix there, right? As far as global is concerned. But here in India, there is optimism. One is this India-US. At some point, it has to happen. Timeline is unclear. And of course, as maybe people look for other things to do once, they say, well, maybe too much has gone on into this AI thing. So what do you think? Which way do the scales tilt?
Good morning, Prashant. As you rightly mentioned, I think global equities have done quite well over the last several quarters, and we are seeing a bit of pullback there. Yes, the global macro environment is somewhat different than what India is witnessing at this point of time. So I do not think that we should relate what's happening in the globe and take a cue from there for Indian markets. If you look at Indian markets, the influence of foreign institutional investors over the years has reduced quite a bit. As in earlier, whenever they used to sell in large quantities, market used to show a lot of downside volatility. That's no more true. That's point number one. Second, if you look at India in relation to globe or in relation to emerging markets, over the last year or so, we've seen almost about a 30% kind of an underperformance, which is very, very large underperformance. So to that extent, even if there is a pullback in global equities, I do not think that the current valuations of Indian markets warrant a similar move in Indian markets. And to top it all, we are also likely to see earnings improving over the next couple of quarters and also in financial year 27. That's the expectation currently. So given all of this, I would say that we may not participate on a one-to-one basis with what's happening in the globe of late. However, the upside also will be dependent on, as you rightly mentioned, some of the factors which could impact sentiment, such as a favorable trade deal with US, etc. Otherwise, it's going to be a reasonable market, much better than probably last 12 months. However, it's not going to be anything equivalent to what we saw between 2020 to 24, which was absolutely a phenomenal period for earnings growth, valuation re-rating, all of that. I don't think we should assume that kind of a market is going to come back anytime soon.
You know, Reliance, keep an eye, as I was saying, 15.55. So 15 rupees off the lows on RIL. And, you know, if RIL starts to perform, it'll basically make up for a lot of the other stuff, which may be going the other way at this point in time. Market's down just 40 points now. Sudip.
Yeah, absolutely. I was tracking that. It's looking like the bulls want to fight back. Hi, Harsha. Great to have you with us. Let's talk tech. That's the conversation everywhere around the world, right? And even here in India, because now we've started getting some contrarian buys as well, citing valuations, citing, you know, obviously the cash levels that these companies have, and then the moves that they're making, TCS being case in point, they're taking those steps on the data center front. How are you looking at the large cap IT services space? I mean, do you see it as a defensive fit in the portfolio, or do you think it'll just keep struggling at low single digit growth levels, so best to keep away?
Surabhi, I think you used the right set of words. You said contrarian buy. I think that's what it's going to be at this point of time. Yes, it has not participated in terms of market moves over the last 4 or 5 quarters. And now there seems to be some bit of a move there. However, nothing has changed on the business momentum side. And still, some of the medium to long-term headwinds that are there for IT services, especially Indian IT services, still continue to be there. And as you also mentioned, the earnings growth trajectory for these companies is going to be much lower than average market earnings growth over the next 4 to 6 quarters. So given all of this, at best, it's going to be a tactical pullback that you will see at this point of time, or a contrarian purchase that you will see from certain market participants. But I would assume that non-IT services would be a sector or a segment to watch where there could be more outperformance rather than IT services itself.
So, sorry, just to complete that, when you say non-IT services, you mean other aspects of technology which are not traditional services companies. Is that what you're saying?
Yes, I mean, you can have selective investment opportunities in internet-based businesses where there are several businesses which have really scaled up well over the last couple of years. And also, as we forecast their growth over the next couple of years, we do tend to see a lot of growth in some of those companies on a bottom-up basis.
Yeah, Harsha, I'm glad you brought that. That's why I was just clarifying that if that's what you meant, because that was exactly my question, that IT services is not giving you growth. But now you have so many of these internet businesses coming, internet/digital these days, and every new business has a technology layer to it, right? You could be selling, eyeglasses, and there's tech there. You could be a broker, and then there is tech there. There's payments, and then there is tech there. So how do you slice and dice, and where are you comfortable with valuations? I mean, are the valuations still palatable? Because these are very fashionable stocks.
So I don't think you can, paint all of them with a single brush. While all of them use internet to do their businesses, the underlying business strength is something that you need to evaluate. Where there is a larger opportunity size, what's the kind of competition that you are seeing? Are there any entry barriers for a new entrants to come in? What kind of capital allocation some of these companies are doing? So I would say it's going to be purely bottom-up, even in the internet services. Just like what you see in traditional businesses, you cannot paint all the traditional businesses with a single brush. And same thing holds true for even internet-enabled businesses. I think the underlying businesses will determine to a large extent what kind of growth you're going to see in those businesses. And then there is an aspect of how good the capital allocation and efficiency that each of those companies bring in. So net, I would say you need to be selective even in that particular segment. And most of the valuations there are, of course, discounting some of the near-term growth that we are going to see. So it's not that anything is hidden in terms of valuations there. So you need to take a slightly medium to long-term call and stick with it and wait through volatility for all there is in those businesses.
Hi, Harsha. Good morning, and always good to see you in. Harsha, a lot of households, mine included as well, a lot of what you earn starts going into SIPs, into the mutual funds as well. And you're hoping for a brighter tomorrow, 10, 15 years down the line. However, in the near term, the issue has been the kind of supply that you're seeing. And appreciating good businesses is very, very good, right? Whether it's PEs, whether it's promoters, they have put in a lot of heart and soul and build those businesses. But when the kind of IPOs that are coming about, these sort of valuations, it appears that, they are exiting with the money, you're being left with the dream. What do you have to say to this? Because the kind of flow of paper that you're seeing, not in this year itself, but what is lined up in for next year, is very, very excessive. What's your take?
So, Nigel, even when the markets are doing well, there are several market opportunities on the secondary market which may not give you the same kind of returns as some of the others, right? So everywhere you need to be selective. More so in case of IPOs, because generally the offer for sale that's come from some of these IPOs is from either promoters or private equity investors, which means that they are the ones who know the business, they have run the business for quite some time, and they are coming and selling at this point of time. So obviously, knowing the business growth, knowing the internals of the company, they are offering their shares at a particular valuation. So that's where you need to be even more diligent in terms of evaluating some of those opportunities. And if you look at Kotak Mutual Fund, for example, we have been very, very selective in IPO opportunities. And that has worked for us. I think that's going to be the way that you will be able to manage the money. Otherwise, if you buy into all of the IPOs just because there is an IPO and there is an offer for sale, I don't think that's going to work. And if you look at the strike rate of IPOs over the last several years, I think these numbers are very clear and it's in front of you that the strike rate that you see in IPOs over a period of time is much lesser than secondary market opportunity. So definitely there needs to be more cautious stance on IPOs.
Okay, all right. What's the wisdom there? And I think we can all, do with a little bit of caution as well in that side of the market. Harsha, thank you so much for joining in. Good conversation as always. And we look forward to another one soon. Thank you very much. Well, with that, we'll move to our next guest. And as we do that, quick glance at the screen. Market is down, but not out. The bulls are trying to fight back. We're just about 35 to 40 points lower on the Nifty at this juncture. Look at that. There was a tinge of green on the Nifty as well while we were speaking with Harsha. But now there's some selling. So interesting Friday morning playing out. But for the time being, we're putting the spotlight on the real estate space. And we have Mr. Ashok Kumar Tyagi, MD of DLF, joining in. Sir, so good to have you in. I mean, always wonderful to get perspective from you on the business and on the overall market. So, a couple of things that we really want to focus on are key talking points, so to speak. Obviously, we want to get an update on the guidance because you've done very well in the first half. So we need to see, how strong those demand trends are, the bookings target and the launch pipeline. So let me start by understanding your sense of demand in your home turf first, at your home turf, the NCR market. It's been a very good first half. You are already at 70% of your guidance, I think 70% plus. What are you expecting in H2? What is the consumer telling you?
Okay, so 2 points, Rupee. Good morning. One is, as far as the consumer is concerned, I think the underlying demand for, I'd say, the more credible developers and the more credible products is there. I don't think there's a slowdown there, frankly. Yes, obviously, whatever you read in the papers in terms of, challenges, etc., going forward, I do believe, in fact, if I were to borrow a line from your conversation with your last guest, a tinge of caution is not a bad thing. But I believe that maybe some of the fizz may gradually start slowing down. But for the underlying, the credible guys, the 5 or 6 players who are, I think the underlying demand continues to be strong. As far as we are concerned, we had guided the market to a sales pipeline of ballpark 22,000 crores, 20 to 22,000 crores for the fiscal. We stick to that. So, I mean, we know we have done 15,000 plus in the first half. But, much as we would like it to be, this unfortunately is not like an auto assembly line where, every day you are launching something. So I think we would, for now, at least stick to our originally guided pipeline, launch pipeline for this fiscal of the ballpark 20 to 22,000 crores. Over the medium term, in fact, in March, we had come out with a five-year guide plan. And I think we have a pipeline of almost 60,000 crores of products lined up for potential coming to the market in the next 24 to 36 months. And all of them will gradually come subject to approval, subject to how the demand is shaping up. So I think we are by and large, we have defined our grid rails, and I think we should hopefully keep on having a reasonably good ride on them.
Mr. Tyagi, hi, good morning. Prashant here. It's been a while since you've been on the channel.
आपने बुलाया नहीं?
हमने बोला, हम तो बुलाते रहते हैं आपको. आप तकल्लुफ करते हैं, but I think उम्मीद रहेगी आप आएंगे, और आएंगे. But Mr. Tyagi, just a quick, I just want to get, we'll get to the launch pipeline, etc. I think you were at an investor conference and you've guided everything to the street. And maybe we can touch upon some of that stuff. But since you're coming on after a while, how's the consumer in your sort of core market holding up? I mean, is it as strong as it was when we used to speak 6 months, 1 year ago? Is the absorption as smooth? Just wanted to get some color.
So okay. So Prashant, I mean, to the point, in fact, to just supplement the reply that I gave Surabhi just now, I think, as I said, the major or the more credible players, where the customer has an underlying belief that these guys will deliver the products to the quality specs, etc., that they have committed. I think the demand, at least in the NCR, at Gurgaon definitely, and I think even in Noida, continues to be underlying strong. So what happens in any bull market, even in real estate, is that at times some of the non-serious players, for want of a better word, get on the ride. And I think over time, maybe some of them will start feeling the slowdown in terms of their specific thing. But I don't believe that for the more credible players, there is a challenge right now. Obviously, one needs to be sensible about the product. One needs to be sensible about pricing. One needs to be sensible about the location. But I think given the fact that at least for us, we have most of those things lined up pretty neatly, I think we don't foresee a demand slow down in terms of what we bring to the pipeline, we bring to the launch pipeline. We'd obviously need to be sensitive to the fact that you can't launch 50,000 crores in a quarter. In that sense, that will obviously be far more than what the market can absorb. But as long as there's a certain degree of interval between what we are launching and there's a certain degree of upgrade stroke variation in what we're offering to the market, I think the demand continues to be good.
Right. So like to like, everything else excluded, for DLF, the environment is same. I mean, you are a credible player, you're the oldest player perhaps. There's no difference, or there is some volatility in terms of absorption. Because, as you said, non-serious players may be overbuilt, there's too much maybe supply, they've in some ways at the margin spoiled the market. I mean, are those things affecting you in any way? Pricing-wise or volume-wise?
So the simple answer is no. I mean, the last major launch that we got to the market was, the Privana North, which did extraordinarily well. The resale market, which I've always maintained is a very secular indicator of how the market is going on, continues to be very bullish and very strong, at least in our micro markets, both in terms of the demand for new transactions happening, as well as the price points and the price accelerations there. So I think the secondary market continues to be strong, which leads us to believe that I think there continues to be underlying demand for good primary products.
All right. Hi, Mr. Tyagi. Good morning. Good to see you in. It's been a while since we chatted as well. But let's get a couple of aspects out of the way then. The rentals. You have the completion of some retail projects, right? Midtown Plaza, Summit Plaza, Goa Mall. how do they aid rentals? If you could help us out with that. I think you all were talking about exit rentals in FY27 of around 400 crores. If you could just reconfirm that number. And also your balance sheet is in fantastic shape. I think you're sitting on close to around $1 billion. How will you be using this for expansion activities? Is there a sweetener you're going to be looking to give your shareholders?
Okay. So, Hector, Nigel, let me reiterate that when my communications guy told me that you will be one of the anchors, I had to go through my numbers because knowing your posture for numbers, in that sense. So anyway, so the three malls that we are very close to completing, one in Golf Course Road, one in Midtown in Moti Nagar, Delhi, and one in Goa. You're right, should ballpark on a full throttle basis have a rental in excess of the number that you mentioned. Our overall rental run rate fiscal 26 exit should be in the range of 6,000 crores and fiscal 27 should be in the range of 7,000 crores across Cyber City, the DLF rental projects, as well as Atrium Place, which is our joint venture with Hines. So I think the rental space continues to be very strong. Our vacancy levels are in the mid-90s, and that's our occupancy levels are in the mid-90s. So I think the rental space continues to be strong. We are focusing more on the retail piece also now. There is a bigger retail project coming up in Gurgaon called Mall of India Gurgaon, which should hopefully in the next 3 odd years, see completion. So I think that's what the ballpark, sketch of the rental business is.
Mr. Tyagi, so we'll come to the cash as well, but given your big portfolio, malls, commercial spaces, you don't want to do a REIT? REIT guys have been doing very well and attracting a lot of investors as well.
So yes, in the last, I'd say, couple of quarters, the REITs are doing well, which is wonderful because I think it's a very interesting product. Mm-hmm. We have been very clear, Surbhi, that we are not pro or anti-REIT or pro or anti-IPO or anything. But we have no intent of taking Cyber City to the public markets till such time that our partner, which is GIC, wants us to. I mean, as and when they believe that there is a requirement for them to sort of guide us to move Cyber City to the public markets, we'll be more than open. That's an agreement that we have with them. But where we are today, frankly, especially with 2 very major projects underway, one in Gurgaon and one in Chennai, we don't believe that at least the next 3 odd years is the time for us to go public there.
Okay, so no REIT at least for the next 3 years. Now, quickly, Nigel's question on how you'll use that cash, 7,000 crores plus. And also, since the first half has been strong, and you remain optimistic on your business at least, will you revise the guidance, which is currently at 22,000 crores?
So the answer to the second one is no. We won't revise the guidance,
Why have you already done 70% of that guidance? So why are you not hiking it higher?
This is not a linear business, in that sense.
True.
So whether we can get all the requisite approvals, etc., for the next big launch before March. So I think right for now we'll stay with the guidance that we have. To the cash question of Nigel and you, I mean that's the only side which we have been very transparent in our analyst presentations. That yes, we are sitting on 7,700 odd crores of net cash position, which frankly is increasing by almost 1,000 crores plus every quarter. The issue today is that if you look at our presentation, almost 8,000 crores is today locked in the 70% RERA account. I mean, so yes, the cash is there, but frankly, as we speak right now, the cash is only generating FD returns, and that is all that the cash can generate. We believe that from the early part of the fiscal 27-28, we'll enter that virtuous cycle of this generation of projects hitting their completions and the cash being released. So to your question of what to do with that additional cash, I think is a question that we will answer then. We have broadly said that the cash will be used for essentially two things. One is clearly increasing shareholder returns, which we have been increasing at a certain pace over the last 4 years. B is investing back in growth. And C, frankly, if hopefully we will have surplus cash, we will see how we can also, increase and maximize the returns once we have no constraints of the RERA 70% account.
All right, Mr. Tyagi, can't let you go without asking you which part of the cycle we are in the real estate cycle. The pessimists are saying very close to the end, optimist, and you're sounding very optimistic. They're saying we're at the start of it, just day one of the 5-day test match. Where are we?
So I mean, what is bilkul data backed is that we are, I think, in the 4th year of the upcycle for sure.
And the upcycle is 10 years.
No. So there, I think, I'd say I would desist from taking a guess. 7, 10, 15, 18. The only thing that I'd say is, Nigel, that unlike the last down cycle, if and when the down cycle comes, and you're right, at some stage it will, most of the grade A developers are virtually completely deleveraged today versus the situation 10 years back when most of us were saddled with leverage. So I think all of us are hopefully far better equipped to handle the down cycle as and when it comes.
Okay, all right, Mr. Tyagi. Always a pleasure, sir, speaking to you. Thanks a lot for the compliment as well. I'll keep at the numbers. Thanks for joining in, giving us the guidance. You're sounding optimistic. Year 4 of that real estate bull market cycle that we've seen. We chat up soon and wish you all the best with the new launches as well.
Thank you.
All right, time to slip into a short break. On the other side, the management of Metro is waiting for us. They'll give us the outlook for FY26 as well as they'll give us the demand trends as well. Welcome back. Well, as promised, let's get chatting with the footwear company Metro Brands. That's in focus after launching Metro Active, a new brand of stores focused on athletic footwear. We're joined by Mr. Nissan Joseph, the CEO at Metro Brands. Hi, sir. Good morning. Always good to speak to you. Well, the top talking points that we're looking at is how are the demand trends in the Q3 so far, the transition after the GST rate cuts as well, how are things panning out, and the new offerings and the store launches. But let's get to the recent announcement then, sir. You have announced the launch of Metro Active. That's for athletic footwear. What kind of expected revenues you're looking at, the kind of expansion plan that you've seen? Clearly, there's a big potential out there, and you have launched in select cities. But I'm guessing in the next few years, you'll have a plan. Maybe 3 years down the line, how big can this become?
Yeah, well, I think let me get started and talk about the positioning of Metro Active. It's very much designed for a performance seeker, and it's for people that want to get active. And activity is really an individual-based criteria. Whether you walk 1 kilometer or you run a triathlon, this store is for you. Whether you play pickleball or you play squash, whether you play cricket or you play soccer, this is for active people, and that's hence the word Metro Active. We carry some of the world's best brands when it comes to athletic brands, such as Nike and Adidas and Puma and so forth, and we also have Asics. So these are some very, very well-curated brands that are best in class for athletes in different sports. The stores are going to be ranging around 3,000 square foot. They cater to men and women, and they carry a small offering of athletic apparel to go with your workouts, right? So the whole idea is to engage the community in getting active, and whatever level of that might mean. We've opened our first store in Indore. We're getting ready to open our store in Dehradun, followed by Jodhpur this year. And early next year, calendar year, we hope to open in Surat and Nashik. As you can tell, we're targeting really underserved communities that have a huge growth in athletic participation. So athletic participation is going to more than double in India in the next 5 years. That's just one data point. The other data point is, I don't think people know this, but there's over 700 races that happen in India every year. We all know the big four. We talk about the big four marathons, but there's over 700 races that happen in these towns that we believe is highly underserved in having access to products, access to information, access to knowledge, access to running communities and workout communities. So we want to create an entire ecosystem where we can help people get active.
Okay, all right, got that. But you don't have a ballpark number that you're looking at? Clearly big potential, but would you have a target as a percentage of your revenues, or if you want to put an absolute number out there?
Well, I think the percentage of revenues would be misleading simply because, we do plan on growing our Metro, Mochi, our Walkway banners. It's not like we're going to stop growing the other ones to grow this one, right? So this has to be catching up to do, in an arena where everybody is pretty much growing on an accelerated pace. So, as you know, last quarter we opened 40 stores. We hope to see that pace starting to become part of our DNA. At the same time, we opened up another 3 Foot Locker stores in the quarter. So there's a lot of activity going on in terms of new stores. So I think what's more important is, we believe there are a lot of underserved communities like Indore, whether it's a Patna, whether it's a Hubli, whether it's a Dharwad. There are tons of these communities, there's tons of these cities where people need to have access to information and great products. So I think the opportunity is quite significant for us as we look long term, but it's part and parcel of the Metro Brands fleet of stores that we plan on continuing to grow.
Okay, all right. Let's focus on a couple of other trends then. How is demand being post GST implementation? Q3 has been as good as you expected, and tie that in terms of what can you do for the year. First half of the year, you've done around 1,279 crores. Last year, you did ballpark around 2,500 crores. For this year, what is the broad range in terms of revenue?
Let me take it one step at a time, Nigel. And I love the way you corner numbers on people. But first things first, I think we're very pleased to see the demand trend that's happened that started in Diwali and has continued through the wedding season. As you know, we're in the peak of wedding season right now. And those trends have been very consistent with what we would expect, actually quite consistent, especially compared to the lumpiness of the 3 years. And I'm calling it 3 years post-COVID because, we had the revenge shopping, then we had the revenge eating out, then we had the revenge travel. I think we had the catch-up weddings. I can't call it revenge weddings, right? So all that created a shift in how consumers spend their money, where they spend their money. It was domestic travel first, then it was international travel. Now we're starting to see hotels in Goa fill up. Airfares are starting to get on the rise again, showing that what we're seeing is the consumers going back to spending money the way they used to spend it in allocations rather than in pent-up demands of different needs that they have. So we're very encouraged by that. We're quite excited about it, actually, to see us finally getting into a normal pattern of some sort. Having said that, though, we're going to have a slightly offset January because last year we had wedding dates in January. This year we don't have any wedding dates. That stuff's going to continue. But when I look at it at a broader trend, we definitely see demand as being on the uptick, as you've seen from our numbers in the last 2 quarters. The other thing is, the GST effect, I think, has had a positive effect for us, especially in our walkway business, where almost 90% of their products benefited from the GST. But that doesn't mean Metro and Mochi were in any way not recipients of that. In Metro and Mochi, we see about 35 to 40% of our products that got positively impacted by the GST rate changes. So, we are seeing a lot of good things happening and a lot of stabilization in demand, which is very exciting for us.
So you are very confident on demand, Mr. Joseph. Quick word on margins as well. You're around, I think, that almost at that 27% mark right now. By the time we end this year, do you think you'll get to 30% as you've mentioned in the past?
Yeah, I mentioned it, and we're going to stick by it. Having said that, though, we are making some great investments right now, whether it's in marketing, whether it's on our new stores, and so on and so forth, right? So we don't expect that to be in any way dilutive to that. But I also want to assure that we're not just doing it. We're not just running our business for the sake of hitting a number there and hitting that margins. We're going to hit those margins. However, we're also continuing to invest in our business, both from a people standpoint, from a technology standpoint, and also from marketing standpoints. As we raised our marketing spends over the last 2 quarters without it being erosive to our top line.
Okay, and just a quick comment on Fila, break even there, and also Foot Locker in terms of the rollout that you are planning for the rest of the year.
Yeah, so I think Foot Locker, the BIS rulings that came in that limited the import of certain footwear products continues to have an impact on how fast we can open those stores. We're hoping that those issues start getting resolved in different ways, mainly by a lot of manufacturing shifting to India, but also, some factories getting certified abroad to bring in some of that heat product. But till we have a sense that has settled down and we have good visibility of the supply chain, we're going to just keep that Foot Locker growth a little bit on the slower side. Though we're still opening stores. We're going to open another store in Bangalore in this coming month. So it's not like we've stopped opening stores for Foot Locker. We're just being a little bit more cautious or a little bit slower than I'd like to be. And I think we'd have been a lot faster with that BIS behind us. As far as Fila goes, we are in the middle of repositioning for Fila. The repositioning is going to be about an 18 months to 24-month journey. So it's not as fast as I would like it, but you don't build brands overnight. And we want to build it right for the future. So we're not trying to rush it through. But on the flip side, we've seen some very good green shoots on some of the products we've launched, predominantly in our Metro Mochi stores. So we can get a good quick read as to how that positioning is coming across. But we're also excited to see that Fila is selling really well in Foot Locker and in both footwear and apparel. So there are some good early green shoots coming through, but I'm not going to get out the party hats and start celebrating it. It's a road ahead, but that's how we do things. We're building it for the long term.
Thanks very much and for joining us. And I think for me, the number which stood out, 700 races in India. I didn't... 700, right? So
actually, Prashant, I was being a little conservative. I believe it's actually over 900, but I thought I'd go safe on TV.
Wow, that's some number. Thank you very much for joining us. Really appreciate it, and good luck as you continue to execute. Thanks very much.
Thanks, guys.
Okay, well, I think markets are down, 100 points, 26,100 is where we are at. We'll shift gears now and focus on Mahindra and Mahindra. M&M held its investor conference, and my colleague Shireen spoke with, the entire who's who of the Mahindra top brass, 14 CEOs and business heads on their plans for the next 5 years. Listen into a slice of this conversation.
Let me quickly quickly go around the room, and Rajesh, I'll start by asking you vision for 2026 and the vision over the next 5 years. What do you hope to complete?
We can't call 2026 a vision. It's almost a budget. So, yeah, Shireen, we don't put out guidance, but we have this time to say that our businesses are going to grow multiple times in this decade, and we are very, very positive and optimistic on every business that we are in. The SUVs is doing very well, and there's a lot of upside. The LCVs as well. And tractors, we put out some specific industry numbers, and we stay very positive about the next 5 years.
Industry-specific numbers.
Well, we're not going to lose market share, so we'll grow at least that much.
You'll grow at least that much. Mohit, I know, try and manifest a little bit
I'm going to put up the vision board. I think I'm going to put up the vision board. Look, I think we put out a very clear plan for FY27, right? At the time we put it out, candidly, most analysts didn't fully price for it because they said, look, this looks really, really difficult in terms of margins, in terms of growth. But over 6 quarters, we have demonstrated resilience and performance towards the goal. So if you think of it, as a plane, we were taxiing, now the wheels have left the ground, and beyond FY27 is the time to go supersonic.
Go supersonic. You're going straight from taking off to going supersonic, and perhaps that's the best segue to come to you, Vinod. How quickly do you believe you can go supersonic with your business?
So, Shireen, as Anish said, we are sitting on a huge order book right now, which we have won in last 1.5 years. And the priority for F26 is very clearly to industrialize those packages, which in this industry takes a couple of years. And once we industrialize, then the revenue starts kicking in. And the most important thing which we are right now doing, which we are actually paranoid about, is that we are on one hand we are delivering the orders which we already have executed. On second hand, we are doing industrialization, and we have to do both very, very well without losing the reputation we have built, and that's clearly is our priority for 26.
That's the priority. Manoj, of course, Signature Resorts, I would imagine, is going to be the key priority as well as the key ambition.
Yeah, so of course we are in a growth market, so I think Signature Resorts is one new foray which we have articulated, but really I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously it will take a lot of time and attention, but scaling the core remains important too.
Nal?
F26, I have a must-do target, Rajesh said he. So we have to do mid to high teens growth in our SUV portfolio and high single digits and not lose share in the LCV portfolio. But over the 10-year period, we have a 8x target in terms of revenue top line for the auto business.
8x target. Amit?
So we have F27. We are pre-sales 4,500 to 5,000 crore. We are at 2,800 crore, so significant jump. For F30, 10,000 crore sales, which we'll try to accelerate sooner, which will be over a period of decade, will be 14x from where we were in F20.
Vijay?
Well, I think the focus will be on 4 growth vectors. Create a fortress around a domestic business, scale up international, scale up farm machinery, pioneer technology. Do all of this to deliver a 3x growth in revenue and meet our aspiration of impacting farmers' lives globally by pioneering technology. And do this through think big, do less, and execute flawlessly.
Suman?
Over the last 3 years, we have delivered 5x EV volume growth and put 300,000 EVs on the market. Our aspiration is to close the decade with 1 million EVs on the market.
Okay.
So that's across all the categories.
Across all the categories, 1 million of EVs on the road. That is the aspiration and the target as far as you're concerned. Avinash?
I think it's execute well on the projects that we've already won. Focus on winning new bids, especially more complex ones that are able to deliver peak power using batteries. And then ensure that the projects that we have built focus rigorously on quality and then recycle capital so that they can go back into new projects.
Rahul?
I'll draw from Anish's slide today where he positioned TechM and Mahindra Finance under unlock full potential. So clearly there's a pivot to growth. I think that growth will be on a couple of pillars. Number one is defend our vehicle business. Number two is grow our fee-based income. And number three is build adjacencies in mortgages and SME.
Okay. Amar, which is going to be the most crucial metric that you're going to be watching closely and chasing after over the next 5 years?
I think for us, the growth momentum is there. I don't think that's going to be, I think Anish already laid out a 15 to 40% growth metric across all our businesses. So the growth metric is there. I think the profitability and the ROE must stay to what has been committed externally, the 15 to 20% growth in EPS and the 18% ROE commitment that we have made, because that's the discipline that will make. For me, the big thing going into the 30s is going to be, there are a lot of Indians who are admired for being CEOs of big global brands. We want Mahindra to be the Indian brand that's admired globally, right? And I think that will all come from all of this that you've just heard today.
Well, Anish, the pressure is clearly on you.
The beauty here is the leaders we have here are absolutely incredible. And therefore, that makes it much easier. We are building on a very strong foundation. And we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade, from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespaces 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
All right, that is Mahindra and Mahindra, their entire top team laying out business plans, strategies, and their ambition for the coming few years across the businesses, multiple businesses, and the stock is doing really well. Okay, let's get to Chandan Taparia now to understand some trading cues for the day. Chandan, thank you for joining in. So we started with a bit of a, a gap down, small gap down. But the question is, do you buy the dip? What would your trading strategy be?
Yeah, good morning. Thanks for having me. So major trend of the market is positive. In fact, on the last trading session, we just missed the lifetime high by few points. Our index headed to us 26,250 and lifetime high is 26,277. So market is absorbing supply near its all-time high, and that is a good sign. Today it's down, but I believe till it holds above 25,850, buy on decline could continue for an upside move towards all-time high of 26,277 and a fresh rally towards 26,500. So buy on decline could continue as of now. However, one interesting thing we have noticed today is India VIX is up by around 8-9%. In fact, it headed towards 13.3 marks. So surge in the VIX is the reason that the market is finding some pause, but overall buy on decline could continue as major trend of the market is positive. Now talking about Bank Nifty index, here the trend is positive. In fact, Bank Nifty has been making all-time high from last few days. Till it holds above 58,500, buy on decline could continue for an upside target towards 59,500 to 59,750.
Okay, all right. 100 points down on the Nifty for the time being. What about individual stocks? What are you working with today, Chandan?
Yeah, so positive on the Nifty auto segment. This is one of the strongest counter, which is all set to give a consolidation breakout. And here we are picking buy on Eicher Motor, one of the strongest counter, which has given a consolidation breakout of last 8 to 9 weeks. It has been making higher top, higher bottom on the daily chart. In fact, the longs are being added, and the counter is expected to witness a rollover of more than 80 to 85%. So recommending to buy on Eicher Motor with support of 69.50, and this counter has potential to rally towards 74.50 kind of level. Second trading idea, that is buy on GMR Airport, strongest price pattern. Counter is trading higher than its volume weightage average. In fact, we are witnessing put writing at 100 strike. Call unwinding started to witness. Short covering is expected in the counter. So in fact, technical wise, we are witnessing a bullish implication of pole and flake pattern. So recommended to buy with support of 102 for an upside target towards 109 level. So two ideas, one is Eicher Motors, second is GMR Airport. And apart from that, bullish stance on the Nika as well. One of the strongest counter which has been consolidating from last 3 days, but trend is positive. Derivatives data indicates bullish stance. So one can buy with support of 263. And here we are looking for an upside target towards 282 kind of levels.
Absolutely. Thanks very much for that. We're going to take a quick commercial break here. Markets are down about 100 odd points. We'll come back. Manisha will take you through what's happening on the commodity space. Coming up.
Welcome back. Well, we've told you about the equity picture where the market's still down about 100 odd points. Let's figure out what's the latest in commodities. Manisha is with us with the latest. Manisha, what's catching your eye?
Oh, the crude oil prices, because we've seen constant decline into this one, and we are back yet again below that $60 per barrel mark for the U.S. crude oil prices. Well, we are trading at a 4-week lows when it comes to the crude oil prices, and we are headed for a weekly decline as well. When you look at the U.S. crude inventories, well, that has been one of the major reasons that is putting pressure on prices, up 4.4 million barrels, and this is a third weekly gain that we are looking at in sense of U.S. inventories. Remember, the U.S. inventories have been climbing. The U.S. production is near all-time highs as well, and that continues to put pressure. China, in the meanwhile, even as there are refining maintenance is happening, but China is continuing to stockpile crude oil prices as and when they go around that $60 a barrel mark, building reserves. So markets do believe that going forward, China perhaps may need so much crude oil because they are stockpiling right now. Apart from that, the Ukraine president signaling move towards a peace talk. We know the details about that. We've been talking about that. That's yet another reason that the markets feel that the Russian supplies may not get disrupted, and some of those sanctions perhaps will go away as well. But for today, it is about sanctions on Russia's Lukoil and Rosneft, and markets believe that that could leave nearly 48 million barrels stranded on sea. That's a lot of crude lying around there, and that also isn't a reason that you would buy around in sense of crude prices right now. And then let's talk about India, where we're looking at import bill declining by 13% between April and October at around 71.2 billion. Well, the data suggests that the imports have not declined, but it is the crude oil prices which are down by nearly 15% from where they were in the previous year, and that really seems to have made the difference. The import reliance, also as per the latest ministry data, shows that India's import reliance stands at 80.2%. Interestingly, also when you look at the India's domestic oil production, well, there has been a decline between the same period to the tune of 1.2%. Interestingly, there's plenty happening in the international markets when it comes to India as well. Latest with Reliance saying that they will comply with the European Union in sense of import of products derived from Russian oil. So that really seems to be making a change there. And then apart from that, there also have been various statements from Minister Puri suggesting that India's PSU oil companies will sign a one-year term deal to import nearly 2.2 million barrels of LNG from US. At this point in time, with the kind of deal that has been done and the import India is doing, that accounts to nearly 10%. And then India's crude oil imports from US also seems to be rising. For the month of October, we've seen a neat 540,000 barrels per day come in because of that as well. Take a look at the price moves then. And for the crude prices in this year, we started this year with $75. We saw a high of 82, and then we've been languishing near the low of this year currently as well. If you look at the crude oil prices, the last 3 years have been in the negative. 2023 was a 10% decline. Last year was 3% down. And this year we are down by 18%. Not just that we are down for the third straight year, but we are the lowest in 3 years that crude oil prices have seen in sense of averages there. Next year as well, it's expected that you could be looking at surplus going forward, and that comes in anywhere between 1.5 to 4 million barrels per day, often expectations coming in from OPEC, IEA, World Bank, etc. The price moves in the next year, well, that really seems to be divided, but most people seem to be believing that it is going to be anywhere between $50 to $68 a barrel. That is where overall gets summed up. The lowest coming in from the IEA, Goldman Sachs, which are talking about mid-50s, but you also have Morgan Stanley, Citi talking about early 60s, and then mid-60s yet again coming in from Bank of America and World Bank. So the range that we've seen this year perhaps could be a range next year as well, but pretty much on the lower side.
Okay, all right, Manisha. Thank you very much for that. That is as far as the oil markets are concerned. By the way, before we hand it over to Lata, news is just coming in from Japan, and it's big news. That stimulus package that markets have been awaiting in Japan has finally been announced. And guess what's the value? Hold your breath, $135 billion. And this includes subsidies on electricity bills, a lot of additional new grants, and so on and so forth. So this is pretty big. You know, measures for the shipbuilding industry. Lots happening over there. This was widely anticipated with the new leadership coming through. So we'll watch out for whether it has any bearing on the market or not. Right now, the Japanese market is still down about 2% Let's take a break on that note, come back on the other side, and we'll have our special segment, It's the Economy. Lata speaks with Nomura economist Aurodeep Nandi on volatile global markets and the impact on rupee and growth.
Welcome to It's the Economy. Despite the fall we have seen in equity markets, the rupee today is higher, stronger, with reports that global treasuries are going short on the dollar and long on the rupee, that is, short on dollar rupee, hoping that a trade deal with the US is close. Separately, more brokerages like Goldman Sachs and HSBC have turned overweight on Indian equities, which is probably getting reflected in FPI inflows. Remember, they have been positive over the last 2 days. Finally, the GDP number that will come on November 28 for the July-September quarter is expected to be well over 7.5%, while the full-year GDP itself is getting revised by some economists to over 7%. To discuss the rupee and all things macro, I have with me Aurodeep Nandi, the India economist from Nomura. Good morning, Aurodeep. Thank you very much for joining us. I will have to start with the rupee because that seems to be the buzz now. There are people, yesterday the governor speaking at the VKRV Rao lecture said that, our current account deficit problems should be much lower once we have a good trade deal. What's the, sense at the Nomura desk? Are people turning short on dollar rupee?
Well, I think, look, there's a lot of uncertainty on the trade deal side. And, people keep thinking that, based on these rumors or these talks, a trade deal is going to come and then it gets delayed. I think the latest that seems to be coming from news reports is that the negotiations are over. There isn't anything fresh to discuss at this point. The ball is in the US court. President Trump had said some time back that they are looking to come up with a deal soon. So again, I think, there have been so many false starts on this that it's more of sort of cautious optimism than anything. Okay. The big question actually that matters, Lata, is what is the tariff rate that will come after the deal is finalized, right? So if it comes down to, say, 15 or 20%, then that's a big thing for India, right? Because that puts us in par with the rest of Asia. Yes. And so the competitive disadvantage that we have currently will get resolved. Yes. On the other hand, if it's still higher, so exporters would still need to, give some amount of discount to make themselves competitive. So I think there's just a lot of uncertainty still there. And,
now, what kind of a range are you all drawing up for the currency, therefore? If there is a trade deal, does it go to 87 or even more? If it gets postponed, say, beyond December 31, the market may worry. So then what happens? Is there any range you all are working with?
I mean, our house view is that a deal will eventually happen. Our sort of numbers which we are looking at is the end of the year, we are looking at around 88. And then we expect, we have a slightly strengthening bias. So Q1 2026 at around 87.6, and then end of 2026 at 86.5.
Oh, 86.5. That's strong.
That's the end of.
Yeah, I get it. 12 months from now or something, or maybe even more. I take your point on that. But okay, let me come back to the macros then. The October deficit numbers were a little difficult to swallow. Has that increased your current account deficit forecast? And if yes, then it doesn't square with your strengthening rupee bias.
I mean, of course, it was a surprise, right? So a country that runs around, $20-25 billion, at max $30 billion, recording a 41-point-something billion dollars of trade deficit is pretty elevated. And I think a couple of things are happening, right? Because on the one side, exports are getting hit because the tariff impact is coming through. On the other side, the import side is kind of sticky. There is gold imports that has been pretty high, and even broader import basket seems to be holding up. So you have the export minus import trade deficit elevated. Now, to your question of whether we've increased our current account deficit number, we have. So, but not by much. We had 1.1% of GDP. We raised that by 0.1% of GDP. So FY26, we have 1.2% of GDP. So certainly not something that sort of evolves into a big external risk going forward. Also remember that the last quarter of the fiscal year typically sees seasonally that the trade deficit improves.
Yes.
So you also need to factor that into account.
No, fair point. We have reported trade surpluses in past quarters in Jan, Feb, March. And of course, now we hear of some brokerages turning positive on Indian equities as well. Okay, Aurodeep, let me come to the big number that will come on November 28. What's your own expectation of the quarter gone by in terms of GDP and the full year GDP numbers?
So we have 7.6% versus 7.8% previously. If I'm not mistaken, I think we are at the higher end of the market at this point. Just two health warnings, Lata. I think when someone interprets this data, one is that the 7.8% that was there in the first quarter of this fiscal year was distorted because of lower deflators, right?
Yes.
So real GDP is nominal divided by deflator, because prices are so, inflation is so low that it sort of brought up the GDP number. I mean, you may recollect that before that number, economists were saying 6.7%,
Yes.
right? And it came out 7.8%. So we are now going from that base. So the base is a bit elevated. The second aspect is that the deflator problem is likely to be even more this time, because both consumer and wholesale price inflation has gone further down. Right, so be prepared for these, trends, some trends in the data which won't be, which will be difficult to sort of explain.
Yeah, but y'all are expecting a stronger rupee by the end of over the next 12, 13 months. As well, I think I don't know whether I read it in the Nomura report or in other reports, there is a severe Asian disinflation likely to continue because of overcapacity in China, etc. So next year also could be a 7% GDP. How are you looking at FY27 growth for India?
So FY26, we have 7%. For FY27, we have around 6.6% or so. So, it should moderate from this year, but you're right, there are some positives which are there. One is the trade deal. The other one is, let's remember, there's been a huge amount of policy easing that's happened this year that reverses the policy easing which was happening the year before, right? So be it on rates, be it on fiscal policy, be it on macroprudential measures, and then that takes some lag to sort of course through the
reflect in the economy.
Reflect in the economy. And also our expectation is that the global economic scenario remains somewhat positive. So if US, EU sort of does okay, then plus a trade deal would mean that it should be better for India. So it's sort of a mix of these factors.
Okay, so Indian growth likely to be positive in FY27 as well is your base case, right? What's the expectation from the Reserve Bank, therefore? The Reserve Bank does look at forward inflation and not just at the 0.25% that happened in October.
I mean, this is going to be a really tough call, right? So, okay, our baseline is that there's going to be 50 basis points more of cuts. So our terminal rate is 5%. Now, the question, Lata, in all of this is when, right? And December is going to be a really tough call, right? Because on the one side, the RBI has said that we have policy space to ease. And that has been interpreted by a lot in the market, saying that, okay, so when a central bank comes and says there's policy space to ease, that is a signal that easing is going to come. But on the flip side, there's also been communication on the fact that, look, is there need for easing? And generally that, because if you look at the data currently, it shows a mix. It's a very confusing period for India, because you've got the Trump tariff effect, you've got the GST cut effect. So all of this is sort of creating a way in which economists are finding it struggling to sort of figure out, well, what is the true state of the economy? And so for the RBI could also argue, well, growth is fine at this point. And let's look at the forecast which RBI has. RBI's forecast for GDP for this Q2 of the fiscal year is, if I'm not mistaken, 7%.
7%, yeah.
So, if we are right and it comes out 7.6%, so the GDP forecast is going to be
revised higher.
And their inflation forecast for FY26 is pretty high, 2.6%. I mean, our number is 1.9%. So there's also going to be an undershoot on inflation. So a combination of an undershoot on inflation and, overshoot on growth ideally should not mean that you should
have to cut rates.
Yeah, so it's sort of a weird kind of thing. And just one last point, which is that a lot of people say, okay, because inflation has been so low, the RBI should cut. In theory, yes. But then inflation was also low in the October policy meeting. Yes. So if that was the reasoning, then the cut should have happened there. So our baseline case is still a December cut, but it's going to be a really close call.
Yeah, there is an old RBI feeling that India's real inflation is 4%. I mean, the flexible inflation targeting has brought it down. And therefore, it's 4. And therefore, 5.5 is not a bad number itself. The 2 cuts, I don't think, is in their horoscope, is not in their DNA. But you never know. There is a new man at the top, and there is a new set of data coming in. Thank you very much, Hardeep Nandi. I understand that we are in difficult times for the Reserve Bank, and we have to wait and see. But at the moment, the bond market itself is not very excited, even if there is a cut, because they look at it as possibly the last cut. Thank you very much. We will touch base yet again after the Reserve Bank announces its policy, and of course, after the big macro data comes on November 28. We wrap up on Bazaar on the note that the rupee is strong, irrespective of the fact that equities have not done too well. Let's see how things pan out from here on. After the break, it's time for Chartbusters.
Well, Hindalco is the top loser on the Nifty after another fire at its unit in New York. The company had earlier planned to restart operations at the unit by December, following fires in September as well as in October.
M&M is the top Nifty gainer, up over 1% as multiple brokerages issue bullish calls on the stock after company sets out ambitious growth targets in yesterday's investor meet.
AWL Agri slips nearly around 4% after a block deal sees Adani Commodities sell 7% stake to institutional investors. Max Financial is also trading slightly under pressure after 0.5% equity changes hands via block deals.
Grow's roller coaster ride continues. The stock was up 6% ahead of its second quarter numbers. And if you look at the numbers, revenue, profits and EBITDA have risen sequentially. The stock holding with gains of about 5%. Those numbers right at the bottom of your screen, 25% growth in the profitability and revenues up 13% quarter on quarter as well. Hello and welcome. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Nigel D'Souza. A day where we've sold off a little from the highs, but nothing really to worry about given the sort of heady run that we've seen in the past and the weakness that we saw on Wall Street. We were very close to a record high, and it's understandable that there is some nervousness at the heights, but no real worry because the market's still firmly in buy on dips mode till such time it holds important levels.
Well, that's right, Mangalam. And in fact, we'll say that we're under pressure. We're down 100 points or 0.5%. But you look at the rest of Asia and you'll say, boy, we're doing pretty okay, right? Because the Asian markets actually are under further pressure. Markets out there down between 1 to around 2.5% the last time I checked. So yes, we're down, but not out and not as bad as what the other Asian markets are doing. By the way, you have Grow, that's whose numbers are come out there. And I think the margins have improved considerably, which is good. The absolute EBITDA number as well has seen a good growth, I think. So net profit up 25%. Margins expand a little bit. I missed the top line growth number, but that as well should come up.
Top line is an 11% growth quarter on quarter and year on 13% growth quarter on quarter. And year on year there has been a mild decline, but that may well be on account of, some factors that we will get to in the details, I guess. But right now, the EBITDA growth and the profitability is something that the street would be looking at.
Well, indeed. And the stock had corrected close to around 15 to 20% from the recent peak. For the time being, holding with a mild gain of around 5%. Valuation still very, very expensive. Float is very limited as well. So keep an eye out on that one. Let's welcome Manas Jaiswal from manasjaiswal.com, who joins us for a technical check. Manas, what do? Market's down 130 points. It has been a buy on dips market. Do you buy today?
Good morning, Nigel. So definitely, because see, yesterday we have seen a breakout and today we have seen some correction. But again, if you're talking about the trend, I believe that till Nifty is trading above 20-day 10-day moving average, I think the trend will remain positive. So this correction is a great buying opportunity. If you can keep the stop loss below 25,950, then definitely on this correction, you can create long position, because I believe that Nifty can at least test its all-time high of 26,277. So for almost 200 points up move, you can take a long call. Keep your stop loss below 25,950, which is almost 100 points from current levels.
Right. And individual stocks, what are you backing right now?
So good morning, Mangalam. So first one is a buy call on Eicher Motors, where we have seen a flag pattern breakout yesterday. So in Eicher Motors, one can create long position, keep your stop loss below 7,100. Here the target would be around 7,400 in next 2 to 3 trading sessions in Eicher Motors. Second is a buy call on GMR Airports, where we have seen a breakout just a few days back. Today, stock has given a flag pattern breakout. Take a long position here. Stop loss should be around 103, and the new target comes near 110.
All right, we take that point, Manas. Thank you so much for that. Have a good Friday. GMR Airports and Eicher Motors are a couple of stocks that he likes, but just keep an eye out on a couple of these other names as well. Hero MotoCorp hit a fresh record high in yesterday's trading session, continues to do well. We're very interested to see how the IT pack behaves in the second half of trade as well. We've seen some recovery from the lows. Names like TCS, etc. pop up for you on the screen. There's been a mild smidge of a recovery from the lows. Let's get you some ideas for profit from our colleagues at Money Control Pro. Today we have Madhu Chanda Day joining in.
Hi, we are talking about late revenues technology, or Ixigo, that had exhibited impressive growth and innovation in the past few years. While Q2 turned out to be a soft quarter for the industry in general, the GTV growth of Ixigo turned out to be much faster than its large competitor. Sector-specific issues in airline as well as in the train business impacted the performance. Ixigo drives a lot of growth through client stickiness, especially beyond the metro cities, thanks to its value-added offerings. The cost of the growth investment, along with the disruption in the train business, turned out to be a drag for the margin. In addition, one-time ESOP expense took sheen of the numbers. To harness the full potential of technology in the booming travel business, the company has embarked upon a large dose of capital infusion from marquee tech investor. This money would be used for investment in AI, ramping up of the hotel business, inorganic expansion, as well as working capital. Travel is increasingly becoming mandatory rather than an discretionary expense for Indian household. With Indian household per capita income steadily on the rise, the sector is in for explosive growth. And Ixigo has the right playbook to participate, bolstered by the capital.
Well, thanks a lot for that, Madhu. For the time being, stepping on a short break. On the other side, we'll be joined by the management of CCL Products. We'll discuss the past quarter's numbers and their outlook for the year as well.
Welcome back. You're watching us here on Chartbusters. We're speaking about TCS. Just take a look at Infosys as well. That's moved higher. From the lows, we've seen some traction in a couple of these FMCG names as well. Both Britannia and Asian Paints up in the green right now. But a stock in the red among the top losers on the Nifty is Hindalco. Nigel, another fire at their Novelis plant.
Well, that's right. The Oswego plant, another fire has been reported. And, remember, there was a massive fire that was reported in September. Then there was another smaller one in October. So this is the third fire in a matter of around 2 months. To give you a few details with regard to what the management had to say on the Oswego plant, the management commentary in October itself said that they're planning to restart operations at the affected plant by end of December. So that we'll have to see whether or not there's any kind of shift with regard to that deadline. They also said that the cash flow hit could be to the tune of around $550 million, while the EBITDA loss could be to the tune of around $150 million, this in the second half of this fiscal. However, it would only be near-term pain because they have insurance out here, and FY27, they're expecting to recover more of this. So there is some uncertainty with regard to the damage. Some source-based information indicates to me that it's not as bad as what it was feared. The fire was doused in 2 hours in comparison to around 4 to around 5 hours, which is good to hear. And I believe that there are no casualties as well. Just hope that that data point as well is correct. So for the time being, stock under pressure because there's a bit of a risk off that's playing out. And also you had this fire that is denting, sentiment out there.
Take that point, Nigel. Thanks a lot for explaining that to us. Not as bad as the ones that we saw earlier, but a fire nevertheless. But we were talking about Grow's results that were reported just as we were starting the show here at Chartbusters. The stock's holding with gains but has come off a smidge from the highs. At peak, it was close to around 6% higher. Now it's around 4.5%. For more details on the numbers, the internals, all the stuff that we have, we do have Vivek joining in with the numbers. Vivek.
Well, that's right. When you're talking about India's largest discount broker, Grow, on a year-on-year basis, the numbers are quite subdued. So when you're looking at the numbers on a year-on-year basis, revenue is down by almost 9.5%. EBITDA is up almost 9.7%, but that is mainly on the back of the fact that OPEX, other income, OPEX has actually come down significantly. Other income has moved higher. And also when you're talking about the cost to income, that too has gone down quite significantly. So that has actually aided the operational performance of the company. But on the top line, you've actually seen a bit of a degrowth. But on a sequential basis, when you're looking at these numbers, sequentially 12.7% growth is what the revenues have seen. When you're talking about the EBITDA, when you're on a year-on-year basis, almost 9.7%, EBITDA margin at 59.3% versus just around 48.9%, aided by the factors that we just mentioned above. Margins on a sequential basis have improved quite significantly. So 59.3% versus 53.4%. And our colleague Devyani says that, when you're keeping aside the other income, the interest component, there has actually been an EBITDA expansion of almost 658 basis points that has led to a 25% jump in profitability on a sequential basis. So that is the good part as far as the numbers of Grow are concerned. Year-on-year, subdued, but on a sequential basis, there has been growth across all parameters and significant margin improvement as well.
All right. Thanks a lot for that, Vivek, for joining and giving us a crisp analysis. Well, time to slip in a short break. As we do that, a quick reminder for all our viewers. HSBC presents Future Female Forward Season 3, co-presented by Cognizant. From New Delhi, we bring you the newest state chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on the 25th of November, Tuesday, 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 News.
Welcome back. As promised, let's get to the management of CCL Products. Chala Srishant, who's the managing director, joins in now. Remember, the company had reported a strong performance in the second quarter. Large part of that was also led by increased prices, increased capacity, and volume growth for the company coming in from their new plant in Vietnam. We do have the management with us, a 50% revenue growth, a 36% profit growth. Chala, the question is the near-term outlook on coffee prices. Yes, it does not affect your margins. Yes, it does not affect your volumes. But what it basically does is, could have an incremental impact on, say, client behavior or your own branded sales, etc. So what's your near-term outlook on that? After this massive rally that we saw in coffee prices, there were some signs of stability and reduction from the highs as well. From where you are, what do you look at when you're expecting coffee prices? How do you expect them to move over the next couple of quarters?
So right now, coffee prices are also at a high because of because of the tariff uncertainty that is there in the US and a little bit about the climatic change and all that. But if you look at the long-term picture, Brazil is actually increasing its production of coffee quite a bit. Vietnam throughput is also expected to be quite good. So all these factors, we're expecting a correction to come in the next couple of months. And that's also one of the reasons why we are advising our customers to take more short-term contracts in the intermediate time and focus on more long-term a little later on.
All right. Hi, Chala. Good morning. Good to see you in Nigel on this side. A quick question on the near term. Mangalam will get back to the demand dynamics. But in the first half of the year, you have grown by 35%. But as it's stated, you're talking about growing the EBITDA by around 15 to 20%. So would you like to upsize that, in terms of a realistic EBITDA guidance for the year? Point number one. And the EBITDA per kg as well is at around 135 rupees. 130, 135 rupees. Historically, you have done around 110 rupees. Is this a new normal?
So right now with this, the guidance, yes, we're looking at more closer to around 20% plus or minus a few percentage points. Now, last year, if you look at it, we had a plant shutdown in Q2. That is why the growth appears to be significantly higher. There will be another plant shutdown that we are planning the next, as in Q3 and Q4 combined. So we are sticking to our guidance of about 20% EBITDA growth.
20%.
Got that.
Yeah.
And
the
EBITDA per
kg, yeah, it is. There is an improvement in EBITDA per kg because of the product mix with the freeze-dried unit coming online. So and more of small packs. So all these factors are helping us slowly inch the EBITDA per kg forward.
All right. So, on that itself, if you could give us a couple of bookkeeping answers. Of your total capacity of roughly 77,000, how much of that is freeze-dried? How much of that is spray-dried? How much of that is in India? How much of that is in Vietnam? And what's the difference between EBITDA per kg when it comes to freeze-dried and spray-dried?
So you're asking for too much details.
That's our job.
But I can give more on a blended basis. So now Vietnam and India both have spray and freeze. We wanted to have that flexibility for our customers, especially when things like tariffs and other issues come up. We should have the flexibility to shift origins. We have about a 6,000-ton freeze-dried capacity in Vietnam, and we have another about 11,000-ton capacity in India. And the rest is all spray-dried capacity, about 30,000 tons in Vietnam and the balance in India.
Got that. And what's the differential in EBITDA per kg between FD and SD?
So it'll vary actually. It's not only SD and FD, it's a little bit more complicated because of the small packs that are there as well. So it gives you a little bit of a skewed nature. But in general, about 15% more is what you can expect from FD compared to SD. That's also one of the reasons why the capital investment is significantly higher for FD compared to SD.
Got it. All right. Give us a few more numbers then. Branded business, I think in the first half of the year has done around 200 crores. Yes. That's of the total 300 crores of domestic business. For this year, what do you end up with? And for FY27, what are you looking like?
So we're looking at around 230 to 250 crores is the range that we're looking at for the branded business, and overall domestic business about 650 is what we are targeting for this year.
650 or domestic, and out of that, how much will be branded?
So branded will be about 430 to 450 is what we're looking at.
All right, 430 to 450.
And for the next year, because this is the one that, the street is very concerned about. So the next year, what will it look like? What is the aspiration?
We are aspiring for 1,000 crore brand 1,000 crore domestic business by next year. So it's a steep jump, but yeah, let's see how things pan out.
And what does your market share right now stand at in the areas where you serve already?
So
because overall versus where you serve are two different matrices.
Correct. So that's actually a very good point. Overall, in India, we are today the number 3 brand, but in the regions where we are actually present in, we've actually taken the number 2 position. So especially in the south. So that is a positive for us.
Okay. Right. And what about the debt number, 1,200 crores? What do you end this year at?
So we're looking at around net debt about 1,300 is what we were looking at. It was 2,000. So from that 2,000, we are looking at 1,200 to 1,300 of net debt for this year.
So it'll stabilize at these levels then. Thanks a lot, Chala. Good to chat up with you. Always good to have a coffee in the morning. And we appreciate you joining in to give us a sense in terms of business. Well, on that note, though, we'll wrap up on this edition of Chartbusters. Stay with us. The market's a little under pressure, but trading our team, they're going to be joining in soon.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Fatakia. Hey Hormuz, good morning. Before I talk about the markets, it's finally Friday. It's been a long week with a lot of updates that we've been talking about, but looks like even the Nifty is tired. It's a 100-point downtick on the Nifty as we speak after touching that 52-week high level yesterday. It was a day in the green yesterday. Most of those gains have been pared down today. 100 points down on the Nifty. We have recovered from the lows of the day, but still deep in the red. The mid-caps also down around 0.8%. This index is underperforming the benchmark. And what is leading to these losses in the Nifty? The Nifty Metal Index, which is down 1.5%. We have the PSU Banking Index, which continues to be under pressure. That index is down 1.2%. Financials not doing so well as well. Some sectors in the green, though. The Auto Index, we'll discuss a lot about it in greater detail. We have the consumption names, which are a wee bit in the green, supporting the Nifty from the lows as well. However, mid-caps continue to be on our radar. The advanced decline ratio is in favor of declines by a big margin, and the small cap index too under a lot of pressure. So let's go across to Hormuz. He's here with us and putting spotlight on the top movers in the market. Hormuz, what do you have on your radar?
Well, Friday there is fatigue across the board, but there are some stocks that are showing no signs of fatigue, and the potential beneficiaries of an impending India-US trade deal continue to be in the spotlight. We spoke about Avanti Feeds earlier in the week. Today is the turn of Apex Frozen Foods, and that stock has now snapped a two-day losing streak today, 13% higher on this stock. And we've had volumes worth close to 14 lakh shares that have already been traded on the stock. The 20-day average here is less than 2 lakhs, so almost well over 7 to 8x of its 20-day average. This is turning out to be the third straight month of gains for the stock, and considering this third 3-month rally, the stock has turned positive on a year-to-date basis and is now up 10% for the year. The other one on our radar is Magnalic Cloud, and we don't talk about this stock quite often. 9% higher today and is now seeing a rebound after the stock fell to a 20% lower circuit yesterday. We've had almost 80 lakh shares that have been traded. The 20-day average is 9.5 lakh shares, so 9x its 20-day average. As a result of that 20% fall yesterday, the stock fell below all of its key moving averages yesterday, and it continues to remain so. And the stock has been down for 4 months in a row now, despite this rebound that we are seeing today. And on a year-to-date basis, the stock's down around 25%, was down another 20 in 2024 as well. The stock that's making a move today is M&M Financial, and that stock is seeing some choppy moves today. At one point, a few minutes ago, the stock was up around 1.5%, and it's now gained in 4 out of the 5 days this week. But despite this choppy move today, the stock has gained over 12% this week, and it's turning out to be the best week that the stock has had since February of 2021. And today's session had 40 lakh shares traded already. The 20-day average is 10 lakh shares, and on a year-to-date basis too, the stock is up close to 40%. It's turning out to be the best year that the stock has had since 2022.
All right, some interesting names there. Thank you so much, Hormuz, for joining us with that list. Those are some buzzers on our radar today. But let's move forward and talk a lot more about markets as well. Rohit Srivastava, who is the founder of India Charts and Strike Money, is joining us now to discuss the technicals, the top sectoral bets, and a lot more. Rohit, good morning. Thank you so much for joining in. What's happening with the Indian markets? We are not following what's happening globally. But do you think there is a support that the traders should be watching out for? What are the next important levels on the Nifty that you're targeting?
So we've seen our market diverge, I think, from the rest of the world for quite some time. And interestingly so, unlike last year, we are diverging on the way up and not on the way down. Both in October, when the US was seeing a correction, we didn't fall too much. And I think we are seeing the same thing now. Last week, we were a bit off. Again, we've taken off to a new high in the last 2-3 days. Today, I think we are taking support close to 26,000, 26,050. Those are intraday support levels. If those continue to hold, I think we should continue to march forward in the coming week. First to, of course, get past the all-time high, which is 26,270. But eventually, I think we are headed towards 26,800 in the coming weeks. And that is where I think we'll be headed. So all-time high is not very far. I think they are coming. We just need to hold this support intraday for the day. We will also be closing positive for the week, if you notice. So even though there is some intraday weakness, the weekly charts are also going to continue to look good.
Rohit, morning. Thank you for joining in. You're saying all-time highs continue in the next few weeks, but the big contributor to this move that the Nifty has had from levels of around 24,500 to where we currently stand has been the Nifty Bank. And there was conversations about the index going towards 60,000. It's very close to that now. What next for the Nifty Bank? The longer period charts, does the index take a bit of a pause once it gets to 60,000, or do you see those levels still being some time away?
I think 64,000 is what we still have on our charts. So that doesn't change. This is just, I guess, some near-term pullback because it's been a performer. It's also hit all-time highs ahead of the Nifty. So it calls for some correction pullback. Will it be significant is a little early to say. I think the key support, the initial support is going to be at around 58,600. So if that doesn't break, we're all good. If that does, then it's possible near term you do see a further setback in banking relative to the market. But something to keep in mind is that our market's always been about rotation. We've seen different segments of the market do well, others pull back, then others do well. And I don't think that is going to change anytime soon. So we shouldn't be too worried that, banking that has led the way so far pulls back. Something else that has already pulled back can lead the way again. And there are many, many leaders that we have, in the market.
Which are the other sectors you think could lead the markets from here on, Rohit? Is it purely based on technical terms, or do you think the fundamentals are leading to that up move that you'll see going forward?
So it's a mix of both. On the technicals, I think interest rate sensitive sectors are anyway looking good, which is your autos and metals. So the metal sector, for example, has already pulled back in the last week or two. And we are back to close to the 40-50 week averages, which are good supports for another leg up to start. This would also end up getting supported not just by the rate cycle, it would also be supported by probably weaker dollar. It has been heading up for a while. But I sense that as the US rate cuts get closer and closer, the US dollar will start ticking on the other way, and the commodity cycle picks up again. We've already seen prices of aluminium, zinc, and even steel more recently starting to pick up. So those are good signs that the underlying current in the commodity prices is there with us, and that is why I think metal stock should do well. Autos, of course, there have been multiple triggers from tax cuts, GST cuts, and the rate cycle. All of that comes together. And I think it's few of the indices which is positive today. So it is holding out. The others, I think, would pick up as well as time goes.
What about IT, Rohit? It's been the yo-yo or the ping-pong ball in all of these global developments. Anti-AI trade, pro-AI trade. With the US not doing well, India does well, and vice versa. Would you stay away from a sector like this, or do you believe that the correction has been good enough to give you an attractive entry point?
So there are two parts to IT. One is the trade and one is the investment. So as a trade, I think it got oversold. It's already reversed, and we are putting out some trades on some of the IT stocks. But the upside may be limited to that 5-10%. The IT index goes up to a 40,000, and then how much more? The problem really is that when you take a 1 year, 2 year outlook, then you're going to have a very, very different view of things. Which stocks would you really want to be in? And my answer is I'd rather buy growth stocks that are growing earnings at 40-50% and are available at a PE ratio of 25 to 40 than end up with an IT sector which is growing earnings at 5-6% and is behaving more like a defensive sector. So you're not going to get those multi-bagger big return outcomes from IT. Usually funds own it because they need to diversify. But if you're an individual investor who's more concentrated, then you would be avoiding defensive sectors like IT, FMCG.
Okay. So you are saying that defensive like FMCG and pharmaceuticals also should be avoided at this point in time?
That's right. Those are places where you may see returns, but not more than what the market has to offer. That is going to come from either the interest rate sensitives in the large cap, the commodity cycle, maybe oil stocks, or it will shift towards a lot of mid and small caps where because of the ongoing growth, valuations have actually cooled off, and search for those pockets, and that's where you'll get the big returns.
You mentioned metals will do well, Rohit, but is there any other sector that you are expecting to do well beyond the metal space?
I think IT, metals, banking, and autos, those on the rate sensitive side. But if you move outside of that, I think the energy and defense spaces still continue to attract attention. Some of these stocks are very close to support levels, have picked up momentum. And I think those are, you see, the thing with the bull market is that the winning sectors don't go out of favor. They just continue to remain in favor. So a lot of people try to call out, that they'll go out of favor. But I think, energy and defense are going to remain in favor.
Okay, all right, Rohit, thank you so much for joining us. Always a pleasure speaking with you. So that's the outlook on the markets from a technical viewpoint and how individual sectors could perform as well. We'll slip into a short break for now. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
Welcome back. As promised, shifting focus to the crypto space now. Manisha Gupta is here with the latest. Manisha.
Well, thank you for that. When you look at the overall markets, well, we have seen the sell-off just about continue when it comes to crypto. We saw Bitcoin trade at an all-time high of $126,000 in this year. Since then, we've not just broken 100,000, but we've broken 85,000 on the lower side as well. So very sharp declines continuing on to that one there. If you look at the overall market cap, that just holds about at $3 trillion right now. It's declined from 4.3 of a high in this year. The trading volumes also have seen a decline to almost 197 billion on a daily basis here. So 1. 1.2 trillion is clearly wiped off from the crypto value in the last matter of 6 weeks itself. Overall markets, when you look at that, as you can see, the month-on-month declines have been quite sharp, and that has led to YTD declines also in sense of going strong there. Bitcoin, for one, has seen a decline by nearly 20% over the month, down by 8% in this year now. Ethereum, Solana, Avalanche, all down between 26 to 28%, and that brings the yearly movement or performance in many of these cryptos to the negative as well. So a 16% decline in Ethereum, but as you can see, 29% down in Solana, and 60% of a decline is what we are dealing with in sense of Avalanche. The big questions that the financial markets are now asking is on whether or not this sell-off in crypto will impact the other financial markets. Well, to take that point, stablecoin, for one, is a very big market. It's dominated by Tether, which has around $181 billion in reserve, and 112 billion of that is held in US Treasuries. The other one to look at also is the rival Circle. That as well holds nearly $24 billion in sense of US in case of stable coins there. The US Treasuries and in US Treasuries as well. When it comes to the US public listings, well, we saw almost 173 of them in 2025 till time. And from that, only 3 have been crypto companies that got listed. And when you look at the kind of funds that have been generated, of overall fund generated, the crypto companies got up nearly 3.3% of total funds. So the fear on whether this sell-off will spill over to other asset classes clearly seems slightly unfounded at this point in time. The other important number to watch out for is the European Central Bank in sense of holdings when it comes to crypto and institutions providing crypto custody as well. So that has seen an increase, of course. In 23, it was just about 400 million, which has increased to 4.7 billion in 2024, with an expectation that the 2025 numbers could be even higher on the side there. ETF holdings, well, that clearly has been a success story, what we've seen since Jan 2024. Out of 104 ETPs that were allowed, 367 is where we stand at this point in time. But in the last 4 or 5 weeks, we've seen huge redemptions come in for this one as well. So it's not just about retail or just about ETFs, but institutional holdings, corporate holdings. We have seen redemptions in crypto come across.
Manisha, thank you for that update. The sell-off continues within the crypto markets. Take a short break. When we return, we discuss the e-commerce trends with JM Financial Institutional Securities. This is Sachin Dixit on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's discuss the internet research space, the quick commerces of the world, and also Eternal, Swiggy, and other stocks in the sector. Sachin Dixit, who is the lead internet research analyst at JM Financial Securities, is joining us now to discuss some of these names. Sachin, good morning. Thank you so much for joining in. First up, tell us, what did you make of the quarterly results for this particular space between Eternal and Swiggy? What's your top bet and why?
Sure. So overall, I think in this space, what we are seeing consistently happen is that there is a sort of gulf appearing between how Eternal has performed and how Swiggy has performed. Interestingly, both of them do well when the competitive environment looks a bit more benign. Interestingly, we have not seen that happen. There has been a lot more news flow coming in from different sectors, from different companies trying to make a foray into quick commerce, which has resulted in probably both the stocks being slightly weaker in the recent 1 month or so. Overall, with basically news flow going in terms of how the competition is likely to be, that's something which will keep on impacting, I think, both of them. Eternal has been slightly more clear in that sense. They have not seen so much of an impact happen, largely coming from the fact of the balance sheet that they have and the track record that they have already delivered. Swiggy is coming from a place which is slightly behind. I think there is a catch-up that needs to happen.
Sachin, thank you for joining in. You mentioned catch-up, but the question being, has Swiggy hopped on to this bus a little too late? Because Eternal, for its quick commerce expansion, has been really aggressive over the last, say, 2 to 3 quarters. But Swiggy has been slow in trying to add more dark stores for Instamart and has now just approved yet another fundraise. So does that push them further behind in this quick commerce race?
It's tough to say, right? Logically, if you think of it, it's a very large market. Ideally, there should be more than, let's say, 2-3 players who should be making value out of this market. Eternal obviously has been more aggressive thanks to the capital that they have at their disposal. Swiggy, coming from a bit of a sort of, as you highlighted, they might be slightly late in terms of how they are catching up with the market trend. Which is also a function of the capital they have, and which is also the reason likely why they have gone ahead and taken that approval to raise more funds. It remains still to be questioned, like whether if they get the money, and if they get the money soon enough, whether they will go ahead and spend all that with as much aggression or not. Because logically thinking, it's a large market, there could be regional winners, right? If you look at broader traditional retail in India, there are region-wise winners, right? There are people who are quite popular in the West, there are people who do quite well in the East. So I don't think necessarily you need one single player to win across the country. So that's where the positioning stands. Obviously, we have seen so far that Eternal is one player which is trying to do a good nationwide play, thanks to what they have already proven in the past and how their unit economics are shaping up even in the recent few quarters. We obviously see that they are positioned quite well for that, but I believe there could still be people who might not necessarily win nation, but they might be a decent sort of play in their own defined regions and how so we go about it.
Okay, so that's about these food delivery platforms. What about some of these travel tech platforms? We did see some of them reporting good numbers, but that didn't happen with something like a Yatra. We did see Ixigo doing well. It's been quite volatile, right? Some of these stocks have done really well. What do you make of this entire space?
Sure. So I think what need to be understood about the space is that this is a space which does get benefited or impacted due to some seasonality coming into the picture, right? So if you look at Q2 results, right, a lot of these companies did see some impact coming from the limited supply, whether it's happening from the limited supply of airplanes coming into the country. A lot of our airlines are still struggling to get the right planes that they wanted and within time. And then there is the impact of extra rains. There was a lot of landslides that happened in the hills this quarter. right? So all those things do play out in the travel tech space. But if you talk about the couple of names that you mentioned, what is interestingly happening is that Ixigo coming from a more of a tier 2 sort of a background, which is where a lot of growth is coming from. There are a lot of upgrades, there's more travel that is happening in those geographies, is certainly driving more growth. Yatra also reported decent results, so which is why the stock has also reacted quite well. But I think you will keep on seeing in travel tech that there will be some seasonality which will happen, but there might still be consistent winners. Whether you look at MakeMyTrip, for example, right, which is a market leader, while they might not be growing at the same rate which an Ixigo might be growing, but if you look at the scale at which they operate, their growth is still commendable.
You know, Sachin, I just want to complete this loop on the quick commerce and the food delivery companies. The biggest talking point has been the fact that they have been making losses. At least Swiggy had significant losses this quarter as well. Eternal is profitable, yes, but even on an EBITDA basis, but the net basis too. So because also there is a treasury income contribution to that. How long does the market wait for a company like Swiggy, let's just stick to that for that matter, for it to turn profitable? Because they have said that they will turn profitable sometime during FY 27-28. But would the market want to project that and reward it accordingly? Because the stock hasn't done much. It's back below its IPO price. So how long do you wait for companies to turn profitable and then value it accordingly?
I think interesting question. Honestly, since the last 4 to 5 years, which is when basically Eternal got listed as Zomato, right, July 2021, we have seen cycles happen. There were points of time where people were willing to give good multiples for growth. Then came a phase where everyone wanted profitability, which is when a lot of these names, whether it's Eternal, Policybazaar, Paytm, right, all of these companies started to focus more on profitability, and they delivered that profitability. Right, so there was that phase coming in. Then came quick commerce into the picture, and all of a sudden people saw that this is a vast market. There's a lot of growth that can come, and which is why people again started rewarding for growth. Right, so coming back to the question that you asked, right, Swiggy obviously at the time of IPO, people build in certain assumptions on how the environment will evolve, and that environment continues to evolve even today, right? If you look at how people are guiding towards dark store addition, right, Eternal did guide about when they will reach 1,000 dark stores. Then they upgraded that guidance further. Then they upgraded the guidance on terms of number of dark stores further, right? So in that sense, if you can deliver that trend, right, I mean, doesn't matter whether you are Swiggy or Eternal, right, if you can deliver the trend that you are able to deliver on that growth, and you are able to show that your unit economics are improving over a period of time. Obviously, right, in a phase in which you are expanding rapidly, you might see more impact happening on your console margins. But if that trend is delivered, I think market will reward. Right. Because I don't think people are playing this for 2-3 quarters. This is probably a longer term play.
Right. All right, Sachin, pleasure having you today. Thank you so much for joining in and discussing the latest trends in the e-commerce and, of course, the internet space. Hopping over to Mangalam now, who brings us the latest trends from the F&O space. Mangalam.
Well, it's a down day so far, no real worries, because we went within 30 points of a fresh all-time high yesterday, and then there was weakness that we saw on Wall Street overnight. The Asian market's not particularly doing well. So if you look at it that way, then, maybe the decline isn't as much. In fact, it's just a pause for breath. In fact, we've recovered from lows as well. A couple of data points that indicate that of the excesses yesterday, now there is signs of moderation. One, the India VIX, that has seen a bit of a spike. Now, it's been hovering around very low levels. So a spike in the India VIX actually is good, brings the risk back into the risk asset once again, and people don't get carried away. Secondly, the market breadth. It's actually continuously declining. Yesterday as well, we saw towards the end of trade, the market breadth had moved towards the area of decliners. And now as well, we have around 2,100 stocks which are in the red for about 600 stocks which are in the green. The only thing to track from here on would be the IT index. And if you look at the intraday chart out there, there has been a bit of a recovery. And every time the AI trade unravels globally, the IT index benefits. Why is that? Because when the AI trade was on, the IT index actually underperformed because the street believed that it's at the cost of Indian IT companies, or maybe, the AI boom will have an impact on the Indian IT companies. So if that trade is unraveling, the counter benefit of that would be the Indian IT stocks, and which is what has been visible over the last few trading sessions as well. And yesterday too, we saw recovery from the lows. And today's low on the Nifty is extremely crucial. Yes, we are down, but not out, because the low on the Nifty is still maintained at that 26,050 thereabouts mark. So telling you between 26,000 and 26,050, there is strong support. Put writers are fairly active, still at 26,100. So that's telling you that the bulls believe there is support at the lower levels. Though call writers have become a little more active as well at 26,100 and 26,200, telling you that as we move once again towards record high, there may be an element of some sort of supply coming in. The put call ratio yesterday, we pointed out, closer to record high, it had moved to 1.41, which was very high. So now that too has moderated to 1.04. So all these signs are good for the market pausing for breath before it moves further. And we are seeing a lot of short covering in a couple of individual stocks as well. Even though the market breadth is firmly in favor of decliners, we have names like PG Electroplast where the shorts are caught on the wrong side and they are covering their positions.
All right, that's the F&O update. Thank you so much, Mangalam, for joining us as always with what's happening in the F&O space. Slip into a break now. When we come back, our big story of the day comes up next.
Welcome back. Still 100 points lower on the index, but the big story of the day is the strong guidance and roadmap laid out by the Mahindra Group, as the company has stated that they will see 15 to 40% growth in the next 5 years. Sudarshan is here with the entire analysis. Sudarshan.
So it was like an investor day never before. You had 14 group CEOs presenting their outlook. So what is that outlook? Over FY22 to 25, the group companies have seen a growth of 25%. Going forward, over FY26 to 30, that outlook is in the range of 15 to 40%. Anisha and other group companies have talked specifically about growth gems. So in FY20, combined value of those growth gems was rupees 8,000 crore. Now the combined value has increased to 56,000 crore. That's a 7 times increase, and M&M's market share in that 56,000 crore is of 48,000 crore rupees. Now let's take a look about the outlook of the company-wise. So for SUV and LCV, they are expecting an increase of 8 times in the revenue, and that's the outlook from FY20 to FY30. For ILCV and electric three-wheelers, that's a 6-time increase in the revenue. For Mahindra and Mahindra Finance AUM, they are expecting an increase of 5 times. For aerostructures, 12 times increase. In realty pre-sales, 14 times increase, and for Mahindra Holidays, they are expecting to have 12,000 keys by FY30. So we have done certain calculation that group companies have given outlook from FY20 to FY30. So what about from FY25 level? So for auto, the current revenue is around 91,000 crore. If it increases as per the outlook, by FY30, it will increase to around rupees 3.9 lakh crore. For farm or say tractor, current revenue is around 35,400 crore. It will increase to 55,000 crore. For Mahindra and Mahindra Finance AUM, currently or as of FY20, it's 1.20 lakh crore, and it will increase to rupees 3 lakh crore. And for real estate or say Mahindra Life Spaces, currently pre-sales is of 2,800 crore, and it's expected to increase to 12,000 crore. And for Mahindra Holidays, total keys as of FY25 end was at 5,800 keys, and it's expected to increase to 12,000 keys. The group companies have talked about aspiration. Let's listen in what Anisha had to talk about growth gems and the outlook for FY30.
Auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly, and farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to growth gem. We are building on a very strong foundation, and we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade, from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Life Spaces 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
All right, that's the Mahindra Group vision. That's the big story that we are tracking today. But time for a short break now. When we come back, Rupesh Shah from Symphony will join in next to discuss the business outlook, Q2 numbers, and a lot more. Welcome back. Symphony is the management on our radar. The company posted a weak Q2 with its sales declining, but the company remains confident that 2026 summer will not be as bad as 2025. Rupee Shah, who is the Managing Director of Corporate Affairs at Symphony, is joining us now to discuss the quarter gone by, but most importantly, the outlook going forward. Mr. Shah, good morning. Thank you so much for joining in. It was a washout quarter, and you pointed out channel destocking and a lot of other factors that happened as well. Can you give us a sense of what top-line growth are you expecting in the second half? What have the demand trends been so far post the festive season?
Post-festive season, especially at a trade level, there seems to be some decent positive sentiments which was missing until then, and that is partly reflected in the advances and trade inquiry. So we expect that December quarter, of course, still it will be muted considering the inventory pile-up, but it should be better than the September quarter. As far as first 6 months of sales is concerned, of course, YOY there was a degrowth, but we have to also keep in mind summer of 24 was a blockbuster summer, so base was very high. Otherwise, September 26 on account of maintaining the market share in air cooling, and secondly, because of decent growth in adjacent category, that was the second highest top line in April to September period.
Mr. Shah, predicting weather trends has become almost next to impossible. Consider we used to assume that monsoons in the country would be between June to September. Today, this year around, the monsoons went on till November. But you are confident that the summer of 26 would be better than the summer of 25. Is it only because of the low base? Or you are confident that with all the reforms also that have taken place with regards to the GST rationalization and so on and so forth, there will be demand returning once once the season is back on the cusp of summer next year?
How the season will pan out, I think you already partly answered in your question that it is unpredictable to really assume how the season is going to be. But historically, there are not two back-to-back bad summer. That too, summer of 24 was bad for cooling appliances across the country. Sometimes what happens, in some parts it is good, in some part it is bad. So one is that historical trend. Secondly, the kind of the new models what we have launched for the mass markets, especially for semi-urban and rural market, that gives us some hope. Thirdly, the adjacent category, which now contributes 26% of our top line in trailing 12 months. That is another de-risking factor. And fourthly, we are continuously focusing on alternate channels.
Okay. So you have spoken about alternate channels in the past as well, how that could be a way of improving the overall performance. When we talk about other markets as well, Mr. Shah, what is the growth outlook in the US market? You did indicate that several major US retailers were in the final stages of having a conversation with you about your products. Do you think US market growth could help offset the decline that we saw in India generally?
Current year, there will be YOY decent growth to US sale. This is despite currently tariffs in place. And we are going to have some more dispatches in December and or March quarter based on the confirmed order from some large organized retailer. But obviously, that value and volume no way can set off the decline in domestic sales.
Would this opportunity be, Mr. Shah, the December dispatches that would come by?
No, what I say, right now we have some decent confirmed orders from US large organized retailer, which will be dispatched in December quarter and or March quarter, depending upon when they want the goods there. But we have some good confirmed orders. This is in addition to whatever we dispatch in June quarter through our Australian subsidiary.
Right, Mr. Shah, pleasure having you as always. Thank you so much for sparing time and joining us today. Wish you good luck for the second half of the year. And we touch base again after the end of this ongoing quarter. The management there of Symphony. Take a short break, but just before we do that, in a big week dominated by the Bihar elections, CNN News 18 continued its reign as the undisputed leader in English news. The channel stood significantly ahead of the competition combined, a feat testament to the faith reposed by the viewers in CNN News 18. Welcome back. The Nifty hasn't moved much since we began the show, continuing to remain around 100 points lower, still at that 130 point range at 26,050 on the downside and 26,200 on the upside. Take your leave on this edition of Trading Hour from Sonal and me. Thank you for watching. Halftime report on the other side.
Midcaps see a sharp fall after a stunning U-turn in US equities on AI valuation concerns. Realty, metals and industrials are the biggest drags, while autos stay resilient.
Anish Shah, Group CEO of Mahindra & Mahindra, calls for thinking of growth in multiples, not in percentages. He expects organic growth of 15 to 40% for the businesses over the next 5 years, with profits growing at a faster clip.
The market value of M&M's growth gems has not been captured, and this will lead to a big value unlocking, argues M&M Group CEO Anish Shah. He adds that insurance and another new business on the anvil shall create more value.
Tata Consultancy Services and TPG Terabyte agree to invest 18,000 crores in TCS arm Hypervault to build out AI-ready data centers. Analysts see the PE investment as a positive but remain divided on the potential.
Grow's second quarter numbers reveal a profit jump on lower employee expenses that offset higher marketing spends. Revenue and active clients dipped year on year, even as market share expanded.
Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Winnie Motiwala. With me is Mangalam Malu as well as Ekta Batra. As always, Mangalam as well as Ekta, good afternoon and happy Friday. But markets, a bit of a correction that we're seeing coming in. Last couple of days we'd seen the gain. But today, yes, 26,000, what we're managing to hold on to, recovered from the day's lowest point, but not a very sharp recovery, just around that. But 26,000, still managing to hold on to that. Nifty Bank, Mangalam, you've been highlighting in the last couple of days as well, right? Nifty Bank is not supporting the market as much as one should. So Nifty Bank today also is down 0.6%, and broader end of the market too is not doing that great. Midcap down 0.7% in the trading session as well.
Yep, we take that point, but if you put things into perspective, the Asian markets are down a lot more. The US markets are a lot lower as well. So to that extent, we just went to about 30 points away from an all-time high on the frontline index. So just a pause for breath is what we're seeing in our markets. We've recovered from the lows by about 55 points. And importantly, there's some moderation which has come back in the excesses as well. The India VIX was sharply lower. Now that's come higher. So that's moderating a little bit. From the excesses of 1.3, 1.4, the put call ratio is also now moderated to 1. And while the Nifty Bank is underperforming, the good part is that the IT index actually has recovered from the lows and the autos are resilient as well. So there are parts of the market which are doing well. So let's see where we go from here on. From a long-term standpoint, in the last few days, if you look at it, the texture of the market has definitely turned from sell-on rallies to buy-on dips, and that may perhaps play out over the next few trading sessions as well.
Well, we definitely hope so. But on a week-to-date basis, if you just look at the markets, the Nifty's been fairly resilient, up around 0.7%. We have the mid-caps, however, which are underperforming on a day basis as well as on a week-to-date basis. So the mid-caps have lost around 0.5%. We have the BSE small-cap index, which has lost significantly as well. So that index itself is down around 1.8%. And if you have to talk about particular indices as a whole, the Nifty metals index has lost around 2.5%, but IT has been quite resilient this week. So let's see whether that sustains or not, up around 1.7%. That trade, with regards to AI possibly declining and IT gaining seems to have continued this week. But nonetheless, we do have Vivek who's joining in, first up on the show, to take us through the stocks that are moving around in trade. Vivek, over to you.
Well, thank you so much for that. Again, a session where the market breadth is quite muted, declines more than advances at this point of time, but a bit of a recovery, especially in the broader end of the market. Quite a few stocks making a bit of a comeback. Looking at the list of stocks that are making all the right moves in the green territory, of course, M&M, strong guidance, tractor guidance up at the investor meet. That particular stock higher by over 1%. Grow, this particular stock, last couple of trading sessions saw significant selling pressure, but today, post the Q2 results, has moved higher by over 5%. The other stock on the radar is Sammaan Capital. The stock was in the F&O ban, but there's been a sharp recovery from the recent lows. That stock higher by over 4%. Anupam Rasayan, one of the top gainers as far as the NSE 500 index is concerned, on good volumes as well. And DCM Sriram, the top gainer, especially as far as the mid-cap space of the market is concerned, very strong volumes for this particular name, higher by 7%. On the other hand, quite a few laggards as well, as you can imagine, given the market breadth. GMDC, that particular stock, muted Q2, analysts are trimming down and moderating the expectations as far as the rare earth story is concerned. That stock lower by over 2%. The entire realty pack, all of them witnessing a bit of profit booking and a bit of selling pressure. Lodha, Prestige Brigade, all of these stocks down by over 2%. And JSW Energy, the top mid-cap laggard in the session today.
Okay, all right, Vivek. Thanks very much for that. So those are a lot of the buzzing stocks. But let's now focus on the primary market action. We have Sudep Pharma's IPO, which opens for subscription today. We have with us Shanil Sujit Bhayani, who's the promoter and the whole-time director at Sudep Pharma, joining in. Shanil, hi. Thank you very much for taking the time out. Well, it's an interesting company considering that you do not have any listed peers. So just take us through a brief in terms of what kind of market share you have in the excipients market when it comes to pharmaceuticals as well as human nutrition, and why exactly do you not have any comparable peer in the Indian market?
Firstly, thank you very much for having me on the show. So Sudep, we typically operate we're a mineral-based pharmaceutical excipient and nutritional ingredients company. And our competitive edge or the advantage is the technologies that we have, which are proprietary in nature, dominated historically by American and European companies. Apart from that, it is the regulatory approvals that we hold, again, where we are the only company in India to have these product regulatory approvals. And that is what gives Sudep the competitive advantage, and which is why also, we don't have any direct competitors in India. Talking about the market share, in India, we would be the largest in terms of in the product categories that we operate in. However, we do face competition typically from imports that are coming from US and Europe.
Okay, just give us a sense, in terms of what your key products are, because we do understand that you have iron phosphate, which is something that goes into the human nutrition, the infant nutrition segment as well, and that seems to be quite a niche market for you all, especially in the Indian context. So just tell us how much do you get in terms of iron phosphate, in terms of total sales, and which are your key clients, how much of it is repeat business, and what kind of market share do you have in India when it comes to iron phosphate?
Sure. So I think overall, if you see the business, it's split in two verticals. So 2/3 of our revenue comes from what we call pharmaceutical, food and nutrition. 2/3 and 1/3 comes from specialty ingredients. Infant nutrition is a key focus area for us. And, we have Danone as one of our customers. Again, they're a global relationship that we have. And our expertise there is delivering very high purity minerals into this category. Again, for iron phosphate, today we are the largest iron phosphate manufacturer in Asia. And in India, we would probably be close to 50 to 60% market share in India today for iron phosphate.
Right. Just from a numbers standpoint, I wanted to understand your revenue growth has been not too much. From 430 crores in FY23, it's gone all the way up to 500 crores. So not like a multiplier growth that we've seen, but there has been steady compounding. But there too, the margins have been fairly volatile. At one point, they were 20%. At one point, they were 40%. Last year, they were 36%. So what's a sustainable growth trajectory that one should assume for a business like yours when it comes to revenue as well as margins?
Sure. So I think on the revenue front, we have our core plant, which was operating close to optimum utilization, and we have an upcoming greenfield which will be ready end of this financial year, when we'll add 50,000 tons to our overall pharma food nutrition capacity, and that will be a significant growth driver in the coming few years. Overall, we've had some ASP correction that had happened post-COVID. So while the revenue growth is maybe single digit, there has been significant or much stronger volume growth for the business. And from a margin perspective, as you see, the specialty ingredients business vertical, which is today a third in revenue, was started 3 years back and has grown at a 30% CAGR, I think, with a very strong margin profile. And we expect that business vertical to continue sustaining the historical growth that we've had over the past couple of years. So all in all, I think we are, and including the acquisition that we've done overseas. So I think that will get consolidated this year. We have a lot of momentum for that category as well, as it brings us closer to the infant nutrition market.
So on a full capacity basis, what is the potential revenue that the company can do?
I think today you see that we are close to 50% utilization on the current 50 to 70,000 tons of capacity. We'll have 50,000 tons of capacity coming live later this year. So it will bring us to just over around 1.1 lakh tons. And with the ASPs being within the similar range, I think there is, we possibly
for the revenues to grow 3x, 4x from here on.
Correct.
Just wanted to understand, Sudeep, a lot of your revenues, in fact, come in from repeat orders. So just give us a sense in terms of the kind of clients that you have, where you're getting repeat business from, and how much of your sales actually come in from repeat business.
Sure. So I think close to just over 80% or 83% to be specific comes from repeat customers. And that's because our products play a critical role in the customer's end product. Typically, it's a 3 to 5 year approval cycle, and not too many competitors, not too many suppliers. So once you go through the entire approval cycle, then the business is fairly stable and sticky in nature.
Sure. Also, what about in terms of the breakup or the division that we'll see going forward in terms of your mix, right? How do you see that changing between both the segments in the next couple of years? And also geography-wise, which are our main focus geographies now?
So I think from a revenue mix, specialty ingredients will continue to be a key growth driver. I think couple of years it will become close to a 50-50 split. As this category continues to grow. And from a geography perspective, again, US and Europe are key focus areas for us. We've established our sales team in both these countries, including warehousing capabilities very recently. And that should also help fast track the growth in these two markets.
Okay, just quickly, Shanil, before we let you go, how many manufacturing facilities do you have? How many are, say, US FDA as well as European regulatory approvals? How many of them have those approvals? And is it necessary for your business?
So we have a total of 5 sites, 4 in India, 1 in Ireland now through the acquisition. 2 sites in India are US FDA audited and approved. It is not mandatory as we are an inactive ingredients company. However, having that approval helps significantly for the exports to US.
And you get clients also auditing your sites?
Absolutely.
Okay. All right, Shanil, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Sudep Pharma. They're looking to raise around 895 odd crores. 800 odd crores will be via an OFS, where the promoters, in fact, will be reducing their stake in the company from around 90 odd percent to around 77 odd percent. And the remaining will be 95 odd crores, which will be a fresh issue. The price band is 563 to 593. They did raise money via private equity just some time ago, and that was at around 562 odd rupees. We'll take a short break, but up next we have Ajit Kumar of GM Financial Securities joining in from the GM Financial India Exchange 2025 conference. Stay tuned for that.
Well, there's been a sharp recovery in the markets, almost 100 points from the lows, and now it's been led by a couple of these auto names along with the IT stocks as well. So look at the intraday chart of Nifty Auto. Look at M&M. That's continuously doing well, was fairly well bid all through the morning. We have Maruti Suzuki, which has moved higher. This morning, a couple of technical experts were suggesting Eicher Motors as one of their picks as well on the long side, and that too seems to have been paying off, currently at the high point of trade for that one too. And from the tech pack, Infosys has moved to the high point of trade, along with Tech Mahindra as well. What hasn't done as well is the banking space. When we started the show, it was up down around 0.2%, still down about 0.5%, though there has been a smidge of a recovery. But the index, remember, is for all practical purposes at all-time high still. Ajit Kumar, who's the lead BFSI research analyst at JM Financial Institutional Securities, joins us now from the JM Financial India Exchange 2025. Thanks a lot, Ajit, for joining in. I mean, the stocks are doing well. A lot on the street believe that maybe credit offtake is likely to pick up going forward. Do you believe that too? And if yes, how would you play this theme? Would you play it via banks, private, public, or would you play it via the NBFCs?
Good afternoon, everyone. Thanks for having me. So yes, credit growth right now is running at around roughly 11 to 11.5%. If you remember, 1 to 1.5 months back, credit growth in India was roughly 10 to 10.5%. So there is a jump of roughly 100 to 150 basis point in last, let's say, 1 to 2 months. By the time we, this year end, by FY26 end, we expect that, credit growth in India will be somewhere in the range of, let's say, 12.5 to 13%. So there is definitely a pickup in the credit growth, especially after, so many steps being taken out, taken by the government and the regulator. Now, talking about, let's say, how do we play it? We are more constructive on banks versus NBFCs. Having said that, even within NBFCs, we have our, top picks. In banks, we are largely constructive. The second quarter performance was better than our expectation. Like, for example, for our coverage of 16 banks, we were expecting YOY PAT decline in second quarter when we had written our preview note. But the actual outcome was, PAT was quite flat. We were expecting, let's say, roughly 10 to 15 basis point of margin compression for the large banks in second quarter. But because of the better balance sheet management and the cost of fund, and the depository pricing, the actual margin compression was hardly 7 to 8 basis point. So net, banking sector has delivered, better than expected performance in 2Q FY26, and it is driven by all the three variables. There is an improvement in the credit growth. There is a, better balance sheet management, which led to, outperformance on the margin side. And even the asset quality, trends, by and large, barring few, very few segments, continue to be benign. Into second half of FY26, until unless there is a further rate cut, we expect, gradual margin recovery for, for most of the banks, as cost of fund continue to come down, and that is why in, let's say, third quarter and fourth quarter we expect PAT growth, PAT YOY growth to improve further for most of the banks in our coverage.
Okay, Ajit, I just wanted to split the discussion between your thoughts on the PSU banking space and the private banking space. Between the two, what is your preference, and and based on what statistics and metrics?
Yeah, sure. So I think for us, it's, not between, let's say, private versus PSU. It's actually quite bottom-up story for us. So we like, few names in the PSUs as well. We like few names in the private banks as well. But nonetheless, if you look at, let's say, PSU as a pack, they have done, relatively, they have shown, relatively better performance in last, let's say, 4 to 5 quarters. And one of the key metric is their credit growth has been quite, materially higher as compared to, let's say, private sector bank. And quarter after quarter, they are gaining market share on the credit, pie side. Whether it is, let's say, State Bank of India, Bank of Baroda, or let's say, and let's say the other PSU banks, all of them are, growing at more than 13-14%. Whereas for the private banks as a cohort, credit growth is somewhere in the range of, let's say, roughly 10 to 11%. So on the credit side, obviously PSU banks are gaining market share. Their asset quality trends continue to remain benign, but that the same trend is there for private banks as well. But two variables where, PSU banks continue to do, quite well is first, obviously, is the credit growth, and second is on the asset quality side. Third place, where is the, margin trajectory? Even in the margin trajectory in the second quarter, PSUs have done as well as, private banks. They have also outperformed on the margin side. But the only caveat here is when we look at the data for PSU banks, the rate pass-through on the asset side has been relatively lower as compared to private banks. So in the second half, if let's say, PSU banks decide to pass on the benefit of rate cut to the borrowers, that might have some little bit of negative impact on the margin side. So that is only slight worry that we have on the PSU pack. But otherwise, in rest of the variables, PSUs are doing as well as, private banks.
Ajit, what I want to know is that, you may not answer stock specific right now, but IndusInd Bank, they've spoken about, the management themselves have said that in the next 12 to 18 months, that ROA of 1% will come in. But brokerages are highlighting that would come in FY28 instead of FY27. Any specific reason for this delay that you all have given?
Yeah. No, so in our numbers as well, we believe that while 1% ROE is achievable, but it is going to get achieved in FY28 rather than FY27. In second quarter, they have made losses. And more importantly, if you see their loan book, in the absolute amount, there is a decline in the loan book on a Q&Q basis from past 3 consecutive quarters. So there is a cleanup which is underway. They have, presence in MFI, they have presence in, commercial vehicle loan, they have presence in, credit card, which is witnessing higher than expected, stress. And that is why we believe that, the cleanup is going to take little bit of more time. Which coupled with your low credit growth basically means that your, target of achieving 1% ROA is going to get delayed. So in our numbers as well, we are expecting, 1% ROA to be achieved only in FY28, not in FY27.
Okay, not in FY27 and FY28. And that MFI issue, just on ground, otherwise, it started easing off and it started becoming better, right?
Yeah, so it has stabilized, but I will not say that, it has materially improved. So probably the deterioration is not there anymore. So let's say, for example, from last 4 to 5 quarters, the asset quality pain was increasing at an elevated pace. Now that pace has come off, but this stress still remained elevated. There is a still little bit of time before we, MFI as a pace completely, come out of the woods. My sense is it will take another 1 or 2 quarters before, we completely come out of this crisis. But even after, let's say, when we come out of this crisis, I'm not sure whether MFI space is going to remain, exactly as it was, let's say, 2 years back, whether we can see, that 25% loan growth and 20% ROE, which some of the MFI players used to print earlier in the good times. I'm not sure whether that is still, attainable even in the good times.
Okay. All right, Ajit, we're going to leave it on that note. Thanks very much for joining in and giving us your perspective on the entire BFSI space. We need to take a short break, but in big news week dominated by the Bihar elections, CNN News 18 continued its reign as the undisputed leader in English news. The channel stood significantly ahead of the competition, combined a feat testament to the faith reposed by viewers in CNN News 18. Welcome back. Well, it is definitely a recovery for the markets, as you can see. So it's around 92-point odd recovery for the Nifty from the day's lows. So how exactly are the F&O statistics stacking up at this point in time? Manglam is joining in for more. Manglam.
Well, you know, this F&O stats tell you that there was recovery which was expected, and that exactly has taken place. If you look at the Nifty Bank and the Midcap index, the Nifty Bank would tell you that there is not so much, but it's beneath the surface. The IT index, the Midcaps, which are, showing signs of life once again, despite underperforming at an index level. And the second part is all the excesses from yesterday are now getting moderated. Why do I say that? Because look at the India VIX. Earlier it was factoring in some sort of complacency, sub 12. Now it's gone above that 13.5. So the idea of risk is back, which is a good thing. The second part is that the broader market health as well. While we're seeing more stocks declining than the number of stocks which are advancing, lines appear to be coming slightly closer to each other. So that's something we'll be watching out for as we move towards the weekend. And a couple of big moves that we've seen from the lows in the IT pack has led to the Nifty itself move a lot from the lows. And as a result of which, we're just about 50 points in the red versus a lot lower earlier as well. The IT index briefly in the green. The Nifty, today's low is an important level, 26,050. Why do I say that? Because 26,000 to 26,050 is an important support zone for the market. The bulls too are writing the 26,100 put, hoping for some support around the 26,000 mark, 26,000 to 26,020. So to that extent, today's low is extremely important. And also important is yesterday's high, which is just about 30 points away from a previous all-time high. So 26,250 thereabouts. Why do I say that? Because, the 26,100 call has seen a fair amount of writing, no let up out there. And even if you look at the 26,200 call, there has been some writing between the 50 to 80 rupee premium mark too. So around 26,250 to 26,300, which is the previous all-time high, we would see some bit of supply coming in. A lot of individual stocks, while there are more stocks declining than the number of stocks which are advancing, a lot of individual stocks are seeing some shorts being caught on the wrong side. So they are seeing some short covering here as well. So if the breadth of the market improves in the second half with the recovery that we've seen in the first half in the major indices, then we could see some short covering in individual stocks as well. And that may continue as we move towards the end of Friday.
Okay, Mangalam, thank you so much for that. We'll keep an eye out on those levels and the stocks in the world of F&O. But on that note, we're actually going to give you a quick reminder for our viewers. HSBC presents Future Female Forward Season 3, co-presented by Cognizant from New Delhi. We bring you the new estate chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on the 25th of November, Tuesday, 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 and CNBC-TV18.com.
Welcome back. Joining us on the show now is Richard Radaglia. He's CEO of Matrix Global. Richard, hi. Pleasure having you on the show here. One thing is the Ukraine president signaling that there could be a peace talk or a peace agreement. And the other side, you have the Russian sanctions taking place on those couple of companies starting today. Both of these events, in some sense, haven't really taken the prices on the higher side. How are you reading the both and the impact on prices?
Nice to see you this morning. I think prices are headed lower. I've kind of made the statement before. I think that the market is oversupplied in crude, and I think any geopolitical event that we have had in the last number of months has faltered. In our first discussions, we saw the attack on Iran and how prices spiked there, and in all cases, the prices continue to move lower. What we're seeing now, and I believe what is coming out of Russia and what's really coming out of India, Trump is very much playing a real politique game here, where he has threatened large tariffs on India of up to 50%, and we're seeing the reaction now. Reliance has come out and said we're going to cut exports into our import zone, and the reason that's important, the current price of Urals crude, which is a heavy sour crude into India right now, or versus Brent, is $23 lower than the current price of Brent. So Urals is at a $23 discount, which I think is one of the largest discounts we've experienced going back even to the beginning of the Ukraine-Russian war. And so what is happening is that the pressure that Trump has been putting on Russia he's doing it in an economic fashion. Right, he's doing it in a way that's causing economic hardship, and I think that is pushing Russia and maybe Zelensky. I'm not sure if Zelensky's part of this, but putting them towards maybe a possible deal.
All right, Richard, as you said, with the on-ground dynamics changing on how India is buying crude, not so much from Russia now, as the statement from Reliance and various Indian public sector units also has been. As India buys more crude and more LNG perhaps from US, do you see that as a definitive pattern going ahead?
Say that again. I think that India, interestingly enough, never really was a large importer of crude from Russia. 40% of all Russian imports or exports went to Europe. It's not coincidental that yesterday the head of Saudi Arabia was sitting in the Oval Office, and the major beneficiary of any decrease of Russian crude imports into India is going to go to Saudi Arabia. Their crude is very similar. It's very close. And it's been one of the major suppliers historically. And so this is really a situation where we've seen time and time again. Trump is using economic power to push decisions, and he's forcing people to wake up and say, look, how do you want to play this game? Who is going to be your ally? And in this case, I think India is saying, Reliance in particular is saying, we are not going to import more Russian crude. The imports of Russian crude, which is was close to almost 2 million barrels a day, is going to be half of that. Remember, when you start importing crude from Russia, you're talking about a 30 to 45 day lead time. And so the loadings that are going to be coming in at sometime in end of December, January, February have already declined. And so the cake is already baked in that case. And what we're going to see is more activity of India dealing with the Middle East and with the US.
Richard, what is also your sense going forward into 2026, where the markets are anticipating anywhere between 2 to 4 million barrels per day of an excess supplies, and most of the global banks and brokerages now have spoken on their crude price expectation next year, and that continues to be more on the bearish side?
I agree 100%. I think, if you think about this, we've had this discussion maybe 6 months ago. It was just the opposite. In my mind, what we're looking at is very much excess supply. It's very possible that if Russia does come back into the fold, that their ability to increase their production. Remember, OPEC is called OPEC Plus, and OPEC Plus is really all of the OPEC members plus Russia. And Russia at this point in time has been underproducing in the sense that people don't want their crude. And now with India pulling back, what that means, it means that China is going to demand even greater discounts. So the economic pressure on Russia is going to be even more extreme. And so I think what we're looking for is effectively lower oil prices going forward. There might be a hiccup or two. As prices move down to a lower level, you might start to see crude production kind of less interest in investments in crude production. But here in the U.S., we have record crude production. I think our production now in the United States is 13.6 million barrels a day. We're the largest crude producer in the world. And much of that crude ends up leaving the United States because of its quality. Its quality is such a high quality that the U.S. refiners, it doesn't pay for them to refine it. And that crude is going into India, and other refinery systems around the world.
Okay. Thank you so much for joining in, Richard, and thank you so much, Manisha, for taking us through that conversation as well. Interesting to keep an eye out on the updates in the world of commodities and what's happening on the crude side as well. But on that note, we're going to slip into a very short break and get you some excerpts from our exclusive conversation with Anisha of Mahindra Group chief on their next 5-year plan and their growth targets. Listen in. Welcome back to Halftime Report on CNBC TV18. And as M&M holds its Investor Day meet with 14 CEOs and business heads under one roof, Shri Imran caught up with Anisha, Group CEO and MD of Mahindra Group, and they was talking about the growth targets. Listen in.
As we look at aspirations across our businesses, I will start with the headlines from today for holidays being the #1 leisure hospitality player in India. We've been the #1 vacation ownership player in India, but that's obviously a sub-segment of the leisure market overall. And Manoj has some fairly aggressive plans for growth for this business as he's transforming the business, not just in terms of getting into a new area of Mahindra Signature Resorts, but also taking our current membership base and creating much greater value for them. As we look at our auto and farm businesses, they have continued to grow extremely well. As we talked today at our Investor Day about key metrics for each business through the decade. And auto and farm have revenue growth of 8x and 3x respectively. That translates to a higher profit growth and hopefully a higher market cap growth that comes with it as well. If we look across our businesses, Mahindra Finance has promised a 5x growth in AUM this decade. And has...
he's smiling very sheepishly as you say that.
He's achieved a lot in the last 2 years already because we've got the difficult part behind us of getting to a better asset quality, of getting to a much stronger customer experience with technology, with data, and now it's a pivot to growth for Mahindra Finance. So in some ways, a lot of the hard work has been done, and it hopefully should be an easier path going forward. Tech Mahindra on a good track has promised a clear path to margins and more coming after that. And as we look across our businesses, Sustain has won a lot of significant deals already, is on track to grow 5x this decade. Life Spaces, Amit has promised a plan of 14x growth this decade in pre-sales, has achieved more than half of it already. And as he has been saying for some time now, that's a low target, I need to increase that target. That's him saying it, not me. Suman has done a fantastic job in electric three-wheelers. We are the largest in electric three-wheelers by a good margin now. And the business has grown, again, fairly dramatically. If you look at electric three-wheelers alone, it's 65x growth, yes, of a small base. But electric is now more than 30% of the entire three-wheeler market and soon to be 50% as well. So we've got a set of very, very strong leaders. Avanti and Asha have been focusing a lot on purpose. As you said, we are purpose-led. We start with purpose. And we've got Vinod, have sort of kept him from a business standpoint last, but our aerostructures business is, I would say, among the most promising businesses we have. And Vinod will talk about why, from a quality standpoint, he really feels that we stand out versus others, not by our perspective, by perspective of our customers who are global OEMs. Aerostructures has promised a 12x growth in revenue this decade. But if we just look at the order book, and one metric I will say is from Airbus alone, for many years prior to last year, we'd gotten orders of 150 million. Last year alone was 1.13 billion in orders. That's a reflection of what the business has done from a quality standpoint. And our helps keep everything together in terms of making sure the discipline is maintained across the business.
Welcome back. Well, it looks like we're going to make a dash into the green for the Nifty at this point in time. But just watch out for specific stocks on a week-to-date basis. So Growth, for example, has risen around 10% this week. It's been a choppy sort of session this week. We have GMR Airports, which has risen around 10% on a week-to-date basis. The stocks such as Tata Motors PV, which is up today, has lost around 7.5% of its market cap on a week-to-date basis. So that's what's taking place for the markets. There's definitely a recovery which is on our hands, at least for the frontline indices. Mid-caps and Bank Nifty still significantly in the red. It's a wrap on Halftime Report. Business Lunch up next.
Midcaps see a sharp fall after a stunning U-turn in US equities on AI valuation concerns. Realty, metals and industrials are the big drags while auto remains resilient. Anish Shah, the group CEO of Mahindra and Mahindra, calls for thinking of growth in multiples and not in percentages. He expects organic growth of 15 to 40% for the businesses over the next 5 years, with profits growing at a faster clip. The market value of M&M's growth gems has not been captured well, and this will lead to big value unlocking, argues M&M Group CEO Anish Shah. He adds that insurance and other new businesses on the anvil shall create more value. TCS and TPG Terabyte agreed to invest 18,000 crore rupees in TCS ARM Hypervault to build out AI-ready data centers. Analysts see the PE investment as a positive but remain divided on the potential. And Grow's second quarter numbers reveal a profit jump on lower employee expenses that offset higher marketing spends. Revenue and active clients dipped year on year even as market share expanded. The bulls are determined to end the week on a high, maybe even at a record high. We'll see what transpires in the next 150 minutes of the final trading day of the week. You're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Patakia. It's been a very significant recovery from the lows of the day for the Nifty. It's a 100-plus point recovery that we have seen on the index, or just around 20 points lower now, almost heading back into positive territory. For the Nifty, leading that recovery has been the recovery that we have seen in the banks. The Nifty Bank now is down just 200 points, and most of these names, be it ICICI Bank, HDFC Bank, have recovered from the lows of the day, and that has contributed to the up move. What is also contributing to the up move is the auto space. There you can see the Nifty Bank. It's up around 250 odd points from the lows of the day. And the Nifty Auto Index at the highest point of the day now, 0.5% higher, led by the two heavyweights, Maruti and Mahindra. Maruti receiving a positive brokerage note just recently from Morgan Stanley, and that has now surged 2%. And Mahindra, of course, we had that mega CEO roundtable of sorts with the 14 CEOs of the entire group sharing bullish views on the road ahead for the company, and 1.5% higher for Mahindra as well. Since we are on that subject, Mahindra Rise businesses have shared their roadmap to 2030 with CNBC-TV18. The group said that their growth target over the next 5 years is between 15 to 40%. Sudarshan is here to break down the entire blueprint for us. Sudarshan.
So Mahindra Group had held Investor Day yesterday, and all the group companies have set an ambitious target. So organic growth of Mahindra Group over FY 22-25 was 25%. Now going forward for FY 26 to 30, now that growth target is in the range of 15 to 40%. Now they have talked also about growth gems. So in FY 20, as of FY 20 end, combined value of those growth gems was rupees 8,000 crore, and currently it's at 56,000 crore. That's an increase of almost 7 times. And in that 56,000 crore, Mahindra's share stands at rupees 48,000 crore. Let's take a look at the growth outlook that group companies have given for FY 20 to 30. For SUV and LCV, they see an increase of almost 8 times in the revenue. For ILCV and electric three-wheelers also, they see an increase of 8 times. For Mahindra Finance AUM outlook, they see an increase of 5 times. For aerostructures, 12 times. For realty pre-sales, they see an increase of 14 times. And Mahindra Holidays, at the end of FY 30, they are looking at 12,000 keys. So they had given the target for FY 22, FY 30. That's of 10-year journey. But I've tried to do the calculation. What were those sales at the end of FY 25, and what would those look at the end of FY 30? So for auto, current revenue or as of FY 25 stands at rupees 91,000 crore. That may increase to almost 4 lakh crore. For agri or say tractor, it stands at rupees 35,400 crore. That may increase to 55,000 crore. AUM that stands at FY 25 and at rupees 1.20 lakh crore, that may increase to 3 lakh crore. Realty pre-sales are at 2,800 crore, that will increase to 12,000 crore, and Mahindra Holidays keys stand at 5,800, and that will increase to 12,000. Let's listen into Anish Shah, what exactly he had to say about those growth gems target and also about FY 30 outlook.
We are building on a very strong foundation, and we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespace is 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
The entire Mahindra Group speaking to CNBC-TV18. Now, the most talked about post-earnings results have been that of Billion Brains Garage Ventures, and that is, of course, Grow, the much talked about stock first quarter after its listing. Vivek is here to tell us how the numbers look like. Vivek.
Well, that's right. So Grow, post results have actually seen quite a bit of a bump up as far as the stock price is concerned. But a few things, number one, that we have to keep in mind. First up, on a year-on-year basis, revenues have actually declined. But however, when you're looking at the operating profit as well as the operating margins, as well as the profitability, all of them on a year-on-year basis have improved. This on the back of the fact that, number one, when you're looking at the OPEX, that is something that has come down quite significantly, and the cost to income too has reduced. And this has improved the operational profitability of the company. But the one thing that we need to keep in mind is that when the last time the management joined us, they told us that FY26 is expected to be a year of growth, especially as far as the top line is concerned, and they were expecting to see growth in the range of 25 to 30%. And they also said that costs could go up by 15 to 20%. Now in Q2, you have actually seen the revenue decline, which raises concerns on whether the management will be able to go ahead and meet the top line guidance that they had started when they met us last time. However, when you're comparing operationally, Grow as well as Angel One, operational performance of Grow is significantly better, especially given the fact that employee costs are something that is much lower compared to its peer. But overall, it has been a steady set, especially on a sequential basis. There's been improvement across all parameters. It's been a steady set, which is why you're seeing the stock move higher in the session today.
The stock has remained steady as well, 4 to 5% higher, as has been the case all through the session. Market cap back above 1 lakh crore rupees. Vivek, thank you for that update. Now on to the big global concern around AI valuations. And just a day after Nvidia's splendid July to September quarter earnings, which had for then assuaged investors about the froth in AI valuations, the US markets took a very dramatic U-turn in Thursday's session. The stocks opened higher but fell off a cliff as the valuation concerns in AI stocks resurfaced. The Dow fell 1,100 points from the highs of the day to end around 400 points lower. The S&P 500 fell almost 1.5% from the day's high. The Nasdaq also corrected over 1,000 points from the highs of the day. As of now, the US futures are trading higher this afternoon. We just need to see how they hold on for the rest of the session. But Nvidia's CEO, Jensen Huang, however, rejected talks of an AI bubble in the company's earnings call. Listen to what he had to say.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Now, on continuing with this subject of the sell-off in AI stocks and the debate surrounding their valuation, Sandeep Kalra, the CEO of Persistent Systems, believes that we have a bubble on valuations, but not on the AI play. Listen to what he had to say.
Bubble that we all are talking about is about the valuations. I don't think it is about the AI part being real. I definitely think the AI momentum is real. We are in a very early innings of this whole, percolation of AI into enterprises, into the way we do business, and so on. When we look at our customers, they have all been doing proof of concept. Some of them are going big. So this is going to be a multi-quarter, multi-year journey. So it's not about the market, the addressable market not being there. Now, as far as the valuations are concerned, markets are the best judge. Whether the Nvidia valuation or other valuations are the right valuations at this point in time or not, we'll let that be the market, place. Now, as far as AI and the entire reskilling is concerned, obviously, the way generative AI and AI at large work, and they are getting infused into every part of business that we do, whether we are a tech services firm, whether you are an enterprise in healthcare, in financial services, and so on. So the amount of reskilling, the workforce transformation, that is real.
Let's take a short break, but just before we do that, an update for our viewers. In a big news week dominated by the Bihar elections, CNN News 18 continued its reign as the undisputed leader in English news. The channel stood significantly ahead of the competition combined, a feat testament to the faith reposed by viewers in CNN News 18. Welcome back. Now, India's Commerce Minister Piyush Goyal is in Tel Aviv on a 3-day visit to push for the long-pending free trade agreement with Israel. Abhimanyu is joining in with the latest updates. Abhimanyu.
India and Israel are all set to deepen their strategic relationship as both the countries have signed the terms of reference for a potential free trade agreement in which they are looking to decrease non-tariff as well as tariff barriers to increase market access across several sectors. Israel may also welcome more skilled Indian professionals, which will not just provide employment to Indian professionals, but also will provide a steady stream of skilled professionals to the Israeli economy. Also, both the sides sides are looking to increase collaboration across several sectors beyond the current collaborations in the defense and space sectors to agrotech, IT services, financial services, and even areas like drip irrigation and saline water management. It remains to be seen how early both the sides are going to start negotiations for a free trade agreement, even as there have been indications that 8 to 10 Indian companies have already been shortlisted to bid for an infrastructure project in Israel. Israel's Minister for Economy, Nir Barkat, also indicated that there are plans afoot, that there is encouragement being given from the Israeli government side to Israeli companies to invest more in India, to invest more in manufacturing capabilities, to gain from overall scale of the Indian market and the skilled workforce.
Now, Abhimanyu also spoke to Nir Barkat, the Minister of Economy and Industry of Israel, and Ron Tomer, the President of Manufacturers Association of Israel, on the potential trade deal. Listen to what they had to say.
I brought a mission to India in February, 100 entrepreneurs and CEOs. And now we have a big mission coming here. So we now know what the entrepreneurs need to succeed. One of the reasons we've decided last year to exchange missions, that at the tail end of it, like today, we will know what our businesses need. So now we're starting to work in parallel. Okay, we're starting to establish more relationships, more exposure, and we're going to be working on innovation. For example, one of the things we're talking about is not do the classic deals of the past. One of the things we're going to focus on is AI. We have a lot of work to do that is futuristic. And so by the trust that we built together, by the collaboration, the high collaboration, I believe we'll be able to create an ecosystem probably the best in the world.
Israel is a country of 10 million people, and we shortly will reach the ceiling of how much output, industrial output we can produce. We can double, we can triple, but we cannot do it 10 or 20 times more. And therefore collaboration with a country like India, when you can do business with people that I have experience with, you can really do it in a very amicable manner. And with the great industrial capabilities, if we need to make 10 times folds or more, the scalability of the Indian production can be assisting us very much. So I'm looking for joint co-investment, joint manufacturing, some in India, some in Israel, joint marketing. India is strong very much in Asia, Africa. We have a gateway to America, to the United States, which President Trump is one of our good allies, and we have the minimum tariff possible. So there is a lot of collaboration on many products.
On to CNBC-TV18 exclusive then, India's air traffic is rising faster than airports can handle, and now the Airports Authority of India is pushing a massive upgrade of the country's air navigation infrastructure. Now, CNBC-TV18 learns that 65 ATC towers across the country will be revamped, upgraded and newly built over the next 5 years with an investment of anywhere between 15 to 17,000 crore rupees. Madhiha is joining in with more details on this. Madhiha, tell us more about this ambitious plan.
Well, the Airports Authority of India has begun its biggest ever modernization of air navigation services to enhance the airspace capacity. Airlines might add aircraft, but not having enough airspace to navigate can slow down India's aviation growth story. So here's how Airports Authority plans to deploy the 17,000 crores. The plan is to modernize 65 ATC towers by 2029. About 60% of the funds go into civil works and 40% into new automation and navigation technology, as well as enhancing cyber security, which is very important considering the cyber attacks that ATC towers could come under. So 65 airports which have been identified for major overhauls, and 54 will undergo minor routine improvements. So of the 65 airports, 13 airports that have more than 100 flight movements per day have been identified, of which 5 airports will see total revamps. 8 airports will get revamps of the air navigation systems. So 22 airports will see ATC towers revamped along with new ANS, which is air navigation systems. 26 airports will retain their towers but get new ANS systems, and 4 airports will see construction of new towers with new equipment. And these 4 airports where the new towers will come up at Bhogapuram, Navi Mumbai, Dholera and Jewar airports, which are all high growth, high traffic locations preparing for large scale expansion. Now, AI says that the objective is simple: handle more flights safely and efficiently by improving automation, flight sequencing, and runway throughput. India currently, remember, handles 44 to 46 landings an hour at its busiest airports, including the Mumbai International Airport, which is well below the 56 to 57 landings per hour seen globally. But modernization, remember, also needs skilled manpower. AI recruits 800 to 1,000 air traffic controllers a year, and that number will need to rise significantly with capacity expansion and the new towers coming up. So AI currently trains air traffic controllers at Prayagraj, Hyderabad, and Gondia. The Prayagraj center will now be upgraded with new buildings, simulators, and radar systems. AI says this upgrade cycle is essential as India prepares for a surge in new aircraft and new airports, and the entire program of the 17,000 crore investment for expansion of airspace capacity is targeted for completion by 2029.
Madhya, thank you for that very important update there. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Starting with some geopolitical developments, Ukrainian President Volodymyr Zelensky has said that he is ready to work with the US on a plan to end the war in Ukraine and expects to discuss it with the US President Donald Trump in the coming days. Zelensky has already met with the top US Army officials where he received a draft of the peace plan. And as we end this edition of Business Lunch, we leave you with visuals of US President Donald Trump's son, Donald Trump Jr., playing dandiya with Reliance Industries scion Anant Ambani at Vantara. Trump Jr. toured the Wildlife Conservation Center with Mr. Ambani and also visited the Ganesh Temple inside the world's largest wildlife rescue and rehabilitation center in Jamnagar. With that, we take your leave on this edition of Business Lunch. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Vivek, finally it's a Friday. Finally, the markets also did see some recovery, but that has been sold into yet again. So we are seeing cuts of around 79 points on the Nifty as we speak. The Bank Nifty, that also saw some recovery, but that got sold into yet again. So it's a 0.6% cut on the Bank Nifty. And mid-caps, they are lagging, and that continues to be the case since the start of the trading session.
That's right. Good afternoon, Sonal. So 0.8% down as far as the mid-cap index is concerned, almost 0.9% down as far as small cap is concerned. And the underperformance since the past few days we've seen is ensuring that the market breadth remains weak. But we have a lot lined up on the show, so let's start off with the top headlines. Indices make a recovery from the day's low, but are trading off the day's highest point. Midcaps see a sharp fall. Realty and metal indices are the biggest drags, while autos stay resilient.
Gross Q2 numbers reveal a profit jump on lower employee expenses that offset higher marketing spends. Revenue and active clients dipped on a YY basis, even as market share expanded.
It's a flat debut for Capillary Tech. The company lists at 570 rupees a share versus the issue price of 577 rupees a share. Stock, however, currently has seen a jump from the day's low with 6% intraday gains.
AWL Agri slips 2.5% after a block deal, which sees Adani Commodities sell 7% stake to institutional investors. Max Financial is also trading slightly under pressure after 0.5% equity changes hands via block deals. Okay, all right, those are the top headlines that we are tracking. Midcaps continue to be on our radar. That one is seeing a big cut. Remember, yesterday, despite midcaps being in the green, we did see the advance decline ratio largely in favor of declines for a greater part of the trading day as well. And today as well, it is closer to the day's low. Even the small cap index, that should come up for you on the screen, that is complementing the moves that we are seeing on the midcaps right now, underperforming the benchmarks, though even the benchmark is seeing a cut of around 0.6% as we speak, 90-point cut as we speak. That's around 0.3% cut. That continues to be the theme for mid-cap radar as well. What's happening in the broader markets?
Absolutely right. That's exactly what's transpiring. You know, the metal pack is something that continues to witness selling pressure. Names like Tata Steel, Jindal Steel, JSW Steel, all of them are under significant pressure. In fact, JSPL is now down almost 2% in the session. But these stocks and a whole host of other names is what Sudarshan has on his radar. He's standing by the wall to take us through the mid-caps that are moving around in the session.
So first, I'll talk about the stocks. Those are reacting to certain news flow, and top of the list is Sammaan Capital. It's another day that company has clarified regarding the SC order, and once again it has reiterated that this SC statement or SC order has nothing to do with company. It's regarding the erstwhile promoter, that was Samir Galot, and that's the reason stock is up more than 4%. Second name that is buzzing in trade is IndusInd Bank. There was a certain report about companies looking to raise fund, though company has clarified that it's not in talks to raise fund. We don't know if the stock is reacting on that news. Nevertheless, the stock is higher. Here it should be grow. It's higher after the stock company has reported Q2 earnings. Those earnings looked largely mixed, but after falling for 2 straight days, today the stock is higher. Mahindra Lifespace, you would have seen that Mahindra Group had held Investor Day yesterday, and they have given an ambitious outlook for FY30. For Mahindra Lifespace also, they are looking at 14 times increase in the revenue by FY30. On the back of that, for second straight day, the stock is higher. Last one is Mindspace Business Rate. There was a positive commentary from SEBI chairman that they are looking at easing the business, ease of doing business for both REIT and InvIT. That might be one of the reasons that why the stock is higher. Some of the other mid-cap gainers, Aztec Life has been moving higher for the last few sessions. Today also it's up more than 6%. PG Electroplast has moved above 600 rupees per share for the first time since August 8. Remember, August 8 was the day that company had released Q1 earnings, and those earnings were weak. They had cut the guidance, and now there was a sharp fall. So after that, for the first time, stock is above 600. Some of the chemical names are moving higher. Apex Frozen Foods, Anupam Rasayan, those stocks are higher with healthy volumes. Fujiyama, after listing yesterday, was low in the trade. Today, it's back up. It's up almost 3%. Some of the stocks that are falling, first is JP Power. Remember, yesterday we were talking about that Adani Enterprises was amongst lowest bidder for JP. So after that, JP Power was higher in the trade yesterday, but today it's back in the red, down more than 7%. All the real estate names are under pressure, and Oberoi Realty, you can see, down almost 3%. And some of the other names are low in the trade are JSW Energy and Tube Investments with healthy volumes.
Okay, all right. Some interesting names there. Thank you so much, Sudarshan, for joining us as always and telling us the mid-cap movers in the market. It's also a good time to welcome Himen Kapadia from DR Choksi Securities for a FinServe for a technical check on the markets. Himen, good afternoon. Thank you so much for joining in. It's been a long since we spoke. So tell us, what kind of levels are you watching out for on the Nifty, broader markets as well?
Very good afternoon, Sonal. Thank you for having me on the show. Sorry, the pleasure. Yes, I was on a mini hiatus for a few days. The thing is, the VIX has gradually moved up to 13.5, which is not a good sign. I think about 13, the VIX could appreciate further. The Nifty, we posted a high of 26,277 on 27th September 2024, Sonal. We came striking distance, 40 points far from away there. That is why we've seen resistant selling pressure. I think it's natural, can be expected. It's obvious now we need to take out this 26,277 in terms of closing. Ideally, not on the daily chart, but on the weekly or the monthly. Okay, the month is coming to an end. I believe by the end of the month, we should be above that. So I guess things are not looking bad. Setup is good. But like you mentioned, I think the mid caps aren't doing that well. The bank Nifty is leading, has posted a fresh all-time high. So it's all over the place. Somehow the spark is missing, but the Nifty seems copacetic, seems nicely placed. I believe new all-time highs in the offing. If not by next Friday, maybe after that.
Okay, Himen, good afternoon. Seeing you after a while. Himen, any specific view as far as the Nifty Pharma pack is concerned, and what are your individual picks for the day?
Okay. Hi, Vivek. Yes, it's been quite some time since we spoke. As far as the Nifty Pharma is concerned, the setup is not bad, but we've been consolidating over here for this is the 5th month, Vivek. The range is roughly between 21,200 and 23,200, and we've been here for 5 months. It's consolidating. I believe the setup is improving, but we need some sort of a push, whether that comes in form of a deal with the US or whatever. There needs to be some follow-up buying, which is missing. But it seems poised. Well, it's been poised for 5 months, so difficult to say it's going to happen today, tomorrow, day after. But I believe the setup is bullish, and I would be more bullish than bearish. So yeah, it looks interesting, but hasn't sort of broken through yet. As far as stocks are concerned, first pick is Eicher Motors. Vivek, looks good. We've spent quite some time in a range between 6670 and 7100. Now we are breaking out. It's posted a fresh all-time high. It's been in an uptrend for the last 5.5 years. And if I stretch the time frame a bit, Vivek, it's been an uptrend for the last 27 years. So short-term, medium-term, long-term setup is quite positive. So one can buy Eicher Motors at around 7185. Stop loss 7165, sorry. Stop loss 7065, target of 7365. It's a modest target. We are going towards probably 78 and maybe even 8,000. The second one is a buy call.
No, go ahead.
Yeah, sorry. The second one is a buy call on LTTS, Sonal. IT is good. It's a recovery, medium-term bottom in place. So it's a turnaround. Albeit it's going to be a slow turnaround, but probably in TCS looking better, but LTTS is my pick. Worst is over, medium-term bottom in place. It's set for an intermediate uptrend, or at least a medium-term bounce. So one can buy LTTS at 42.90, stop loss 41.90, target 44.90.
Okay, all right. Take that point, Devin. Thank you, Himen. Thank you so much for joining in today, and have a great weekend ahead. And in a big news week dominated by the Bihar elections, CNN News 18 continued its reign as the undisputed leader in English news. The channel stood significantly ahead of the competition combined, a feat testament to the faith reposed by viewers in CNN News 18.
Welcome back to Midcap Radar. Well, a bit of a recovery attempted as far as the pharma pack is concerned. Lupin as well as Aurobindo Pharma, both of these stocks have now moved to the day's highest point. Still, very mild moves is what we are seeing, especially as far as even the pharma pack is concerned. But moving on, Winnie now joins in. She has all the details on the new kid on the block, Capillary Tech. It's also the Midcap Spotlight stock of the day. Winnie, over to you.
Yes, Capillary Tech is the one that has listed on the exchanges and bourses today. When you look at it in terms of the listing, it started off muted and then picked up some bit of a pace. At one point of time, it was up almost 7%. Right now, it's holding on to gains of 6%. So slight bit of that positive up move, but not a very bumper listing. Still a 6% up move right now is what we're seeing for the stock as well. Now, obviously, in terms of the IPO size, just a recap, 877 crores IPO, which was there. Of that, fresh issue was 345 crores and offer for sale was around 532 crores, where 85 lakh around shares were sold by the promoter and balanced by Trudy Holdings, which sold the remaining amount of stake. Now, obviously, in terms of subscription, that came in around 53 times the total subscription. Let's talk a bit about the company, right? Just to understand for our viewers, it's a SaaS company which helps enterprises, and this is mainly in terms of to run loyalty programs end to end. So they earn points, they redeem rewards, there's personalized offers that come in as well, and they mainly understand the customers by using AI and data. So AI data, that's where they'll help, with servicing all these enterprises as well. Other than that, they will engage with customers across channels, so emails, SMSs, apps, social media, and they offer consistent personalized experiences also for their clients and customers. Some of the clients that come in over here are Tata Digital, ABFRL, Domino's Pizza Indonesia, Aditya Birla Fashions are some of the names there as well. Now, in terms of financials, when you look at it, on a year-on-year basis, first half FY26, they managed to see a 25% growth there, margins at 11%, and the company has reported a profit of 1 crore in the first half of FY26. Management said that they generally add 3 to 4% in terms of EBITDA margin every year, and they expect that to continue. So that'll be interesting to watch out for, but a decent listing coming in for the company today.
Okay, all right. That is Capillary Technologies, up 5.5% as we speak. And we will stick to a recent listing yet again. This is our special segment, Midcap Spotlight. We'll focus on Grow, Vivek. How did the numbers look? First one after listing.
Well, absolutely. Grow is up 65% since the listing. And, it's been one of the stocks that's been on everyone's radar and everyone's wondering what exactly is transpiring. Well, one litmus test for the company today was how exactly Q2 panned out. And Q2, and as you can see the stock, Q2, in fact, has been a bit of a disappointment, and we'll explain why. On a year-on-year basis, when you're looking at the numbers, the revenues has actually gone lower on a year-on-year basis. However, when you're looking at the operating profit, or when you're looking at the EBITDA numbers, the EBITDA, we look at the operating profit without the interest income for this particular name, as our colleague Devyani points out, that has improved, and that is largely because of significantly lower OPEX cost, and the cost to income this time around has been significantly low. So that is something that has aided both EBITDA and on the back of that, also margins have gone higher. Now, the other thing that we need to keep an eye out for is the profitability. On a sequential basis, remember, all of the parameters the company has done well. But when the company joined us, post-listing and during the listing, they actually told us that the top line for FY26 over FY25 is actually expected to go 25 to 30%. They also said that there will be subsequent increase and there will be costs also that increase higher. But looking at Q2, which has actually seen a degrowth, it's now important to watch whether the company can actually go ahead and meet the guidance of revenue growth or top line growth for FY26, and that is something that will keep the street worried. But still, they have H2 and H2, and it'll also be important to see what the management says, once they do have investor calls, etc.
Okay, all right. So we'll watch out for that, but makes sense the kind of numbers Grow has posted in the stock reaction. The stock has come off from the highs of the day. With that, we'll do one thing. We'll sip into a short break. When we come back, we'll get you more on the market, stock-specific action, and a lot more on the other side. Welcome back. You're still tuned into Midcap Radar, and the Finance Ministry has just concluded its pre-budget meet with the infra and energy sector. Our colleague Timsi Jaipuria is joining in with more details with what the demands of these sector experts are. Timsi.
Well, that's right. Finance Minister's pre-budget meeting with energy and infrastructure sector has just concluded. And what we are given to understand from sources that representatives from solar sector, from highway sector, construction sector, from shipping sector, etc. were part of this meeting. And some of the key demands, firstly from the solar sector, were that they sought a higher government funds allocation for capacity expansion. They've also called for cheaper financing and discounted green energy loans. They've also sought for a further push for more funds under the PM Surya Ghar scheme. Also, they've sought expansion of PLI support for solar cells, batteries and electrolyzers. These were some of the key demands for the solar sector. When it comes to the highway and infrastructure sector, well, they've sought for continued higher capex allocation for highway expansion, plus also MORTH, that is the Road Ministry and NHAI, are seeking stronger funding for the new projects, especially faster execution, have been sought for greenfield expressways, multi-laning works, etc., which are underway. Also, a push to resolve land acquisition, which has been plaguing the sector for quite some time. Faster clearances of bottlenecks, that's what they've demanded. When it comes to shipping sector, well, they've sought continued support on the maritime financial schemes and also rollout of infrastructure status for large vessels. That was another request. Also demands for further R&D incentives for green shipping building technology and further support of fund allocation. Let's see how much of it actually gets transpired in the union budget this year. Back to you.
All right. Thank you so much, Timsi, for joining in with all those important details. Of course, we'll keep watching out for these demands and suggestions which come ahead of the final budget expected in February. For the markets, it's a 60-point downtick that we are seeing on the Nifty currently. There's another attempt to recovery as well from the lows of the day. The mid-caps too, it's nothing to write home about, honestly. It's still down 0.7% as we speak. That's the mid-caps that I'm talking about. Bank Nifty too down 0.4%. But we do have some outliers in the market. For instance, Apex Frozen Foods, that stock is up 16%, bucking the trend that we are seeing in the broader markets. Karnataka Bank is up around 9.5%. We do have IndusInd Bank, which is seeing gains of around 3%. Dhanuka Agritech is the stock, which is up 2%. GMR Airports is seeing gains of 1.5%. So there are a couple of names which are bucking the trend as far as the broader markets are concerned. The small cap index, though, it is largely in line with what the mid caps are doing. So all these stocks should be on your radar as well. But with that, we'll do one thing. We'll take your leave on this edition of Midcap Radar. Do stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. And in terms of the markets, let's look at that, right? Recovered from the day's lowest point, again came down a bit in terms of the points over there, but 26,000, that psychological mark that we've been keeping an eye out on, the Nifty is managing to hold on to that today. So that is something interesting that we'll be keeping an eye out on as well. 26,137 approximately, there is where the Nifty is trading at. Look at the bank Nifty. Now that is down 0.4% in today's trading session. That too has recovered with the market from the day's lowest point. We'll watch out for that as well. Nifty IT, when you look at that, that also actually managed to even go to the green at one point of time, came off that green point, still almost a recovery that we're seeing from the day's lowest point overall for the market. Broader end of the market continues to see a bit more of a pressure versus the Nifty 50. So Nifty Midcap is down 0.6%, small cap too is trading with cuts of almost 0.6 to 0.7%. So some bit more of a pressure that we're seeing on the broader end of the market. But this is a show where we solve all your stock related queries, and to do just that we have Shaina Mukaddam, independent market expert, and Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all those stock related queries. Shaina as well as Vaishali, good afternoon, and thank you so much for joining us on the show as always, and happy Friday to both of you all. Vaishali, before we jump to the queries, a check in terms of 26,100 levels for the Nifty. If we manage to close above that, what is the trajectory now for the Nifty? What are we keeping an eye out on?
Hi, very good afternoon, Vinny, and thanks for having me. Well, market has been a bit choppy, but broad-based, the index has been showing a lot of strength. Today, we saw a weak opening, but I think near-term basis, 26,000 is acting as a good support. And hoping that we close about 26,200 levels, we would be expecting a further target of 26,400 to 500 in near future.
Okay, we'll keep an eye on those levels over there. Thanks for that, Vaishali. But let's get started with those queries then. And the first query for today is coming from Nitin Agarwal, who's writing to us from Noida. He's holding 900 shares of Biocon, and this is at a price of 374 rupees per share. Currently, the stock is at 400 rupees per share. Now, he wants to know the long-term story for Biocon. Is it a good bet, and should he continue to hold this stock? Shaina, your view for Biocon?
I would suggest continue to hold. Basically, if you look at the very short term, yes, valuations may look a bit expensive. But if you look at it over a 1 to 2 year period, they start looking more attractive. On an EV by EBITDA near term, it's expensive, like 20 times. But if you look at, let's say, compare it to the turnover, so it's about just 3 times, which I think for the quality of Biocon, its manufacturing facilities, management, it's not expensive. Having said that, I would still take FY26 as a year of consolidation because this is the time where they're actually repaying a lot of debt. There is likely to be a merger of its subsidiary within itself, Biocon, in the second half. So I would take this as a year of consolidation and continue to hold. We saw the second quarter numbers, they were very strong. And I would believe the biosimilars will continue to drive growth even going forward. They have got good products, like they've got almost 5 products of biologicals in the US market as of now. And there, the market, they already got more than 25% market share in most of them. So I would see this area, well, prices may remain a bit soft in biosimilars, but that does not matter. I think they are going to do pretty well if you take a 3-year time frame. So I would remain invested in Biocon.
Continue to remain invested. A lot of fundamentally positive moves that will come in from the company as well. And biosimilar, Shaina saying that will do well. Vaishali, your view on the technical front. What are we keeping an eye out on over there, right? In the last 1 year, when you look at the 52-week range, around 291, 300 to 400. In that range, what the stock has been moving in this 52 weeks. What are we keeping an eye out on going forward? Is there an expectation of an up move now?
I would say when I'm looking at the longer term charts and all, of course, the stock has been showing a lot of strength, but it was just vulnerable with few days back. We just saw some negative report coming in. So we saw a little bit of a dip. But when I'm looking at the longer term horizon, I think this stock is ready to make new highs soon. For now, I would expect a range of 370 as support and 420, 430 as the target resistance. But I think once we see the stock moving above that, and I think chartically it is not in an exhausted state. So I feel there is scope for an upside. One should stay invested.
Okay, should stay invested. That's a word on the fundamentals and technicals. Next query for today, we have Tanai, who's writing to us from New Delhi. He's holding 100 shares of Suzlon. Price is 59 rupees per share. Should he continue to hold or now sell this one? He's making some bit of a loss. Shaina, your view?
Well, here I believe that the stock, if you look at it over a 3-year time frame, is giving you such a good return, and it has actually made the near-term valuations pretty expensive. So I would take part. I mean, he's making slight loss, so I would take book half of my loss now and hold the rest for long term, because I believe the valuations even for the next 1 odd year is likely to remain on the higher side. If you look at it, EV by EBITDA FY27 20 times, price to book 10 times. So I think this expensive valuation will likely to keep the stock. You may have a time-wise correction rather than price-wise correction. And order book is strong. They've got more than 6.1 gigawatt order book on hand. But competition is also increasing, especially in solar, coming in from solar. So all these factors, I believe, would keep the stock, the upside a bit capped.
Okay, so we'll keep an eye on those factors over there. Thanks so much for that, Shaina. But Vaishali, on the charts and technicals, what are we keeping an eye out on, right? Because the company has seen, in terms of a stock move, its fair share of ups and downs. And right now, overall for the year, it's down 15%. What should we now keep an eye out on?
So, well, near-term basis, the stock is definitely showing some weakness. I think this can drag down towards 53 odd levels. But on a broader picture, I think 450 acts as a very good support. So the view is positive as long as the levels of 50 are held on. And I think once it gets into a momentum and goes above 63, 65, this can call for a further upside. But if the level 50 for a long-term perspective breaks, then that would negate my view, and this would get into a further selling pressure. So for now, it's definitely a hold. For a longer-term horizon, 50 should act as a support.
Okay, we'll keep an eye out on that. 50 should act as a support. That's what we'll watch out for. Let's move on to the next query then. We have Rahul Malhotra, who's writing to us from Pune. He's holding 200 shares of Praj Industries. Price is 300 rupees per share and wants to know the long-term view on the stock. So he's bought at 300. Stock is trading 336, making a profit. Shaina, your view?
Well, if you take a longer-term 5-year view, the stock has really not given you any return to an investor. And there are a lot of issues over here. There's execution problems. They have actually, they're not able to absorb the higher raw material costs. It's impacting their overall margins in a big way. So even if they're able to maintain their revenues, which were actually disappointing, in fact, not too much of growth, but their profitability is getting impacted. The only upside that is possible, if at all, is in case the government increases the price of molasses, then you may see a bit of sentiment upside. Having said all this, I would say it is better to switch from Praj, look at some other stock or investment for investment.
Okay, we'll surely keep an eye out on that. And Praj Industries for you, would you say hold on to this or maybe look at some other bets here?
I would definitely say give it a miss because, this stock has gradually seen erosion right from 850 to 900 levels and now 330 levels. So even if I'm looking at a daily chart or a weekly chart, there is no sign of revival for now. Only consolation is that, yes, it's in the deep oversold zone. So we can expect a bounce, but I don't think it makes sense. That would be wishful thinking. Give it a miss.
Okay, give it a miss instead of having those wishful thinkings. Thank you so much for that, Vaishali. But let's move on to the next query. We have Tina Gupta, who's writing to us from New Delhi, holding 110 shares of ONGC. Price is 75 rupees per share, making a good profit on this one. Now wants to know whether they can hold this for the long term and actually look to add also at these levels for the long term. Your view on this one, Shaina? Looking to add more?
Well, I wouldn't suggest to add. In fact, he has gotten at a very good price. I would, in fact, suggest take some profits off the table. There are a lot of other strong PSU stocks which have better potential over the next 3 to 5 years. You can look at something in banking, something in defense, equal quality. See, ONGC, I would believe that crude oil prices have come off if you even compare it to last quarter. Last quarter, the average selling was 67 BBL. Now, currently it's ruling, I would say it'll rule between, say, 58 and 62 dollars per BBL. Now, to that extent, we do not know how the quarter will end going forward or the year will end, but I think it's going to remain weak. Also, the October numbers in terms of production were not that good. We saw some bit of decline in terms of overall production. Valuations, of course, I mean, I don't want to sort of make any comment on it. It is, of course, not expensive, but I would still say that you switch.
Switch is the word coming in here. And for you, Vaishali, ONGC, what should the viewer do?
I totally agree with China. Actually, even on a chartical view, if you see, the stock is really not participated. It has just been for the longest in a narrow range. So for now, I would just say it is just a range of around 235 to 260, 270. That's what one can expect at the most. So, well, I don't see any strength for now.
Okay, don't see much strength for now for ONGC. Switch is the word on the technicals and fundamentals. On that note, we're going to actually sip into a very short break, viewers, but an update for you all as we sip into the break, because in a big news week dominated by the Bihar elections, CNN News 18 continued to reign as the undisputed leaders in English news. The channel stood significantly ahead of the competition combined, and a feat testament to the faith responded by the viewers in CNN News 18. Welcome back to your stocks on CNBC-TV18. As of now, Nifty continuing to hold under 26,140, 150 levels around that mark. Let's keep it going then with the stock-related queries, right? We still have Shaina Mukaddam as well as Vaishali Parekh with us. Let's keep it going then. And the next query for today is on two stocks. This is Bajaj Housing Finance and Piramal Pharma. Now, Siva is writing to us from Hyderabad. He's holding 175 shares of Bajaj Housing Finance. Price is 128 rupees, so they're making a loss on this one. The other one is Piramal Pharma. 65 shares they're holding at a price of 195 rupees per share. Piramal Pharma, not Piramal Finance. So they're holding Piramal Pharma. Now, he's asking if he can hold the shares for a time period of 6 months to 1 year. What's your view on this one, Shaina? Piramal Pharma, Bajaj Housing Finance, both of them.
I don't think he's going to make too much money. In fact, he may not make any money in the next 6 months on either of these stocks, even from current levels. Though both the stocks have, been a bit soft if you take a little longer term period. Bajaj Housing Finance. In terms of valuation, it is quite expensive compared to the rest of the housing finance companies, and it's price to book of about 4 times. And other than that, the expectation was that post the IPO that they listed and they got funds into the company. The expectation was they will do double the growth that the rest of the housing finance companies were doing, which is around 13 to 14%. But if you saw last quarter numbers, instead of 25%, I was a bit disappointed to see that the growth is now closer to the rest of the housing finance companies versus the expectation. So I believe that the stock will consolidate around time-wise correction is likely for the stock till we see some good numbers start to come in terms of overall growth. Management, of course, is strong. Now, the similar cases with Piramal. They had restructured their operations in 2022 where they had demerged their business. Now, from that time, the performance has been very erratic. Last year, they ran into huge losses. Now, even this first half, they have actually done a net profit loss, but on the EBITDA levels last quarter, second quarter, they have turned profitable. But I still believe in terms of valuation, compared to the market cap of close to about 25,000 crores, the revenue, the ratio of turnover to market cap is quite expensive. So I see both these stocks, Piramal Pharma as well as Bajaj Housing, not move too much from here, at least for the short term.
Okay, not too much move expected here from the short-term point of view. Vaishali, your view on both the stocks, Bajaj Housing as well as Piramal Pharma. What should they be doing? 6 months, 1 year, targets, anything?
So I would not recommend a buy, but if one is holding, then I would say for Piramal Pharma, of course, it has been a laggard, but I think technically it is well placed. So if one has to exit, I would suggest exit, wait for a bounce at least up to 210 to 20. That would be a level to exit this stock. And in fact, if the stock goes above 220, because as such, there is no negation on the chart. It's just been in a narrow range right from I think to nearly for 6 to 8 months, right, within the range of 180 to 200, 210. So, one should hold and have a relook at 200, 210 levels. If this sustains above that, then I think perhaps it could get into a good momentum and go towards 230, 240. So not in a hurry, but I would not recommend a buy at this level. And as far as Bajaj Housing is concerned, well, that too is showing a lot of weakness. So I would not say that it's a buy, but wait for a bounce to exit.
Okay. We'll keep an eye out on that. Wait for a bounce to exit there. So keep an eye out on those, bounce. If there's anything that comes, you can look to exit the stock. Next query for today. This is from Anandi R, who's writing to us from New Delhi, holding 100 shares of two FMCG companies. One is Jyoti Laboratories at a price of around 495 rupees per share, 100 shares there. The other one is HUL, 35 shares at 2,800 rupees per share. Wants to know if we should book the losses or switch to some other stock. Shaina, what's the view coming in? FMCG, staples, given the boost that we've seen in the recent times, it's expected to do well. But both these stocks, should they continue to hold?
Well, HUL is expected to do better in the second half in terms of volumes because, we saw the last quarter, the revenue was flat. Basically, GST instead of being a positive was actually somewhat of a negative for them. So that actually the volumes will pick up in the second half. So, and also the demerger of the ice cream business, which I think an investor should hold on for because they'll get one share of the ice cream business, and I think there is value unlock over there. In for Jyoti Labs, I would say it is better to exit. They are not doing well in their in either of their dishwashing segment as well as the insecticide segment. They have actually reported flat revenues if you saw quarter numbers, and margins under pressure. The costs were higher. So I would say even in terms of valuation, it is expensive. So it is an exit.
Okay. We'll keep an eye on that. Bit expensive in terms of valuation for Jyoti. So that is where the exit comes in. Your view on both these stocks, HUL as well as Jyoti Laboratories, Vaishali?
HUL, I think technically it is very well placed right now. It makes it a favorable risk-reward ratio. So if this person is making a loss, I would suggest to average out at these levels. Keep a stop loss of 2350 because that makes it a very favorable trade. And this could take the stock up towards 2600 levels. So I guess for now it's a hold or perhaps add more at these levels. And the other one you asked me is Jyoti Labs. Well, there's nothing really happening in the stock. It is not shown any trend. It's just a sideways move. So I would say avoid this stock.
Okay. Thanks for that view there. Let's move on then to the next query. Deepak Joshi is writing to us from Karnataka. He's holding 300 shares of NBCC. Price is 70 rupees per share. A long-term investor and wants to know whether to hold or sell and book out their profits. Your view on this one, Shaina?
Well, he's gotten at a good price. And I would say you can continue to hold because, the problem over here is not their order book. They have got a huge order book of about over, I think, 1 lakh crores. But there they have got, and even the recent one actually, which saw some momentum come back into the stock, is the big order. They got 3,700 crores from Rajasthan to develop area around the Jaipur airport. So these are all positives. But in terms of pure valuations, I think if you look at it in terms of EV by EBITDA, it's about 30 times. So this actually, in my view, will limit an upside in the stock over the next, say, 6 months to 1 year, unless they show a major improvement in operations and numbers. So I would say take a slight up, wait for a slight bounce, maybe 10% higher, and then you could switch.
Okay, and on the technicals, your view, Vaishali?
Well, the stock has been showing some momentum since a few days, but it's just oscillating. So 110 is acting as a very good support, 108, 110. And we are waiting for the stock to move past 119, 120. Once that occurs, and if we sustain about those levels, then I think the stock is going to witness some strength and we can see a target of 135 to 140. So let's wait and watch for some time. I think the stock should participate from here on.
Okay, we'll keep an eye out on those levels over there for NBCC. Wait and watch right now for the stock. But, that was the last query for today. So, Vaishali as well as Shaina, thank you so much for tuning in as always and helping us solve all those queries. Hope you all have a great weekend. And viewers, thank you so much for tuning in. Remember, please email us your queries on the email ID that's at the top of the screens for you all. And we'll get them answered Monday, Wednesdays, Fridays at 2 p.m. on your stocks. But with that, we'll wind down the edition of your stocks today. Up next, you have Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng trading with cuts up almost 1.7% as well.
Don't sell just because there's a bubble.
There are two things in favor of India as we start trade. This gush of liquidity which is coming into mutual funds, and mutual funds can't sit on cash, they've got to deploy. Second, of course, is this anti-AI bit. A third lowest, 26,120 is where we're at.
The global macro environment is somewhat different than what India is witnessing at this point of time.
The resale market, which I've always maintained is a very secular indicator of how the market is going on, continues to be very bullish and very strong, at least in our micro markets.
Businesses are going to grow multiple times in this decade, and we are very, very positive and optimistic on every business that we are in.
This is the third fire in a matter of around 2 months. Year-on-year basis, revenue is down by almost 9.5%.
It's a 100-point downtick on the Nifty as we speak after touching that 52-week high level yesterday.
Going forward, over FY26 to 30, that outlook in the range of 15 to 40%.
Bank Nifty, that also saw some recovery, but that got sold into yet again. So it's a 0.6% cut on the Bank Nifty.
Okay, it's somewhat similar to where we were when we started in the morning. 40 points lower, off the low point of the day. But, I mean, as you saw the clips describing the trading action through the day, and I think that as the intraday shows you as well, there's been ups and downs, and basically the market not really going anywhere. Market breadth is definitely negative. 850 stocks are higher and about 2,150 stocks are lower at this point in time. So that's the overall picture as far as the Nifty NSE advanced decline is concerned. This is Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Nigel. Nigel, hi.
Well, hi, Prashant. Not too bad looking screen, actually. Someone had told you in the morning, look at the Asian markets and looking at other, the way US markets ended as well, and we'll be down 0.1%. I'll tell you what, the bulls would have grabbed it, and also if you're, yes, the breadth of the market isn't great, but it's still pretty okay. And it hasn't worsened, actually. You're still in that, 1:2, 1:2.5 or thereabouts. So that, the ratio has remained constant pretty much. So not such a bad trading session. You'll want the broader markets to participate. But first, the global markets need to stabilize a little bit. Then we can go to those fresh all-time highs and then hope that, a larger number of stocks do participate.
Absolutely. It's a quieter kind of session today. I'm just looking at the biggest volume-led gainers. I can maybe count 10, 12 names. That's it. With large volumes and large price action. So it's otherwise, I mean, it's a very, very vibrant screen out there. Not so much today. So maybe just a few names, right? Maybe and we don't talk about this one at all. Aztec is up 10%. It's the number one volume-led gainer on the NSE right now. McLeod Russell, 13% gain. Second largest volume-led gainer. Karnataka Bank is coming up with a 9% gain. Apex Frozen Foods is up 18%. Just a bunch of these names. Sorry, that is McLeod, not McLeod. I'm sorry, beg your pardon. Which I was referring to. DCM Shriram is up 8%. Sharda Crop is up 5%. Anupam Rasayan has been strong from the word go. There is Aether, which is up 3.5%. Hindware is up 5%. And that's it. I mean, that's basically the 6 or 7 names which I mentioned, which have got large volumes in it. Otherwise, I mean, it's kind of a quieter day, so to speak. Just quickly running you through what's on the the next hour and what you will see. So stocks, of course, recovering from the day's low, market rebounding. But of course, as we've been saying, still trading with slight amount of losses. Market breadth is negative. We'll talk about Grow, right? Reported numbers, first earnings after the listing. Stock was up about 5-6%, is sold off about 1% higher, but something which we will talk about in some detail. Hindalco is one of the top Nifty losers. Nigel has been telling us about that, so we'll get a view on that as well as we go along. And, brokerages on Mahindra and Mahindra, that's been the top story, and you heard a whole host of top leaders from the Mahindra Group talk to us earlier. So we'll play out those sound bites and, of course, get you that perspective as well. The other story which we will tackle and get your views on, of course, it's a Friday, right? I mean, 2 days now, the US market is kind of sold off. Actually, only yesterday's sell-off, I think, is more, in that sense, important because people were looking for the Nvidia results to basically answer the question if the coast is clear. But obviously, the coast is not clear. So what will US session later tonight hold? And I think that's like a unknown out there going into this weekend. How should you position yourself in this last hour of trade? Nagaraj Sethi is with us of HDFC Securities. Nagaraj, good to have you with us here. Thanks very much. What would you do?
Hi, good afternoon, Prashant. Rightly said, Nifty has been in a strong uptrend, no doubt about that. Higher tops and bottoms on the daily chart is indicating market is at a strong uptrend. So, though it is showing some consolidation at the higher levels, there is a resistance around 26, 150, 200 levels. I'm not expecting any bigger decline from here onwards. The consolidation momentum by today, or at least by next session, Monday, we could see eventually Nifty bouncing back from the lower levels and could breach above the recent high of all-time high of around 26,277 and higher. I'm expecting Nifty to move towards the 26,500 levels in the next few weeks.
Okay, sounding bullish then, Nagraj. What about individual stocks?
Yeah, I have two stocks from a banking side, particularly Bank Nifty and Midcap banking side. I'm bullish, though my Bank Nifty is showing cut off around 0.5%. I'm expecting outperform in the near term. So first one is the Ujjivan Small Finance Bank. Chartically has been in outperformance over the last few months. Largely higher tops and bottoms indicates the overall strength of that particular stock. Currently trading around 54.25 levels. It has broken above the consolidation phase, and I'm expecting this to move up towards the 57.50 is going to be the next target. One can look to buy at this point of time around 54.25, 57.50 is going to be the target, and one can place a stop loss at 52.50. Second one is from Mahindra and Mahindra auto space. M&M has been a constant uprun over the last many months. Higher highs, higher lows indicates that the stock is in a near-term uptrend for the long term. So currently it plays around 3755 levels. The overall chart pattern, including volume breakout during upside breakout as well as RSI, is indicating more positive bias. One can look to buy at this point of time, currently around 3755 levels. Upside target would be around 3950. One can place a stop loss at 3625 levels.
Okay, all right, Nagaraj, thank you very much for that. We'll come back to you in a bit and get some more trading ideas. For the time being, let's focus on the newsmakers of the day, and Grow is definitely in focus today, not because of the stock price. You don't have a sharp up or down reaction on Grow today. It's actually a fairly calm session, at least for now, 1% up. The numbers for the second quarter are out. How do they look? Let's ask Vivek. Vivek, over to you.
Well, that's right. So 60% higher since listing, and all eyes on India's largest discount broker as to how exactly quarterly numbers would pan out and whether they could live up to the kind of stock performance that's actually come about. Now, immediately post the results, the stock actually popped up 5%, but it has cooled off since then, and let's understand why. First up, number one, when you're looking at the results on a year-on-year basis, the revenues have actually gone down almost 9% on a year-on-year basis, and this is a bit of a concern. However, aided by lower operating expenses, aided by lower costs, actually you're seeing the operating profit. Now, operating profit here is measured without the interest cost. That has actually improved both on a year-on-year basis as well as on a sequential basis. In fact, both year-on-year as well as on a sequential basis, the operating margins have actually jumped up higher. And profitability on the back of that, both year-on-year as well as sequentially, has gone higher. But the key thing to watch out for is the fact that, during the time of listing, the management told us that FY26 is going to be a year of growth, and they're expecting to see a top-line growth in the range of 25 to 30%. But at the end of H1, it's actually been a bit of a degrowth as far as Grow is concerned. So there's a lot of heavy lifting to be done as far as H2 is concerned in order to go ahead and meet the management guidance. Also, when you're talking about cost, the management had said in tandem with the growth that they're expecting to see on the top line, they're expecting operating costs also to go higher. So it'll be interesting to see how exactly H2 pans out, and also what the management guides for, especially as far as the investor call is concerned.
Okay, all right. Thank you for that, Vivek. Let's take this forward. We have Deepan Mehta joining us as always. Deepan, great to have you in. Now, we've discussed this dynamic move that the stock has shown since listing quite often. But right now, the question is really on growth. Whether the numbers, at least on a fundamental level, justify a buy, and then at what price to buy is the second part of the question.
Yeah, Sabhi, good afternoon, and thank you for having me on the show. I think that Right now, in my opinion, the stock is fairly valued. And I was very positive on the IPO and I thought it would list very well, which it has. But right now, I think seems to be fairly valued. There are some headwinds, and always that risk factor is there about any SEBI regulation, which will curb F&O trading. But Grow is gradually going to grow into other asset classes, into other financial products. And the real strength and the asset of the company is the number of users which are already registered with them. They have done the KYC, they've got the demat accounts, and still they are growing their market share as well. And that's a really valuable proposition. And I would rate that as one of the key factors to keep the stock in mind. And maybe at corrections at reasonable valuations, one could look at it. Over the next 3 to 5 years, it will definitely transform itself away as much as possible from F&O trading to more broad-based annuity type of businesses. We have seen that happen in Angel One. We have seen it happen in Motilal Oswal as well. I think Grow will follow the same story, but at a much larger scale.
Dipan, good afternoon. I think you had mentioned right about Nvidia's the way it's trading at around 40 times and 2.5 times. Last evening I hear from source-based information that Mr. Jensen was trying to get in touch with Dipan Mehta and thank him for the idea. A probable listing in India. Take some more money off the table. Kidding on that front, Dipan. Let's talk about not Nvidia, but Novelis. Because last night there was another fire that was reported at their Oswego unit, which is in New York. They reported, remember, a massive fire in September, a smaller one in October. So this is the third straight fire that we've seen in a matter of 2 months at Novelis's Oswego unit. Now, the management commentary in October was that they plan to start operations in this affected part of the plant in December itself. They also mentioned that there will be a cash flow impact of around $550 million and the EBITDA loss could be $150 million out in the second half of the year. They said there'll be pain in the second half of this fiscal, but in FY27, they'll recover most of it because most of it is insured, so 70 to 80% recovery is what they guided for. Hindalco put out a clarification a couple of hours ago. They're saying that everyone working at the plant was safe, evacuated, there were no injuries. That's the best piece of news actually to hear, that no casualties, no injuries. That's good news. And multiple local fire departments out there have responded. Crews remain on site to monitor the situation. So for the time being, there's a pullback in the stock because the street is wondering whether or not that December deadline will be met. And why exactly are we seeing so many fires at this particular unit? Ford, for one, will be impacted. But from an India shareholders' perspective, they know the second half of the year is going to be a washout, but resumption of operations is going to be crucial for the way forward. Dipan, what's your view? Aluminium is doing so well. It's been quite strong. The dollar has strengthened a little bit, which could cap the pricing on base metal prices. But what's your view? Hindalco has been a decent performer. If you want to play aluminium, would you now rather look at Vedanta? Would you rather look at Nalco?
I think that broadly we are seeing metals doing very well. And Hindalco, eventually, I think Novelis is a very key asset because with higher tariffs in US, certainly they would have a competitive advantage as compared to imports. And the local business of the domestic business also is doing very well because of higher realizations. And valuations are reasonable, I would say attractive at sub 10 times or so. And expansion plans also going on stream in India as well as Novelis in US as well. So broadly, I think that it's a stock one to remain invested in. And if you get the cycle right, then maybe you could invest at the bottom whenever that is. But on the whole, I would remain invested and generally have a more positive view on metals per se because of valuation and because of the way I think the entire system is playing out, where hard assets are giving preference over some of the financial assets, and that process may continue.
Dipan, the Mahindra investor meet, of course, has been something we've been tracking closely. I just want to play out sound bites of the interaction that Shireen had with the top leaders at Mahindra and Mahindra. These are, of course, targets which Mahindra Group Chief Anish Shah laid out in that interaction. Listen in.
Auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly, and farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores. in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to grow. We are building on a very strong foundation, and we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade, from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespace is 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
I mean, those are big numbers, right? I mean, we're not talking about percentages, but number of times growth. Well, we can cast the entire conversation at 5:30 p.m. tonight, today evening, and 9:30 p.m. tonight. So that's an exclusive, and it's a big one. Deepan, my question is not so much about Mahindra and Mahindra, but I mean, you know, sometimes I remember we had this conversation with Sanjeev Goenka, and he kind of, this is not the last one, but the one before, I think about a year and a half, 2 years ago. A similar big picture kind of conversation, and Mr. Goenka, I remember, laid out targets for individual businesses. And stocks actually responded in a big way. From that point, actually, Deepan, leave Mahindra and Mahindra, the auto business aside, anything else you'd look at it? You know, there is Life, there is Holidays, M&M Finance, of course, is there as well.
Yeah, Prashant, of course, I think very positive interview and very positive statements coming from Mr. Anisha, who's been extremely positive for minority shareholders. I was just checking since April 21, or rather last 3 years or so, the stock has given a compound return of about 44% or so. So great value creation in the last 3 years at M&M. But apart from the automotive company, there are two other companies which show a lot of promise. One, with usual disclosure, we are invested in them. One is Mahindra Holiday, and they have announced 1,000 crore entry into leisure hospitality. So there also we are seeing a change in the business model. I thought the company was always playing well below its potential, but now maybe things may change over there and they get more aggressive. And I think it's reasonably valued also given the M&M brand and their corporate governance standards and other aspects. And M&M Finance, I think after many, many quarters, I think September quarter was a bit of a relief, where they actually showed very decent performance, and some of the issues related to NPAs, those seem to have been resolved. Of course, the industry has done very well, and the real problem starts or challenges start when the industry starts to go down, which we have seen M&M Finance not able to manage well. But amongst all the other companies, of course, M&M remains the prime mover. Amongst the other M&M group companies, most positive on Mahindra Holiday and M&M Finance. Again, a disclosure, we have investments in all these three companies, so our views could be biased.
Okay, all right. You know, and in fact, Mahindra Holidays, I think from the peak that we saw in 2024, it's come down considerably. But that's what Deepan is positive on. And just going by the kind of demand for the end of year as well, most resorts are almost booked out there. So could be a stock to track as well. By the way, just the big story is not this market, but it's the rupee.
Yeah.
I think that should come up for you on the screen. There's been a sharp drop in the rupee. There's weakness being seen on the rupee. It's moved to around 89.3.
Whoa.
Big move is what we're seeing out there. I think we'll get Lata in just a bit to tell us what is she picking up. But there's a massive surge. Just take a look at the way the rupee has moved actually. 88.6 to around 89.35 or thereabouts. I'm not sure whether or not there is, you know, any kind of fat finger or something that's involved in this. But there's a very, very sharp depreciation. So it's at a record low, and you know it's suddenly moved. And in fact, it's continued. The last tick actually is 89.45. So there is some weakness that we're seeing in the rupee.
I mean, you know, it's moving like a small cap, right? I mean, you don't see even stocks moving like this. Just look at that. I don't remember seeing a move on the rupee like this. I'm not sure if there's anything which has happened. what could happen, right? I mean, there's no, and we'll of course scan the wires, etc., to see if there is any news flow per se, and of course we would have put it out so far, but it's a pretty unprecedented move that we have, and we'll try and get some perspective in terms of what has happened. Has the market got some sense of what? I mean, the US-India, the deal, I mean, but it'll show up in equities as well, but this is a 70 paisa move on the, against the rupee, which has come through. So
there's
at a
also
record low.
some move on the dollar. Maybe we can pull up the DXY. It's volatile, but in a percentage sense, I mean, nothing compares to what's happening specifically on the dollar rupee. The dollar continues to hover around the 100 handle.
But the dollar actually is weakened a little bit, because it went to 100.5 in the last few sessions, and now, in fact, it's come down to around 100. And the rupee actually was more or less steady when the dollar was showing some strength. And suddenly that's given away.
So that's what there doesn't seem to be a massive dollar surge in the last 1 hour. That's exactly what I'm saying. It's been more or less range bound around this 100 handle, for the better part of the day. So this seems to be a rupee specific move. And we're going to be getting you more on this as we go along. As far as the equity screen goes, I mean, that's where the picture is more or less, similar to what we've been tracking. Still about 70 points lower on the Nifty. So not too much changing there. But volatile for the better part of the day today. Let's do one thing. We'll take a break, come back on the other side, and we'll have with us Venkatesh Balasubramaniam from JM Financial Institutional Securities. We'll get a perspective on the market. Welcome back. The equity screen is still wobbly, still about 100 points lower on the Nifty. Let's bring in Hormaz. And actually, there's a decline on the equity front also. That's quite evident for the time being. Need to see if the day's low holds or not. So as we're looking at the screen, that's the Rupee. At least the slide seems to have stemmed. But we still need to figure out what exactly transpired over there. More on the Rupee in just a second. In the meantime, let's go across to Hormaz and talk about the day's big movers and shakers. Over to you, Hormaz.
Final few minutes of this week in the trade, and there are, of course, enough and more names that are buzzing in today's trading session. And start off with this name called Dharmaj Crop Guard as a recent listing. It's the third straight day of gains, and because of this move, the stock is set to snap a 6-week losing streak today. The stock is trading at the highest weekly volumes in 5 months in this week so far, and in today's session, we have had over 2 lakh shares that have been traded. The 20-day average comes up to around 60,000 shares. And as a result of this 3-day up move, the stock has gone back above its IPO price of 237. Now, the smaller private banks doing well, joining the list today is Karnataka Bank. And the biggest single-day gain since June of 2023. The volumes are the highest since November of 2022 in today's session. More than 3 crore shares of Karnataka Bank have been traded today. The 20-day average is just around 25 lakh shares, and the stock has moved above all of its key moving averages, but has been a bit of a slow grind lower for Karnataka Bank, down 11% this year, was down 9% last year as well. Aztec Life Sciences, we spoke about the stock in yesterday's session. We are talking about it in today's session as well because it is building on to yesterday's gains. Now, 6 out of the last 7 trading sessions where the stock has gained almost 30% now in the last 2 sessions is Aztec, and today's volumes have comfortably crossed yesterday's volumes. And to speak of yesterday's volumes, they were the highest since February of 2010, and it has more shares traded in since that as well. Now, more than 1.5 crore shares have been traded today. The 20-day average here is only 3 lakh shares, but the stock has been a bit of an underperformer. It has had 3 consecutive years of negative annual returns, including this one. And shrimp stocks are taking turns to move. Avanti Feeds moved higher earlier this week, and today is the turn of Apex Frozen Foods. A 20% up move in today's session, snapped a 2-day losing streak. Today's volumes are the highest on record for the stock, with more than 1.5 crore shares traded here as well. The 20-day average is around 4 lakh shares, and the third straight month of gains for the stock, which has ensured that the stock has reversed all the losses of 2025, has turned positive on a year-to-date basis.
Okay, all right. Thanks very much for that, Hormaz. What we'll do is Venkatesh Balasubramaniam, MD and co-head research at JM Financial Institutional Securities, is with us from the sidelines of the JM conference. Venki, good to have you with us here. Good afternoon. Okay, I think we lost the line, but in any case, what we're going to do is talk about the Rupee, and that's the top story. So let's just have the intraday up, please. 89.45, and that's a massive move which has happened all in the last 15-20 minutes of trade, and I can tell you that pretty much everyone seems to be scratching their heads. Some feedback that RBI did not intervene. The whole street is short, hoping for a trade deal. But this is, of course, conjecture, and we don't exactly know what has happened. Lata is here, who's also been making phone calls. And Lata, anything you're picking up?
Well, the only reason why everyone is pointing to the fall in of the rupee is that the RBI was not there at 88.70 to 88.80. Until now, every time the dollar became that expensive, the Reserve Bank has come in and supplied dollars. The fear was that if it crosses 89, it goes to 90 very quickly. But Reserve Bank is there at that point, and probably everyone knows there is a trade deal round the corner. The market was not attempting to break that barrier, also because a lot of people have sold dollars against the rupee, sold the dollar rupee, as it were, expecting that the rupee has already, discounted all the bad news. But there are people who are sitting with open positions outside above 89. Importers don't have enough dollars. And the fact that Reserve Bank allowed that Lakshman Rekha to be crossed has led to quickly importers coming in and buying because they're completely uncovered above the 89 mark. This is dealers just screaming at us, saying bad policy on the part of Reserve Bank. They could have allowed a graduated fall. They would say that because their books are bleeding. But there's only one answer to this issue. Until now, at 88.70, 88.80, the Reserve Bank was supplying dollars. Today, in the last 10 minutes, it has not supplied the dollars, and therefore the currency is now trying to seek its own level. It's very difficult for the market to come and take the other position when they have just started bleeding from the 88.80 mark. The support will have to come from an external force, which is the Reserve Bank. People were expecting at 89.35, 89.40. They keep telling me every second that maybe it's 40, maybe it's 45. Now, of course, everyone says maybe it's 89.50. But only an external force can stop this because the market is extremely uncovered, unhedged above the 89 position.
Basically, people were short the dollar, expecting a trade deal. And,
And the stop loss got triggered at 88.80.
As you said, there is a lot of positions. So that covering essentially going into the weekend once stops, etc. took out. Let's get Jamal McCly, Managing Director at McCly Financial Services. Jamal, good to have you with us here. Thanks very much. I mean, if you're watching the screens, if you heard Lata and the discussion here, your thoughts, what's happened? Jamal, are you there? Jamal, are you there? Okay, I think we lost the line. So we will try and have him back. But let's get in. Do we have Venkatesh? Do we have? Okay, I don't think we have Venkatesh either.
But very, very surprising fall, right, Lata? And I think some optimism that we're going to hear about that trade deal, which hasn't happened. You told us earlier this week the trade deficit was rather weak. Now you don't have RBI that's present at around that 89-odd mark.
Fundamentally, there are many reasons why the rupee should weaken and dollar should become expensive.
But the trade numbers came a couple of days back. I mean, this cannot be a slow reaction to the trade numbers, right?
Well, you keep worrying that foreigners have not entered. We saw 2 days of net foreign inflows, but it looks like today it will be an outflow because there is a general equity market.
We have Mitul Kotecha joining us, Head of Forex and EM Macro Strategy, Asia at Barclays. Mitul, good to have you with us here. If you can comment on the move that we are seeing in the rupee now and what's causing it.
Right. Yeah, look, I think as has been highlighted, it does look like this pent-up demand for dollars has finally come through. We have seen the RBI, at least up until now, holding a line in the sand just below, obviously, the 89 level, and clearly that's broken today. Obviously, there's speculation on what's driving this and whether this is importer demand picking up and driving this move through there. I think probably a surprise for a lot of people is where the RBI is at this point in time, and whether they will come in now and reverse this move or dampen this move. Generally, we are seeing illiquidity in markets at the moment. We've obviously had a pretty tough risk-off session in U.S. markets overnight yesterday, and we're seeing general broad dollar demand coming through across the board. So this is partly reflecting that as well. But clearly, I think this move has taken many by surprise here. And as I mentioned, generally the fact that we've not seen that cap hold that we've seen in recent weeks has also perhaps been something that has caught investors out.
Hi Mitul, thanks for taking our call. If the Reserve Bank doesn't step in, you think that the rupee fall can be severe, much more than what we are seeing now?
Well, look, I think it's already spiked quite sharply. I would be very surprised to see this RBI let this go to the extent that it just completely moves into sort of a much sharper decline from these sort of levels. But again, they may be waiting, and again, we're speculating here, but they may be waiting for rupee to find sort of a clearing level. There's every chance you could see exporters coming as well, given these sort of better levels from their perspective. And, I think obviously, as I said, some of this demand has been pent up given what we've seen in recent weeks. So perhaps once you let the air out of this move, we could see a bit more stability.
Is this, Mitul, if we don't know what happens tonight, right? I mean, US, the markets look a little wobbly. If there is a risk of NASDAQ is already down 7% from the highs, it could extend. And that may mean people moving into a safe haven like the dollar. You think that there is that anxiety as well, maybe, at the margin?
Yeah, look, absolutely. I think that is afflicting across Asian markets at the moment and global risk assets. In reality, as you said, we've had AI nervousness, and that has exhibited itself in weaker tech stocks, and certainly some of the key AI stocks have been under pressure. And if that continues, it could lead to some more safe haven demand, and that would probably drive the dollar higher. And we're seeing that again on many currencies. And but I think there's also a sense that we're going to be moving towards the end of the year. Markets are starting to already looking a little bit illiquid. That's not helping as well. So I think there's a number of factors at play here.
We heard yesterday that there is a large amount of traders and treasuries who are betting short on the dollar rupee, on the expectation that all the bad news is priced in and there is a good chance of the deal getting announced, of a US-India trade deal getting announced sometime soon. Is that true, that people have moved short on dollar rupee? And in that case, that's the stop loss that's gotten triggered?
I think that's fair. Investors had been sort of positioning at least for some sort of a rally in the rupee on the back of any potential trade deal announcement with the US. And I think that the general consensus is that would at least see some appreciation of the rupee, albeit in our view, it could have been more of a knee-jerk move. But I think investors have been positioned that way. Hence, the sell-off is probably a little bit more extreme because some of these positions are probably being stopped out as we speak, given that positioning that was going into this. And look, you still can't rule out a trade deal announcement coming through in the days ahead. And if that is the case, you could see some reversal. But at least for now, the fact that we haven't seen a trade deal yet is also something that could be playing negatively on sentiment.
Absolutely. So actually, that's my question, Mitul. I mean, whether you will see today's high drama on the currency purely a technical issue, the technical factors that we've been discussing, positions being closed out, and the dollar shots having to adjust their positions. Is it purely technical, or would you read more into it and then say maybe this is a hint of whatever is happening between Washington and New Delhi? That's my first question. Then I want to come to levels, because the RBI, as early as yesterday, the RBI governor made it very clear, reiterated that the RBI is not here to defend any particular level. So, I mean, looking at what's happened today, what would the range be? So, two-part question. Is it technical, or is it more than that? And then your range.
Look, I think it is largely technical. Fundamentally, the rupee is arguably already very cheap. Right, and we've written a lot about this, the fact that on a near and a rear basis, it's now cheap across the board and against peers. And there's no value in having much weaker rupee from here, especially given that it could also result in increased capital outflows. And this is something that's obviously weighed on the rupee as well, the portfolio flow aspect on especially equity outflows. But so I would argue that this is technical rather than fundamental. But at the same time, again, giving levels is very difficult here. We had been assuming that we'd see this cap below 89 hold. It's hard to now sort of pinpoint where we see a stop here. We'd actually expected at least some retracement in the rupee as we went into year-end, i.e. firmer rupee will still happen if we see a trade deal. But I think for now, it's very hard to see any reversal at the moment until this sort of demand, the stop-loss positioning starts to clear out, where we could see a bit more stability.
All right. Mitul, thanks very much. Good speaking with you, and good to get a quick take on what's happening here. By the way, some wire agencies, etc., are reporting that, and this is, of course, their feedback from traders, that the RBI has likely supplied dollars at near 89.50. And that's what's coming through from Reuters. There you go. That's at the bottom of the screen. What we'll do is we'll take a quick commercial break. Markets, by the way, we've been focused on the rupee, but just look at the Nifty as well. I mean, that's gone south, right? We started with a 40-point cut at 230, and it's essentially just seen almost coinciding with what we've seen on the rupee, on the currency, a sharp slide. And we're on 125 points. Take a break. We're back. We'll get a quick chatter segment going with Nimesh as well, with what he's picking up and some trading ideas after that. Stay tuned.
मत है।
Welcome back. Markets are down 120 points. The big action has been in the rupee market. For the time being, I think it's at least stabilized at around that 89.45 odd mark, 89.45 to 89.5. You know, that's the level right now. So hopefully it doesn't slip a little bit more from here. But let's hop across to Nimesh, who's here to tell us about D-Street chatter. Nimesh, what are you picking up with regard to the market? Anything on the rupee, if you picked up something?
Not really, Nigel. You know, that's not my domain.
Okay, we'll wait for Lata to come back. Tell us about the markets.
Okay. From a market perspective, while the Nifty is down, but you know, in the global context, I believe it's relatively outperforming today. But that's not the case. The bigger point seems to be the broader market underperformance. Even in today's market, the midcap index is down 1%. And as I've been saying for a while, right, when the Nifty has been outperforming, the broader market seems to be under pressure. And that's where the big pain seems to be. You know, every investor or trader seems to be sulking to the fact that while Nifty is heading towards an all-time high, their portfolios have not done well. Flows, again, a mixed day of trade. You've seen a bit of trend in the last few days of FI buying, and that might continue in today's market as well. But interestingly, Monday we are going to see the big inflow because of the MSCI changes. So that's something to account for in Monday's trading. As a sector, auto stands out today. Some bit of buying as well, but that's one space which has relatively outperformed. I want to discuss a bit on the broader market underperformance. I gave this insight yesterday as well. There are at least 38 to 40 mid-cap names which are under pressure for the last few days, and the reason is there is one big FII which is getting merged into another large entity, and because of that merger process, there are some 38 stocks which they own, whether they are looking to sell it out in the open market or through blocks. So, large liquid names are part of that portfolio, and maybe that's the reason why some of those mid-cap names have been under pressure for the last few days, and that's the trend today as well.
Got it. All right. Good explanation. Yeah, I recall you saying that, Nimesh. What about individual stocks, though? What are you picking up?
So the first stock on my list is Anupam Rasayan. Again, in a weakish broader market, this stock is relatively outperformed. This week, the stock is up 16%. This year, the stock is up nearly 80%, and big outperformance there. Of course, Q2 was strong, but I understand one reason could be that maybe the company is very close to an overseas acquisition. So that's the buzz as far as Anupam is concerned. The second name is GMR Airports. Big buying in the last few days in GMR Airports. Again, today there is very strong delivery-based buying. And I understand one leading long-only fund is an active buyer in GMR Airports in the last few days. The third stock is Indus Tower. Specifically for today, there's going to be in the last 30 minutes, MOC sell flow in Indus Tower at a leading FID. So maybe you'll see some pressure there. And the last name is Gujarat Pipavav. Again, in a weak market, that for the last few days, it's relatively outperformed. And that's largely because for second day running, I understand there are very strong delivery-based buying at a leading FI desk.
Okay, all right. Nimesh, thanks very much for that. The big story, of course, is the AI story, right? This is Nvidia CEO Jensen Huang essentially rejecting talks of a bubble in AI. This is, of course, the earnings call. Listen in.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Okay, that's the top boss at the company, which is the poster child for everything AI. NVIDIA at the center of a lot of things. And of course, a humongous market capitalization in that sense. 120 points lower on the Nifty, 26,074. Nigel.
Okay, all right. Well, let's go back to our market expert. Then we have Sudep Bandupadhyay who joins in. Hi, Sudep. Good afternoon. We were, at the start of the show, we talked about how the markets have outperformed, which is the case. The problem is, the broader markets have taken a bigger leg down now, just in the last 60 minutes or so. And the Indian rupee has suddenly slipped. You want the currency to be stable. That's something that will hurt you otherwise. What are you looking at? Do you think that this is a buying opportunity? Vast has underperformed. Do you believe there are plenty of opportunities out there? And if yes, name a couple of stocks.
Well, of course. If you are looking at the Indian markets from a long-term perspective, of course, there are opportunities. And some of these corrections, which do happen from time to time, gives you opportunity of buying stocks. One stock which I've been positive, which is the recent listing, is Grow. And I think we are just seeing the trailer as far as its performance is concerned. They are getting into newer segments. which will be significantly revenue accretive, whether it's margin funding, whether it's distribution of financial products, whether it's wealth management. I think they have the customers, they have the broking business, which is performing very well, and the quarterly performance also was very impressive. But going forward, I think they have a significant opportunity to scale up business and reward the shareholders even more. So this is one stock which I think is definitely worth buying from a long-term perspective. As far as other spaces are concerned, IndusInd Bank is one bank which, again, I would say, somebody has a one-year kind of time horizon, is definitely worth buying. It's quoting about one-time book. They are getting the pieces right. A lot of cleaning up has happened. There's a strong management team led by Rajiv Anand, which has come in. And the promoter is committed to infuse capital. There are rumors of fresh fundraise. The board has already approved a significant fundraise. So I think all the ingredients are falling in place. It will take probably a couple of quarters, but these corrections is an opportunity of buying it at the right valuation. The third stock, again, I would mention is probably some of these engineering names, capital goods engineering names. And Larsen has been my favorite for a long time. Again, every opportunity one should buy Larsen from a long-term perspective.
Got it. Let's welcome in Sudip. Hi, afternoon. Venkatesh Balasubramaniam is also with us, MD and co-head of research at JM Financial Institutional Securities from the sidelines of their conference. And I think we had a bad line. So, Venki, good to have you with us. I hope you can't see me, but I hope you can hear me. Your thoughts, Venki, what the conference, of course, I think coming to a close now. So maybe give us a quick wrap out of what you learned. Top 3 things you learned at the conference. What kind of questions, what kind of answers, and what's the mood been like?
Yeah, thank you for having me on your show. We've just almost wrapping up the third day of our conference. We've had almost 200 corporates participating, almost 750 clients who have attended our conference. We've had a wonderful set of speaker series over the last 2.5 days. Significant amount of interest in areas like data centers, renewables, newer technology companies. For example, we had the Eternal CFO talking in our conference. We also had Toyota talking about the auto sector outlook over the next decade or 15 years. Lots of bullishness about the future, despite the fact that shorter term might be a little bit of a concern, but longer term structural story seems very much intact. We also had people from NXP Semiconductors and Bhagwati Electronics talking about the future on the electronics value chain. So that was super interesting. A lot of investor meetings and speaker series, we actually had to bring in extra chairs because it was so crowded. So lot of both domestic investors and for FII investors have come in. They are meeting companies. They know markets are expensive, but they are evaluating ideas just in case there is a correction. Maybe they are identifying the ideas to buy if there is a correction.
So, as someone, there was a sell-side note which described the market as one where there is a low ceiling and a high floor. So you're kind of in that range, right? Would you agree with that kind of an assessment? And what are your own thoughts and convictions now for markets? And long term, of course, is the opportunity is there, but we're talking about, say, the next couple of quarters.
Yeah. So let me put it very simply. Market at 23 times FY26 on the expensive side. Now, clearly I could justify this market if we were growing at 15% plus on a consistent basis. In 25, Nifty has grown EPS at maybe 3.4%. In the current year, currently our numbers are at around 8 or 9% kind of growth. So a little hard to justify. That is why you have not seen any returns on the index level for the last 12 to 15 months. I don't see that changing at least for the next 6 months. So we are going to see a flattish kind of a market. There is a tussle between the FII investors who are selling. Interestingly, in the current year, I think in the secondary markets, FIIs have already sold $24 billion of Indian stock on a net selling basis, but they have bought roughly around $8 billion of stock in the primary side, the IPO market. On the flip side, you have seen continuous selling, continuous buying from domestic mutual funds. So they have been supporting the market. So in a way, what is playing out is a time correction. I don't see the time correction going away, at least for the next 6 months. As we end the year, next year outlook looks far better. You genuinely have a case for 15% kind of EPS growth. Why? One, because last 1.5 to 2 years, bank stocks haven't been giving you too much of earnings growth. That is going to change around next year. We believe most of the private sector banks can give you double-digit to 15% kind of EPS growth. The GST and income tax cut, which has been done over the last, let's say, 7 to 9 months, will start showing up in your consumption numbers, whether it be auto, whether it be FMCG, and you will start seeing EPS upgrades happening on the consumption side, at least over the next 6 to 9 months. That sets us up very well for the next year. If you do get 15% kind of EPS growth, then you can definitely justify these market valuations. But currently, we are still looking at 26 numbers where you cannot get double-digit earnings growth.
Next 6 months, kind of flattish, similar kind of markets, right? Basically, is what you are referring to, with, of course, a fair bit of dispersion here and there in some of the sectors you mentioned. Venki, we're short on time, had more questions, but we're also running into close. Thank you very much for joining us, and I hope you come back for a more detailed discussion. Thank you. We take a break. We are back. Sudep, of course, with us. There's also the market close in about, 7 minutes from now.
Welcome back. Just 3 minutes to go. And as we're closing out, by the way, a lot of the metal stocks have taken it on the chin. They are the worst performers as we're getting ready to close out the day and the week. Look at JSW Steel, Hindalco, Tata Steel, all of them down and down quite a bit. Some of this weakness happening after the rupee tumble started. So that's something to remember as well. Before we let Sudep go, Sudep, your thoughts on the metal space overall and also Hindalco. I mean, Hindalco anyway had negative news with Novelis suffering yet another fire. Now, would you buy into any of this weakness? And if yes, would it be ferrous or the non-ferrous side?
Well, I think Hindalco is definitely unfortunate. The second incidence of fire, and definitely, though probably it counts to about 10% of this facility, 10% of the Novelis production, but still, I think definitely this is a setback. And we were expecting things to come back to normal by December. So this is definitely a setback. So I don't think I will get into Hindalco. Overall, we have been positive on Vedanta for quite some time. And if I have to look at aluminium, considering the prices at which aluminium is hovering around in the LME, I think Vedanta will be my pick. We have been favoring Vedanta for multiple other reasons, including the demerger exercise which they have undertaken. There has been legal challenges and a lot of negative news flow around it. But we believe that strong value unlocking possibility definitely does exist as and when the demerger actually happens. But there can be multiple views, but the fact is demerger is going to happen. And I think things are moving in that direction. So if you are a bit of an aggressive investor, I think it's definitely worth looking at Vedanta, even at current levels.
Okay. All right. We will, let you go on that note to enjoy your weekend. Sudep, thank you so much for joining in and giving us all the market perspective. What an interesting week for the market, because despite all the topsy-turvy situation, debate around the AI bubble and whatnot, the Nifty is down for today, but still managing about a 0.5%, uplift for the week overall. Anyway, let's look at today's tally then, 127. But defending 26,000, that's the story. Metals, of course, what we were just discussing, definitely a weak spot. Beyond that, some of the financials have been fairly weak as well. And the Bank Nifty has actually led the slide from the front because it was the outperformer index as well. So look at this. ICICI Bank, SBI, HDFC Bank, Axis Bank, cuts between 0.5% to 1.5% on all of these names. And even beyond banks, so overall financials also seeing plenty of profit taking. Case in point would be a Bajaj Finance, which has lost about 2.5%. There's Geo Finance, which is down about 1.5% as well. So financials overall weak. We've also seen some declines on a couple of IT names like Wipro, which is down about 0.7%. Reliance, slightly lower, 5 rupees lower on Reliance, L&T, some of these big boys also coming in for some profit taking. However, on the upside, auto is really revved up. I mean, look at the moves. Maruti, 1.5%. M&M, definitely capturing the street's imagination with all that they have said at their investor day, 1% higher. And even Eicher Motors continued its good form. It's up about 0.25% as well. Overall, by the way, TCS is ending flat. So in an otherwise weak market, some of these IT names, TCS in particular, holding its own after the big announcement of investments in data center along with TPG. The bell has gone. But Prashant, we must also take note of the fact that mid-caps have had a far worse day. Large caps still okay, but the mid-cap index is ending a whole 1% lower. Okay. Well, with that, we have to take your leave on this edition of Closing Bell. But do keep it with us, because in just a bit from now, we'll be back with Editor's Roundtable.
Hello and welcome. You're with us here on a fresh new edition of Editors Roundtable. Markets have shut. We are on this show, as always, going to be discussing the week which has gone by, but of course also looking at some of the factors which may come into play the week ahead. Joining us today is a very special guest, Mahesh Nandurkar of CLSA is with us. Mahesh, great to have you with us.
Not anymore.
Sorry, Jeffrey.
6 years ago, I joined Jeffrey.
It's the Rupee hangover. We're still kind of jolted by what we saw in the currency market.
Let me make the correction myself. I've been talking to Mahesh, I think, 20 years since, and he spent a long time at CLSA. My apologies, Mahesh. Of course, Nigel is with us, Rupee is here, and Nimesh is here as well. So with a rocky start, I guess we can dive straight in. Mahesh, how are you feeling? Markets and what you've been seeing over the last week, and I mean, just the state of affairs according to you.
Yeah. No, so overall, I mean, if you look at just the calendar year, like Nifty is up like about 7-8% or so, which is actually not bad. I think we'll probably close the year with say around maybe a 1 or 2% higher from here, hopefully. So it's been like a double-digit return year this year. Which is actually not bad given where the starting valuations were. I think the outlook for next year would also be, I would say, like a low double digits or high single digit type of a return. The good thing is that the worst in the earnings growth, I think, is now behind us. In the first half of FY26, there were certain one-offs, be it in the form of weather or maybe some GST-related disruption or the RBI cutting the rates, impacting the bank earnings. But I think despite all that, we've seen almost about 10% or so earnings growth in the first half. So I'm quite hopeful that things actually look better in second half and more so even in FY27.
With second quarter in the bag, has that caused you to make any overall changes to your estimates for the full year?
A little bit tweak downwards, something that happens all the time. I mean, I've been on the sell side. You've been interacting with so many analysts for so many years. We always start the year on a slightly higher level. Yeah. But I think, a 3 to 4% downgrade during the course of the year is actually not such a bad outcome. In fact, if you look at last 10, 15-year average, the numbers have been like far worse. So if we end up seeing just like 2 to 3% downgrade, is actually a good outcome.
But where are you post the downgrade? Because and that's interesting because I was going through reports from a couple of local brokers as well. And some have either left their estimates flat or I've even seen very minor upgrades. But post the downgrades, where are you on FY26 and what's the estimate for FY27 earnings?
So FY26, we are at about 10%.
Okay.
And FY27, we are much higher, about 15-16%. Okay. And I think, and the key contributor towards a much higher earnings growth next year, one is obviously banks, which have seen a bigger impact this year because of, as we discussed, the rate cuts. We're expecting much better numbers from autos, some of the consumer discretionary names as well. I would say even power. Power is a sector which has had like 2 back-to-back bad years because of, extra monsoon and much better water tables, which actually acts negatively for power demand from agri side especially, right? So, on that low base, power next year should actually report pretty decent, assuming that it is a normal year. Cement, we are very sort of bullish on, and telecom. So, if you look at our overall coverage universe, while I talked about like 15-16% growth for next year, the 2 sectors that really stand out are cement and telecom, where we're expecting more like 25-30% earnings growth.
Okay, all right. Good to see you, Mahesh, and you're sounding quite optimistic as well on the prospects, and good to hear that the earnings downgrades are finally ending, and hopefully the cycle turns from here. But just taking a break from the equity markets, towards the end of the week, what stood out was the kind of action we saw in the rupee. And, you put out a couple of notes, your team, that CAD is at a 20-year low. You're talking about the fiscal deficit being under control as well. What's your view? I mean, obviously, we'll talk about equities, but in terms of the rupee, what's your call out there? Today, it almost went to, the 90-odd mark.
Yeah, today, I think towards the end of the day, we saw a pretty sharp depreciation of the
Some
currency.
are calling it a more technical factor, but what is your call, fundamentally?
I think so, because, just the rupee fundamentals are actually looking very solid, according to me. I mean, as, you mentioned, this year, FY26, and I think next year is not going to be any different, FY27 as well. Current account deficit is going to be like 0.5 to 0.6% of GDP. That's at like a 20-year low. And obviously, low oil prices help, but it's not just the low oil prices. What we are also seeing is a very strong trend in services exports as well. And while one might say that, okay, we can see the IT companies, how much they are growing, it's nothing exciting, maybe like 4-5%. But if you look at the net services exports last year, also first half of this year, it's 15%.
Yeah.
And clearly the big driver for that is GCC, among other things. So it's a combination of low oil prices, much higher services exports growth. And finally, while there have been a lot of question marks about the net FDI number, like last year it was like almost zero. But I think that net FDI number of zero is actually hiding the underlying improvement in the sense that like last year we had like $85 billion of gross FDI inflow.
Absolutely.
This year we are on track to hit $100 billion of FDI. That's obviously getting negated in a big way because of some foreign.
To that point on FDI, net FDI last year, from what I remember, is $1 billion.
Yeah, it was
it's almost zero. Yeah,
it was zero.
But the argument there that even I've heard, and I heard this from some large private equity players, is that please don't undermine the importance of the gross number. You're seeing a net zero number because of a lot of large private equity exits, because deals have matured, investments have matured. You need to take the money out and then look at,
But that money is coming back, what do you mean?
Yeah, so
that money is coming back is what do you mean?
Exactly. So, I mean, that's what a large private equity fund sort of argued back with me, that why shouldn't we take our mature investments
100%.
out?
We should look
and
at
then, look at how
in
much
fact, India has
redeploying
become,
again.
It's a funding.
India has become, the only major global markets where private equity is able to sell and bring money back home.
Yeah, correct.
Which, and if you see like private credit and even private equity all over the world, they're actually, looking at ways of raising resources, and India has been providing that liquidity as of now, which, to your point, it actually is bringing in confidence that India is not the market where you can only invest.
Yeah.
But you can take money out as well.
So you don't get stuck. But you can make money and then exit as well.
You can't stretch that point beyond. I mean, most markets you can sell and get out, right? Except unless something like Russia happens, or which market you can sell. I mean, all markets you can sell.
No, that's because the primary market. So, see, for private equities to make a reasonable exit, you need liquid primary markets.
I take that point.
Yeah.
The other point is that the point about supply, and I think we were discussing this on Bazaar the other day, $100 billion worth of IPOs last 5 years. There's only 15% of it which has actually gone back into plant and machinery.
Yeah.
Actually creating assets.
Yeah.
Rest is all exit.
Yeah. So how do you, and the rest of it may exit होता है, वापस पैसा आता है, वो ठीक है, पर पता नहीं आता है.
All through family offices.
But what is your, how would you respond?
No, so I think, just to complete this point on private equity, I think, that money is going to recirculate at some point in time. So maybe not today, but the outlook definitely is better. The second, source of that negative FDI number is also some of the large foreign corporates, whether it is BAT or LG or Hyundai and some of the others. So that's, also. So I think, just to complete that point on FDI, what I would say, when the gross FDI numbers are so high as $100 billion, even if you see a small reduction in the selling by PEs or by, let's say, the foreign promoters, the net FDI number can go up pretty quickly. Yeah. In fact, in the first half, we are already like +10. And if the same continues, maybe +20 for the full year, as compared to 0 or 1, as you said last year.
So net this year, half year, we have the numbers?
It's +10.
+10.
Yeah.
Okay.
Yeah.
Better.
Mahesh, just to take that point forward on the FDI investment, the one space which has seen big investments in last 6 months is the banking sector. 5 large deals and big checks, right? I mean, something we never heard of. RBL Bank will see a 60% stake sale and a big FDI money coming in.
Yeah.
What's your outlook on the banking space? Because I remember you saying that the big earning upside will come from banking as well. Yes. So given the earning upside and that there is a lot of interest, how are you looking at the banking sector?
No, I think the outlook is definitely looking pretty good on banks, and I would say even NBFCs as well. As we have seen already, the overall credit growth, which was struggling at about 9% or so till, let's say, May, June. Now we're already up to about 11%. And this is, by the way, despite the fact that we've actually seen some GST-related deflation. Although, okay, so there is increased economic activity, but there is also price deflation as well. So I think that 11% credit growth number, I would say, is a very good sign that growth has improved finally to some extent. And I think the credit quality concerns are kind of pretty much behind. Now, the only hanging sword at this point in time for the banking sector, I would say, is there could be 1 or 2 more rate cuts.
That would add pressure to the NIM.
That is, but I think the market will probably look beyond that because we've already seen 100 basis point, maybe 25, maybe 50. But I think we are really coming towards the end of the rate cut cycle. So I think the market is going to clearly look beyond these near-term rate cuts that might happen.
When you talk to your global clients or even clients in India, is there a preference shift towards mid-sized private banks because they could be in the sweet spot going from here? Is that something that you're also identifying when you talk to your clients?
I would agree with you because when the growth is improving, like the way it is, also asset quality is not really a question mark, which is the case right now. One can afford to kind of go down the market cap curve. So yeah, I would agree with you.
Okay, all right. The other big event, Mahesh, has been politics, right? And we got a favorable outcome in terms of Bihar. The markets like what they saw. The NDA, stamping their authority. We have policy continuity.
Yeah.
Couple of questions out here now.
Yeah.
It seems the government has pivoted a little bit, right? It was all capex, capex, capex. And what we have seen during this year, whether it's with regard to GST 2.0, whether it's with regard to the action that we saw in the budget, or even some of these freebies, which some obviously are not very happy about because how do they manage the state finances?
Yeah.
I believe your preference is consumption. So tell us what are the top picks within consumption. And then I have another question with regard to alcohol, with regard to this BR election. But let's talk about the consumption picks first.
Yeah, I think the consumption as a trend has definitely been looking up and looking up much better on the investor radars. I think one of the very strong trends within the consumption is this whole thing about premiumization.
Yeah.
So in every category that you look at, whether it is two-wheelers or four-wheelers or alcoholic beverages and even detergents and take any other sort of category, you will see that the value end of the segment is not growing as much. It's the higher value added segment or the premium end segment is doing much better. And I think that trend is probably going to continue. But if you look at the sectors by itself, while consumption is definitely an attractive segment, if you look at different verticals, I would say select autos are looking pretty interesting. Although some auto stocks have actually run up quite a lot in this GST euphoria. I think maybe four-wheeler stocks have actually run quite hard already. So some select two-wheelers are looking interesting.
Alcohol beverage companies that you're about to put on.
Yeah, is looking quite good at this point in time. I would also say that I am willing to now go to the second sort of derivative within autos, which is the auto components. And I'm also keeping in mind the possibility of a trade deal or at least the penalty part going away. Which makes some of the auto component companies also very interesting, where the stock prices we have already seen correcting by 25-30%. Those could be very interesting names to look at as well.
Okay, I have a question on consumption, which we will take, but we have to take a quick commercial break here. So let's do that. Mahesh Nandurkar of Jefferies is with us, and we'll take that break and we'll see you on the other side.
Welcome back. You're with us on Editors Roundtable, and we're in conversation with Mahesh Nadurkar of Jefferies. He's already told us a couple of pockets of the market that he's fairly optimistic on, and power, telecom, and cement are those sectors. Mahesh, let me ask you about one more: real estate, because you guys were among the earliest bulls on real estate, well before the cycle was fully flourishing, right? We spoke with DLF this morning, Mr. Tyagi, and Nigel asked him, so where are we in the cycle? He said it's probably year 4. But don't think it's a 10-year cycle. It could be 15 years, it could be 18 years. But no, on a serious note, it's been a good run, but now stock-wise, stocks have gone into a bit of a consolidation patch. What do you think of the sector?
See, at the sectoral level, I think we are probably going through some kind of a mid-cycle consolidation at the sectoral level. But many of the leaders listed in the in the stock market, they're all growing pre-sales very handsomely. So in first half of FY26, it's almost 20% plus. So while the market as a whole might be going through a bit of a consolidation, most of the large listed companies are growing very handsomely at 20% plus. And I would actually say that this could be a much longer cycle than what we have normally seen, because this time it's some of the characteristics of a cycle that you see have been very different. Like if you compare with the previous cycle, we saw excessive land banking, the companies taking on debt, leverage, buying land.
Which is the point that he also made, that healthier balance sheets.
Yeah, physical prices going up very rapidly. I mean, we've seen like back-to-back years of 25%, 30% price each in each of those years. But now if you see, I mean, if you compare today's prices versus pre-COVID, which is 6 years ago, except for a few micro markets, the physical property prices have gone up by, I think, by about 25-30% over a 6-year period. And in a typical upcycle, you would do that in 1 year. So in many ways, what we have been seeing this time is very different from a typical cycle, which have been kind of short-lived. But this is clearly looking like, a trend where the balance sheets are extremely healthy, all-time low debt to equity, no signs of land banking, no signs of greed, not much of a spike in physical prices as well. So I think it is becoming less of a cyclical sector and more of a steady state sector. So I would actually say that this current phase of consolidation that we've seen in the market is actually a good opportunity to accumulate some of the stocks which are actually looking very reasonably valued. So in fact, most of the investors that we interact with, they have problems in finding value in India, right? And I would say that there are right now only 2 sectors. One is banks and the other is property, which are trading well below their historical averages.
What an interesting thought. And in any case, in markets like NCR or Mumbai, it's probably easier to buy a real estate stock than to buy the real estate itself. So may as well, investors can buy the stocks.
When we spoke to Mr. Tyagi this morning, he and I asked him whether it's all getting as absorbed as easily as before. I mean, it was 6 months back, he was said, it's like hot
gone
cakes.
In 24 hours.
It's now, he was more nuanced and it was more...
market reality check as well.
Maybe because on the consumption point, which Nigel and Sudep both asked you, Mahesh, real estates, and of course, India across the board, there is such under-penetration that it's long runways, no arguing with that. But my question is twofold. One, not real estate, because you said valuations are attractive, but otherwise, many companies there are trading at 40, 50 times multiple for basically...
On the consumption side.
On consumption.
Staples.
Staples more than anything else. You like staples, first of all, or no? So then I think the question is moot. You like real estate? You like what else in consumption? What should you describe as consumer?
On the consumption side, I would say autos. I would say, some of the other sectors like telecom, I would classify as a consumer sector. That's for your consumer lenders, consumer sort of lending, whether it's NBFCs. I would say real estate, okay, we kind of discussed that already. But then some of the value retailing segment, but not staples.
Nigel is waiting to...
and alcoholic beverages.
On telecom, I have another question, which is again something that caught my ear. You said that in FY27, telecom could be one of the sectors that will lead earnings growth. You said almost 30-35%. That is premised on what? Mega tariff hikes, or what? How does telecom start generating 35% growth?
No, actually, even this year, FY26 has also been a very strong year for telecom companies. So what I'm saying that it's basically a continuation next year. And what is really driving that is see, ARPUs are growing. So in the last 5 years, ARPUs are up 50%. They are increasing by 10% every year. And I think that trend should just continue next year, as well. So ARPU growth of about 10%. Then you add another, 2-3% of volume. So revenue growth of like 13-14%, EBITDA growth of 16-17%. And some of these companies have large below the EBITDA line items. So if EBITDA is growing by 15-16%, your EPS growth becomes more than 20%. So I think, so in actually my view, telecom is the cheapest consumer name in India. You cannot find. So if you just look at the combination of EV by EBITDA multiple versus EBITDA growth, and if you look at and if you want to find growth stocks in that where EBITDA growth is predictably higher than 15%, the most of the consumer stocks are trading at 20 to 30 times and more in EV by EBITDA terms. But telecom is trading at 12 to 13 times. So therefore, I say telecom is the cheapest consumer sector.
You said data consumption is growing at 2 to 3%, which is that volume you referred to. Is that data consumption, or?
No. I'm just saying, ARPUs. Because that avenue is revenue per user because it's user, right? So if user is consuming more, that is already.
Data, have you looked at that particular metric? Is data also growing at a data consumption growing?
Yeah, data consumption is growing. We are, I think, consuming. I mean, we are like the highest consumers of data. We, as in like India as the economy, right? Almost like 36 GB per month or something like that, or maybe I'm just.
But 36 GB per capita.
Yes.
Okay.
So it's so we are very, very heavy. Data users.
That's quite something to think about. I mean, which sector can you right now say with conviction can give you 20% earnings growth in a year? And Mahesh is saying telecom could be that.
The other one is going to be all this Chat GPT and Gemini is hugely data intensive, right?
It is.
Yeah. Everything is data.
This is
even more.
I think the data consumed for a simple Google search compared to Chat GPT.
Yeah.
I think this requires a lot more. I think Mahesh can tell.
Yeah, but basically, I mean, like if you see, generally speaking, people around you, the usage of videos and reels and it's at a crazy level, right? And video are like super.
People are going to be watching this show on data.
Data. It's all about the data.
Now it's going to be quite interesting. Just to close the loop on the alcohol point, because Mr. Nitish Kumar, he's promised. I mean, the freebies are 40,000 crores odd. There's an alcohol ban currently in Bihar, and when the ban took place, that time they lost around 4,000 crores in terms of revenues. So as a balancing figure, he's obviously got the female vote bank, but there has to do something with regard to the revenue collection as well. So will Bihar be able to drink legally? It's going to be an interesting point. I think the coming months will know.
Who they're drinking illegally?
No, I mean that's what reports suggest. The report suggests that there's a large illicit market, and there are a large number of cases in the courts as well. So the judicial system as well is under pressure.
But is there value there? Alcobev?
Yeah, he said. Yeah.
Still, despite the run-up in Radico and
we have seen a huge run-up, but I think it's clearly a segment where we are seeing revenue growth, earnings growth very strong. So, see, I don't mind paying up higher multiple if I'm getting visibility on growth.
Steady growth.
And you asked about the staples and the valuations being high. That's one segment where valuations are very high and growth is not supporting those types of.
Even if earnings grow, valuation derates, you won't make any money eventually at the end of it. My last question, right, and I think we should close with AI, maybe.
That's our favorite question.
If Jeffries has a global view, or I don't know what your global guys are saying about it. What's happening in the?
Is it a bubble? Not a bubble?
Yeah, it's very difficult to call, it a bubble. But yeah, there are various thought processes, and sort of various reports that we have seen. What it clearly looks like is that for a typical value investor, international or a global value investor, it is becoming difficult to justify the valuation that some of these stocks are trading at, global AI stocks are trading at. So what we're seeing clearly as a trend is that while a lot of these value focused funds had gone significantly underweight on India over the last couple of years, are actually now making a comeback and looking at adding to India, and sort of cutting their India underweight and funding that by selling some of these expensive names.
There you go, Surabhi.
The anti-AI trade.
Oh, India is a massive anti-AI trade, yeah.
We've managed to close up 0.5% in a week that's been roiled by all this AI and Nvida business. So Maybe. But we need to see the money. They need to show us the money, as they say, right?
If this AI as a global investment theme were to peak out, I mean, India will definitely be a big relative beneficiary of that, for sure.
Well, on that optimistic note, I think it's a good time to call it an evening. Thank you so much for joining us, Mahesh. Always great to have you with us in person. Thank you for doing this, and we look forward to
Thank you very much for having me here.
Thank you.
All right, with that, it's a wrap on this edition of Editors Roundtable. Thank you for watching. Have a fabulous weekend, and we'll see you with the markets bright and early again on Monday morning.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: artificial intelligence-related stocks give a real jolt to investors worldwide. Stocks tumble across Asia and Europe after Wall Street loses $3 trillion in value. Nvida, Oracle and AMD lead the sell-off. Shares of SoftBank down over 10% in Tokyo. Weak global cues drag the Wall Street lower. The Sensex down over 400 points. Nifty manages to hold above 26,000. All major indices close in the red. The Indian rupee sinks to a new low. $1 now costs nearly 90 rupees, weakening risk appetite and uncertainty over the India-US trade deal weigh on sentiment. US sanctions on Russian oil takes effect today. Reliance Industries stops importing Russian oil. US imposes sanctions on 2 Indian entities and individuals alleging involvement in crude oil trade with Iran. Mahindra Group is looking to grow in multiples, not percentages, says Group CEO Anish Shah. The head of 14 group companies come together on television for the first time on their annual Investor Day on CNBC-TV18. Anish Shah says the market value of their growth gems has not been captured, promises big value unlock in the days ahead. That's an exclusive. SEBI Chairman Tuhin Kanta Pandey says they are actively examining including real estate and infrastructure investment trusts in market indices in a calibrated way, calls enhancing their access and liquidity a priority. Online trading platform Grow reports a 12% jump in profits as lower employee expenses offsets higher marketing spend, but revenue and active clients decline year-on-year even as market share expands. Airports Authority of India kicks off its largest modernization drive, plans to revamp 65 airports with modern equipment and air traffic control towers at an estimated cost of 17,000 crores. That's an exclusive. Ukraine's President Zelensky says he's ready to work with the United States on their plan to end the war with Russia. The plan requires Ukraine to make some painful concessions, including giving up some territory and downsizing its military by 40%. At least 5 people are dead after an earthquake of 5.7 magnitude strikes a city near Dhaka. Over 200 injured. Strong tremors felt in Kolkata and cities in northeast India as well. Donald Trump Jr. tours Vantara, the wildlife rehabilitation initiative led by Anant Ambani. Trump Jr. also visits temples in Jamnagar along with Anant Ambani and Radhika Merchant. Well, let's start with the global market action. A sell-off on account of AI valuation sparking a sell-off worldwide. Asian markets slumped in trade this morning, dragged lower by a tech-led sell-off that we saw overnight in the US markets. Japan's Nikkei, South Korea's Kospi and the Hang Seng all down. In fact, look at the Kospi down almost 4%, 2.5% lower on both the Hang Seng and the Nikkei. The rout in Asia reflected the spillover from a steep drop in Wall Street action overnight. The Nasdaq and the S&P 500 declined around 2%, wiping out nearly $3 trillion in investor wealth. That's the story as far as the S&P 500 and the Nasdaq are concerned for you. Tech names including Nvida, Oracle and AMD suffered the steepest decline. The global sentiment also weighed on our markets, and our markets closing lower, 0.5% lower for both the Sensex and the Nifty, and the Midcap index dropped by about 1%, so closing in the red. However, markets are up over 1% for the week. Prashant joins us now to take us through the week's market action. Prashant, how would you sum up the week gone by, and more importantly, the cues that we need to watch out for?
A roller coaster of a week it was, and of course, into Friday, the excitement did not die down. For most of the week, of course, the excitement was in the US markets with sell-offs, debate about AI, etc. Here, we had a steady week for the most part. On Thursday, getting to within 30 points of a new high for the Nifty. But then on Friday, especially in the last 60, 90 minutes of trade, with the rupee going into a bit of a tizzy, the market here sold off as well. I'll just give you the Friday to Friday closes. Nifty up about 0.6% still. Nifty Bank up about 0.6. Mid-cap index down 0.75%. The small cap index lost about 2%, 2.2 to be precise. If you want to sort of look at this sectorally, real estate was the top losing sector, about 4% cut. Metals this week down 3. Defense as the area was down 3%, actually 2%, beg your pardon. The gainers were the IT services index with that big move in the middle of the week, 1.6 though for the week. Autos 1%, the consumer sector was up 0.9% as well. Large caps now, so Max Health was the big Nifty gainer, 7%. Ixigo was up 7%. And then, of course, it falls off with a 3% gain for Bharti. The big cut, Tata Motors passenger vehicle, another 7.5% loss here. Adani Enterprises down 3.6%. Tata Steel down about 3.6% as well. Now we come to the broader space, and a fair bit of dispersion here for the most parts, except maybe Thursday and Friday when things went very, very quiet. It was a pretty vibrant looking screen. I'll start with what was up for the week. On a broader basis, Narayana Hrudayalaya was up 16.5%. M&M Finance was up 11%. TBO Tech, 9% gains. GMR Airports, 9%. Hero MotoCorp, 8%. And Eris Life was up 7.5% as well. In terms of broader market losses, GMDC, 14% loss. This one. HBL Engine, big outperformer over the years, of course, 13.5% pullback. KEC down 12%. Samman Capital, there was that news flow out of the courts, 10% lower though for the week. It recovered from the lows. Sagility was down 9%, and JSW Energy was down about 8% as well. So, that's essentially the week and what it looked like. As we look ahead, the big question, of course, is whether US markets will stabilize or there is more to go on the downside, especially with regards to the Magnificent Seven and, of course, that entire AI trade. And I think that's how we will pick up the pieces when we come back on Monday morning and trade on from there. Back to you.
Yes, we will be back Monday morning with the market action. Prashant, many thanks for joining us. And Nvidia CEO Jensen Huang has dismissed the talks of an AI bubble. Speaking at an investor call after the Q3 earnings, Huang said he's seeing something, and I quote, very different. Take a look.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, Nvidia is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Well, that's Jensen Huang on AI valuations and concerns on whether they are far overstretched. But let's talk about the rupee, because the Indian rupee hit a new low of 89.49 to the dollar after a flurry of late trades. Dealers are largely blaming the absence of the RBI as the reason for the fall, and then RBI's intervention for arresting the fall as well. Some dealers say the RBI reappeared and sold dollars in late trade. Lata, what's going on with the rupee? What prompted this kind of a move today?
Well, that's the guess in the market. Around 240, in a matter of a minute, the rupee depreciated from about 88.70 levels to 89.49 level. The explanation for the market is that the Reserve Bank was always expected to come in and support that 88.79.80 mark. They have been doing that for the last several weeks. Usually what happens is when you notice the Reserve Bank protecting a level, people start writing options at that point. You sell the dollar at that level. In fact, there is a widespread belief that the rupee has already depreciated a lot. It's depreciated more than the fair value. You normally measure it by the REER and NEER terms, which is real effective exchange rate and nominal effective exchange rate, comparing rupees inflation to the inflation of its trading partners. By that standard, the rupee is, devaluated much more. About 2-3% undervalued. The expectation in global markets is that people are selling the dollar versus the rupee, because when the trade deal comes, the rupee is expected to go to about 87.50 or 88 levels. Therefore, the market was not prepared for the crossing of 89. Once that happened, all those who were sitting short had to immediately come and cover because their stop losses were triggered. That created a natural momentum of dollar buying, and that took the rupee very quickly to the 89.50 mark, at which level people believe the Reserve Bank has come. Now, one logic in the market is probably the Reserve Bank was testing. Since everyone is saying fundamentally the rupee is undervalued, why not wait to see what is the natural level? Let's not intervene. But usually the central bank doesn't stay for 70 pice or 1% of the fall. So there is a lot of anger against the Reserve Bank for not coming in earlier, for not allowing a gentle depreciation of the rupee. At the moment, 89.50 is seen as the new Lakshman Rekha, the new level which the Reserve Bank might defend. But its sacredness is all of half an hour. We have to really wait and see how things pan out. At the moment, the rupee is clearly undervalued, but it can still fall. Who is to say if the Reserve Bank doesn't come and support?
Well, we will have to wait to see how this pans out, but that's a new record low for the rupee. Lata, many thanks for joining us. And on to the action in the crypto markets, where the Bitcoin continues its month-long fall. The cryptocurrency has fallen to its lowest level in the last 7 months, dropping below the $86,000 mark. The entire crypto market has shed almost $1.2 trillion in value since October. Investors are reducing exposure to riskier assets amidst fading expectations of another cut by the Federal Reserve next month. Well, the U.S. sanctions on Russian crude oil coming into effect today. In a statement, Reliance Industries has said it has stopped the imports of Russian crude oil. Reliance said, and I quote, "From the 1st of December, all oil product exports from the SEZ refinery will be obtained from non-Russian crude oil. This transition has been completed ahead of schedule to ensure full compliance with product import restrictions," end of quote. The company has also said that all pre-committed liftings of Russian crude are being honoured since shipping and logistic plans have already been finalised. However, any consignment after the 20th of November will be diverted to the company's domestic tariff area refinery, which is outside the scope of any new SEZ restrictions. The U.S. has also imposed sanctions on 2 Indian entities and individuals alleging involvement in crude oil trade with Iran. The U.S. Treasury Department lists includes Maharashtra-based RN Ship Management Private Limited and Pune-based TR6 Petro India. 17 entities and individuals from around the world have also been sanctioned, according to the department's statement. These entities were helping Iran generate funds for its nuclear program. On to CNBC-TV18 exclusive, Mahindra Group CEO Anish Shah has said the group is looking to grow in multiples, not percentages. This as the heads of 14 group companies came together on television for the first time at their annual Investor Day. Speaking to CNBC-TV18, Anish Shah said the market value of the growth gems has not been captured and promises big value unlock in the days ahead.
Auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly. And farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to growth gem. We did mention to investors that we would look at one new area in the next 12 months with a very high bar. We had exactly the same slide that we put up a year ago. And at that point, we had said insurance is one area we would look at. We have gotten into insurance in a space where we feel we can create very meaningful value for our shareholders. And similarly, if we find a space we can create meaningful value, we will look at it. We do play in 70% of India's GDP growth over the next decade. And therefore, our current businesses have huge room to go. And you're seeing that room to grow with holidays. You're seeing that room to grow with many of our other businesses. We've also talked about organic growth. Organically, we've grown 25% a year for the last 5 years across the group, despite being in some tough industries as well. And we plan to grow 15 to 40% organically for the next 5 years across businesses.
Well, that's the Mahindra Group on their vision for 2030. You can catch that conversation with the top brass of the Mahindra Group at 5:30 p.m. and 9:30 p.m. right here on CNBC TV18. Well, news just coming in. A Tejas fighter jet taking part in a demonstration at the Dubai Air Show has crashed. The plane made by Hindustan Aeronautics went down this afternoon while performing an aerial display before a large crowd. It is not clear yet if the pilot ejected before the crash. The Indian Air Force has confirmed that the Tejas fighter jet has crashed at the Dubai Air Show. Details are being ascertained. As you can see on your screens, a plume of black smoke rose above the airport after the crash. This is, of course, a developing story, and we will get you more details during the course of the next few hours. But we are still awaiting a statement from Hindustan Aeronautics. That is the footage of the Dubai Air Show where the Tejas fighter jet has crashed earlier this afternoon. Well, up next, the Airports Authority of India kicks off its largest modernization drive, plans to revamp 65 airports at an estimated cost of 17,000 crore rupees. Details when we return. Online trading platform Grows profit jumped 12% in its first set of earnings after its listing last week. This as a 9% fall in employee expenses offset higher marketing spends. However, revenue down 9%. Active clients declined year on year, even as the company's market share expanded. That's Grows earnings for you. The probe into the death of Ola Electric employee Arvind Kannan has been transferred now to the Central Crime Branch. This comes after his family petitioned senior police officials for an independent time-bound inquiry. The 38-year-old engineer died by suicide on the 28th of September in Bengaluru. Police recovered a 28-page note alleging workplace harassment, unpaid dues and heavy pressure, naming senior officials including the CEO Bhavish Agarwal. Indigo will invest over 7,000 crore rupees in its wholly owned subsidiary Indigo IFSC this fiscal. The arm will use the funds to acquire aviation assets, allowing the airline to own more of its aircraft. The investment will be a mix of equity and preferential shares infused in multiple tranches. In a statement, the company said the move highlights its focus on smart capital use and long-term value creation. On to a CNBC-TV18 exclusive. The Airports Authority of India has kicked off its largest modernization drive. AI plans to revamp 65 airports with modern equipment and air traffic control towers at an estimated cost of 17,000 crore rupees over the next 5 years. Madhiya is here with more details. Madhiya.
Well, the Airports Authority of India has begun its biggest ever modernization of air navigation services to enhance the airspace capacity. Airlines might add aircraft, but not having enough airspace to navigate can slow down India's aviation growth story. So here's how Airports Authority plans to deploy the 17,000 crores. The plan is to modernize 65 ATC towers by 2029. About 60% of the funds go into civil works and 40% into new automation and navigation technology, as well as enhancing cyber security, which is very important considering the cyber attacks that ATC towers could come under. So 65 airports which have been identified for major overhauls and 54 will undergo minor routine improvements. So of the 65 airports, 13 airports that have more than 100 flight movements per day have been identified, of which 5 airports will see total revamps. 8 airports will get revamps of the air navigation systems. So 22 airports will see ATC towers revamped along with new ANS, which is air navigation systems. 26 airports will retain their towers but get new ANS systems, and 4 airports will see construction of new towers with new equipment. And these 4 airports where the new towers will come up at Bhogapuram, Navi Mumbai, Dholera and Jewar airports, which are all high growth, high traffic locations preparing for large scale expansion. Now, AI says that the objective is simple: handle more flights safely and efficiently by improving automation, flight sequencing and runway throughput. India currently, remember, handles 44 to 46 landings an hour at its busiest airports, including the Mumbai International Airport, which is well below the 56 to 57 landings per hour seen globally. But modernization, remember, also needs skilled manpower. AI recruits 800 to 1,000 air traffic controllers a year, and that number will need to rise significantly with capacity expansion and the new towers coming up. So AI currently trains air traffic controllers at Prayagraj, Hyderabad and Gondia. The Prayagraj center will now be upgraded with new buildings, simulators and radar systems. AI says this upgrade cycle is essential as India prepares for a surge in new aircraft and new airports, and the entire program of the 17,000 crore investment for expansion of airspace capacity is targeted for completion by 2029.
Madhiya, many thanks for joining us. The Airports Authority on a modernization drive. Justice B.R. Gavai retiring after a 41-year career and a 6-month tenure as the 52nd Chief Justice of India. He assumed office in May this year. Justice Suryakant will succeed him, taking charge as the Chief Justice from the 24th of November. Ashmit recaps the key moments of Justice Gavai's tenure. Ashmit.
Well, Justice B.R. Gavai today hangs up his boots as India's 52nd Chief Justice of India. But while his tenure was brief, about 6 months, the impact of the decisions that he took will be anything but. Justice B.R. Gavai was the country's only second Dalit Chief Justice of India. His term at the helm was just a little over 6 months. He's scheduled to superannuate on November 23rd, and since that's a Sunday, Today is the last working day for the chief. So let's look back at the last 6 months of his tenure. Now, his latest judicial decision was the opinion that courts do not have the power to give a deadline to the president and to the governors to decide on the bills passed by the state assemblies. This went against Supreme Court's own April judgment, which imposed a 3-month deadline. It was widely criticized for potentially paralyzing lawmaking in states and encouraging obstructionism. In another key decision, Justice Gavai reversed a judgment that barred the practice of retrospectively getting environmental clearance for a project that has already been constructed. Some fear that this reversal will allow companies to begin projects, start cutting trees without environmental clearance, and get one retrospectively by paying a penalty. Another reversal was on the legacy dispute involving AGR dues of telecom companies. Since 2019, the Supreme Court had passed multiple orders confirming the original AGR demand. But in the latest petition filed by Vodafone Idea, Justice Gavai-led bench allowed the government to recompute the demand and grant relief to Vodafone Idea, citing special circumstances. In another landmark decision, Justice Gavai-led bench struck down the Tribunal's Reforms Act of 2021. He reprimanded the government for reintroducing provisions which had previously been set aside. He slammed the centre for trying to overrule Supreme Court orders by making a new law. Now, before becoming the CGI, he was also a part of the bench that upheld the demonetization exercise of 2016. He also ruled in favour of abrogation of Article 370. He was also a part of the bench that struck down electoral bonds for political funding. Now, Justice Gavai also went viral when he dismissed a petition for restoration of a Lord Vishnu idol by saying, "Go and ask the deity." This caused a lawyer to throw a shoe at the CJI while he was seated in Court 1 of the Supreme Court. Justice Gavai also made the news when the Supreme Court administration issued a letter to the government nudging it to evict former CJI Justice D.Y. Chandrachud from the formal residence. It has also been flagged how no women judges were appointed to the top court under his tenure. Now, his decisions, comments and actions often made the evening news. And while he may have his plaudits, some of the recent actions have led to strong criticism and concern.
All right, Ashmit, many thanks for joining us. The Chief Justice of India, B.R. Gavai, retiring, and Justice Suryakant to take over. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. We're back in a minute with more.
Organically, we've grown 25% a year for the last 5 years across the group, despite being in some tough industries as well. And we plan to grow 15 to 40% organically for the next 5 years across businesses.
Every time I would go for a meeting to Anish, I was reminded of Subhash Chandra Bose. तुम मुझे खून दो मैं तुम्हें आज़ादी दूंगा. So I was like, तुम मुझे capital दो मैं तुम्हें return दूंगा, right? So that's.
How much money do you need?
So I've clearly outlined a plan for 4,000 to 6,000 crore.
So if you think of it, as a plane, we were taxiing, now the wheels have left the ground, and beyond FY27 is the time to go supersonic.
Whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years.
When we started the journey on Growth Gems, collectively they were worth 8,000 crores in March 2020. Today, they are worth 56,000 crores.
Hello and welcome to a special Market Masters edition that coincides with the end of the second quarter earnings season. The question we're asking our guests is whether the results season shows a clear recovery in Indian earnings and hence will the foreign investors return. Our guest today is Timothy Moe, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs. We have invited him because Goldman Sachs has just turned overweight on India from their underweight position almost 13 months ago, since October 2024. Timothy, thank you very much for coming into our studio. That's
thank you
making
very
it
much.
all the better. Okay, well, straight away, why have you turned overweight on India?
Really, Lata, the reasons are that the causal factors for engendering our downgrade 13 months ago, as you mentioned, have dissipated and look as though they're turning aside. So to be specific, we downgraded for two main reasons. One, that a lot of India's good news got priced into the market valuation in September, October of last year, when the market was trading about 25 times forward earnings. So we've been very positive in India, as many people have been, but felt a lot of that was in the price. So that was number one. And number two, we had a developing conviction that there would be what we were terming a mid-cycle slowdown in the economy and in earnings. And as I'm sure you're aware, when you have a richly priced stock meeting a downgrade, you tend to get some hyperactive move to the downside. So we just felt, look, let's step back here and take our foot off the accelerator and take our view down. And we're fortunate that our timing was reasonably apt. And since then, India has underperformed by the most in a decade or two, particularly compared to China, which has come out of its doldrums and has had a very good year. So if you look at the scorecard for year-to-date market performance, China's up 35%, and India just recently was up only 2-3% in dollar terms. And that's MSCI India, but Nifty pretty much the same. So what we figured, to your question, is, well, number one, there's been some moderation in valuation. Not colossal, but the market was coming down to maybe 22 times. So it kind of grown into its valuation to some extent. Number two, quite clearly, the economy had slowed down, but was showing signs of stabilization. And in fact, even has printed above expectation numbers for second quarter of calendar year, first quarter fiscal year. And we've been toning up numbers overall. And then at the market level, there's clear signs that the persistent downgrade cycle for earnings has really stabilized. If you look, for example, at a measure of breadth, number of analysts downgrading versus upgrading, and this is your zero line, we got to really, really deep. Almost everybody was downgrading. Now it's basically flat, and even there's a touch of upgrades. And if you look at the most recent quarter, which you mentioned, the expectation coming into that was about 9% year-on-year growth for the full market. It's actually going to come out more like 14, about 5 percentage points above. So there are signs at the earnings level that things are coming into play. So you put all that together, and we just feel that the risk reward for India is now turning more favorable, especially because foreign investors have sold, since they started selling last year, about $30 billion in this downgrade, this down selling time, which is the second largest in absolute terms and relative to market cap on record. And even year to date, there's about 16 billion in net selling, which has gone on. And so if you've got lighter foreign positioning, you've got an economy which is stabilized, looks like it's picking up a little bit. Earnings, we think, will grow on a compound basis, maybe 13-14% next couple of years. Market valuation is still rich, but acceptable. We did a bunch of work on that. We just feel risk reward looks better for India. So we figured it's time to pull the trigger.
Very good. That suits us. But do you, which sectors are you impressed with? Are you impressed mostly with consumption? Because that's where the government has given everything it can, rate cuts, tax cuts.
Indeed, Lata. So we very much like the mass consumption theme. So I'll answer your question this way. There are a number of themes that we particularly like, which, as I said, to start with your question, would be mass consumption, because obviously the underlying dynamics, demographics, large population, per capita incomes are rising, people's consumption habits change. This is your classic sort of developing market or developing economy story, and we think that India has much to play for in that regard. Additionally, we like the theme of self-sufficiency, and this plays into defense, into energy sufficiency, and so forth. So there's a lot of aspects there our analysts just did a very large report, 140-page report on initiating on the Indian defense sector. And defense is a theme which we've liked regionally and globally, and I think for many reasons, which I'm sure we'd all agree with.
Yes.
In a fractious geopolitical environment, which we find ourselves in today, the theme of defense is one that's played very, very well. And we think India has some catch-up to go in that. And so we're quite excited about that theme, along with the theme of energy sufficiency. We also like the theme of the new economy. This is leaning into the digital economy and more delivery.
E-commerce.
Correct. Yeah, e-commerce, fast delivery, all that sort of stuff, where you see a transition from your analog to digital economy. It's not a theme unique to India, but there's a lot to play for in that regard. And then just simply the theme of high growth, where we find there are many companies that are offering good growth opportunities, particularly in the smaller mid-cap space, where you've got early emerging companies that tend to do better. So we like those four themes. And then from a sector perspective, that will be manifested in a number of the consumer areas in terms of durables. Some of the financials, the banks have particularly come out of a period of credit constraint. And so we actually initiated an investment view of longing financials versus Nifty. We thought that was an interesting catch-up performance trade for the banks. And then some select higher growth areas as well. So that's sort of our view within the market.
Okay. Just zooming out, what would be your pecking order, since you specialize in all of Asia? What's the pecking order in terms of countries in Asia?
Well, it's a great question, and frankly, we're a bit spoiled for choice here,
good.
because we like a lot, and I think the trouble we're having in terms of finding things that we don't like as much is, I think, an indication that the broader appeal and potential for Asian equities actually still looks pretty good, even after a very strong year. MSCI Asia Pacific ex-Japan Index is up 25% this year, and 40% off the lows in early April. And so we think that can continue into next year for reasons we can explore a little bit later. And as I said, we're somewhat spoiled for choice. So to be more specific, we've had a very, very positive view on Korea, which is the superstar this year.
Because of the AIs.
Yeah, stratospheric performance. It was up actually up 90% nearly in dollar terms. And it's had a bit of a correction, but still up roughly 80. And one might think, well, after that, it's probably going to cool off. But even with that significant performance, Korea is still trading at 11 to 12 times earnings. And a good part of that is that, number one, the earnings delivery has been very, very strong because of the AI theme and so forth. But also, we're having a re-rating structurally of Korea because of better corporate governance, which I can get into further if you wish. But the point is that this rally in Korea started literally from 8 times earnings. So even if you're up a lot, you've only reflated to 11, 12 times earnings, which means there could still be plenty more to go for. So we like Korea. We like China. We just put out a view that over the next 2 years, we think China can go up 30% in price terms, maybe another 5% in dividend yield. And again, we think there's some structural reasons there. Taiwan, which are market weight on, but also looks good because you've got a very strong AI component there and some broader tech elements. So North Asia, we think, still looks good, including Japan, by the way.
Okay.
But then India, we like also. Maybe it's a bit early, and maybe it's going to take a little bit of time to catch up, but we like India as well. So those would be our top picks. To balance that out, in an Asia perspective, we're underweight Australia because it's richly valued and doesn't have as much growth. Not that we're necessarily outright bearish, but think it still will perform less well than the others. And then trying to be underweight as much of ASEAN as we can. These are the smaller markets, Indonesia, Malaysia, Thailand, Philippines, and so on, because they just don't have as much of that tech-focused driver.
Yeah. Clearly a developed country choice more. But, the start of this year, not start, maybe after the Liberation Day, after February 1, announcements from Trump, economists actually turned very negative on global growth because of uncertainty. You won't know where to invest in which product because you don't know when you will be hit by how much tariffs. That was the narrative we got. But in your report, you'll have upgraded growth forecasts for practically every region, for the world, for the US, for parts of Euro area, and of course for Asia, in a big way, even for India. Yeah. Why did it change?
So great question. So first of all, we and many other economists are upgrading our forecasts on a fairly dynamic basis, given the information which comes in. And so the point of reference that you took just after Liberation Day was the nadir, the worst part of the forecast, because at that point we were looking at very, very elevated tariffs. And of course, there was this sort of tit-for-tat escalation between the U.S. and China, where you had such colossally high tariffs that it basically was equivalent to an embargo in trade. And of course, that would have been very, very damaging for both economies. So we marked down our growth views dynamically quite aggressively. And just to give one or two numbers, we started this year, taking China as an example, with about a 4.8% GDP growth forecast for the full year. And that got marked down to about 4.1 in early April. But then, of course, as some of that tariff increase was walked back, and in China's particular case, we saw exports doing much better than we had thought, and I think consensus, we progressively marked up our numbers, so much so that today we're actually standing at 5% GDP growth for this year, and we just did the biggest upgrade to our China forecast in probably a decade, adding 50 basis points and 70 basis points to our 2026 and 2027 numbers. Now, because of this leaning into high-tech manufacturing and China's export competitiveness, and also the leverage they've got through rare earths. So the point of all this is that we've seen kind of a walking back of some of the worst fears, number one. Number two, to your question, that sort of reduces at least some of the uncertainty and makes it a little bit better environment for investment. Number three, a lot of that investment has come in, particularly in the U.S., in hyperscalers and AI, which is really separate from the whole tariff area of concern. And then number four, just if you look at the data which has come out, just empirically, the world seems so far to be doing better than one would have thought given the higher tariff levels. So people are just learning to live with it to a better degree. So all of that contributes to that increase in the growth forecast.
What do you think will be the catalyst that other foreign funds will wake up to the change in sentiment over India? Do you think this catalyst could be only the trade deal? Unless that happens, people are not going to come in?
So I think it's a few things like that. So if there is an announcement between the U.S. and India, as seems to be rumored, of course the market would look at that as a good thing, because if this extra, for example, 25% tariff surplus is eradicated, and maybe there's even agreement to go to something along the lines of what both Korea and Japan have arranged bilaterally with the United States, which is about a 15% base case, with maybe, in each case, Korea or Japan buying more from the U.S. and then also investing more in the U.S. If there's some sort of agreement along those lines with that sort of flavor, I'm sure the market would take that well. Now, I don't think that the full 25% additional tariff surplus has been fully priced in, because most investors thought, well, it's probably not going to last for a long time. But the market has certainly expressed and priced some sort of concern over that. So if you know for sure that's not going to be there, that's going to be a positive. So I think that in terms of near-term catalysts, that's one which we can look to. But the other ones, I think, from an India-specific perspective, really would be delivery of growth. Because I think the broader picture for India is that valuations are full. I mean, 22 times earnings, hard to argue things are on sale. We did a big piece which looks at valuations from a variety of different perspectives. And the punchline is that we think that these valuations are defensible, but we're not calling for an increase here. We think there may be even a little bit modest decrease, but roughly speaking, we could hold on to the current level. Ergo, in order to really power India and to rekindle foreign investor interest, India earnings have to come through. So I think it's really earnings delivery as we go through time will be the catalyst to get interest coming back.
A final question, and this is a macro market conflict I have in my head. India's macros have improved. We were a country up until 2013 with a 6% inflation on average. And because we adopted inflation targeting and went after it, now we have constrained our fiscal deficit, and inflation is averaging about 4%. That is reflecting in lower nominal GDP and probably impacting earnings. But that's a good reason why earnings and nominal GDP are lower, because we controlled inflation. Don't you get brownie points for that? Or do investors like you only look at the earnings number?
No, it's a great question. I concur with you. I think that if you have an environment where you have better real growth or very good and solid real growth and inflation under control, that is a much healthier environment. And I think full credit to India for the fiscal consolidation which has taken place, but it's been done in a gradual manner, so you kind of thread the needle between wanting to be more prudent fiscally without doing so much that you then hurt growth and have a negative spillover effect. So I think that the policymakers have done a very commendable job in that regard. I think that the silver lining, as you said, in that slight cloud of lower nominal GDP is that a lower inflation environment certainly allows the RBI to be more accommodative. And I think it also may calm fears about currency weakness. So if you get a more stable rupee and lower interest rates, well, lower interest rates are obviously good for markets through valuation. So I think that there's that positive pass-through effect from lower rates, which may mitigate the lower.
No, you're right that the inflation differential narrowing so much between India and the US is not reflecting in the currency just yet.
Correct.
But do you think the rupee's worst is over?
So our overall view, as I mentioned earlier, is that the U.S. dollar should weaken on a structural basis. India's had some challenges this year, and the rupee's been on the weaker side, along with the Indonesian rupiah. But we think here it's sort of probably roughly range traded stable. So we don't think it appreciates as much as some other currencies, for example, the Korean won, which I think is very undervalued here. It should rise, and the Taiwan dollar as well. But we think it can sort of hold its own. So I think from a U.S. dollar investor perspective, you're probably okay in U.S. dollar, keeping score in U.S. dollars. And then the real heavy lifting will have to be done by earnings delivery and growth.
Thank you very much, Timothy Moe, for your views and for dropping into our studio today. I do hope other funds follow Goldman Sachs' view and change their view on India and rate it overweight. Well, we have to take a break on that note, but I'm back with another guest on our Market Masters edition. Leif Eskison, the chief economist from CLSA, will join us after the break. Welcome back to Market Masters. So, the show where we are asking if India is on the cusp of a re-rating. My guest now is Leif Eskison, the chief economist at CLSA. Leaf, good morning and thank you very much indeed for joining us. Well, let me start by asking you that India's second quarter, what we call second quarter, July, August, September quarter, GDP number is due in a week. Has there been a recent upgrade from CLSA? What's the number we should be prepared for?
Yeah, so if you look at the current fiscal year we're looking at growth coming in just a hair below 7%, so 6.9% to be exact, right? So relative to the first quarter of the fiscal year, it does, you can say, imply some slowdown in growth during the remaining 3 quarters of the fiscal year. That sort of slowdown, I would say, is sort of driven essentially by 2 factors. One is because the government has to sort of rein in to some extent, you can say, spending to meet the deficit target. We think there'll be some sort of slowdown on that side, maybe sort of government-led infrastructure type investments. And then also the sort of, should we say, lagged effect of the higher tariffs that got imposed on India from the US, and also a slowdown we're seeing in global trade in the, should we say, in coming quarters as well, would be the 2 factors that will drive that. I guess if we start to see the effect of some of the GST reform, that could provide a bit of a lift to the consumption side of things, right? So that's why the slowdown we are looking at in the remaining of the fiscal year is not that significant. So as I said, full year fiscal at 6.9%.
Would you put an upward bias to that 6.9 because of the GST cuts and the probability of a trade deal with the US?
Yeah, certainly, I think the chances of a trade deal have gone up, right? I mean, Trump has certainly indicated as much, and the 2 sides are still negotiating on that front, right? So whether it happens on in this calendar year or in the beginning of the next calendar year, so the last quarter of the fiscal, we'll have to see, right? But I suspect that we could move towards a deal, right, where maybe the tariff rate that's imposed on India lands at something similar to what we're seeing for other Asian economies, to say around 20% thereabouts, right? And then, of course, there'll be some give and take also in terms of purchases and opening up for certain sectors, etc. That would be part of that broader deal, sort of in similar fashion, but not quite the same as we've seen from some of the other Asian economies, right, where they've entered deals with the US.
Okay. Well, is there any, this is not really an economist's question, it's more your equity strategist question, but do you see the global view on India changing? We've seen the largest amount of foreign investment outflows from India. But now, as the GST cuts and the income tax cuts in India work in and earnings improve, and probably the trade deal comes in, do you see the movement of funds back into India? I mean, a lot of the rupee depends on that. That's why I'm asking.
Yeah, so I think, given our view on, should we say, US equities being quite frothy, right? And should we say, a little bubbly, if you will, right? I mean, we do also see a relatively high probability of a correction in US equities, and that also would imply, should we say, more of a sort of less risk appetite, more broadly speaking, globally, right? So I think it will be hard for Indian equities to sort of buck the trend in that type of environment. But if you look, should we say, beyond that potential correction, and if there's also maybe some further correction in India in the context of that as well, right? And valuations are maybe somewhat less, should we say, challenging to the extent they are now, then maybe there could be a bit more scope if we start to see the GST reform adding to the growth impulse in India, right? And if growth holds up relatively well, that there could maybe be some resumption on the other side of this of equity investors coming in, right? But I think valuations still are quite high. I think positioning domestically is still quite long in the tooth as well, right? So I think that is still something that does pose, I guess, challenges from the point of view of foreign investors in the near term, right? So maybe a healthy correction could be a good sort of starting point, right, for seeing flows coming back in.
Okay. Well, just a final word. How many rate cuts do you see from the Reserve Bank? Is it just one in December or, more?
So we currently have two, 25 basis points in each of the two following meetings, right? So we're not buying it. We're not looking for 50 basis points in December, which I think came up after the latest inflation number, right? But I think what you need to look at is if you look at core inflation, right, in India, still at around the target, right? So I don't think there's necessarily a case for cutting by 50. So 25 basis points in December, and then subsequently another 25 basis points.
Okay, got that. Thank you very much, Lee Festerson, for joining us and giving us a view of both the US economy, the global economy, and where Indian rates are headed. Thank you very much for joining us in this special edition of Market Masters.
You're watching News Center with me, Ashmit Kumar. Now, the big story this evening, a Tejas fighter jet taking part in a demonstration at the Dubai Air Show has crashed. The plane manufactured by Hindustan Aeronautics went down this afternoon while performing an aerial display before a large crowd. Indian Air Force has confirmed that the pilot has been killed. Further details are being ascertained. The Tejas, a single-seat light combat aircraft, is India's first indigenously developed fighter jet. The incident marks the second crash involving a Tejas aircraft in less than 2 years. In March of 2024, a Tejas fighter went down in Rajasthan's Jaisalmer. The pilot, however, had ejected safely in that incident. Well, the other story that we're tracking today, Justice B.R. Gavai hangs up his boots today as India's 52nd Chief Justice of India. Justice Gavai was the country's only second Dalit Chief Justice. His term at the helm was just a little over 6 months. He's scheduled to superannuate on November 23rd. And since that's a Sunday, today is the last working day for the Chief. His latest judicial decision was the opinion that courts do not have the power to give a deadline to President and governors to decide on bills passed by the state assemblies. This went against Supreme Court's own April judgment, which had imposed a 3-month deadline. In another key decision, a Justice Gavai-led bench allowed the government to recompute the adjusted gross revenue dues demand and granted relief to Vodafone Idea citing special circumstances. Speaking at his farewell a few minutes ago, Justice Gavai joked about his plans for the evening.
I'm really feeling very happy that I don't have to read anything for tomorrow. I was dictating the judgments till yesterday evening, today, except correction of today's orders. I'll be very free. I was just telling Brother Surekant when we were coming, I'm feeling so relieved, and I told him what I proposed to do in the evening. I can't share it.
Well, joining us now to reflect on the legacy of Justice B.R. Gavai is with us Senior Advocate Gopal Jain and Senior Advocate Mr. Sanjoy Ghosh. Mr. Ghosh, Mr. Jain, thank you so much for being a part of this conversation. Mr. Ghosh, coming to you first. A lot of decisions that he's made recently in the last week leading up to his superannuation has invited a fair bit of criticism. You, in fact, were one of the critics. I saw your tweets that you'd put out on X. Care to reflect on some of these big decisions, landmark decisions, and the implications of these decisions going forward?
Well, there were a lot of controversial decisions. Firstly, thank you, Ashmit, for having me. To make the point very quickly, on the issue of this reference, you see the court can't be divorced from the political realities. The political reality has been that in opposition states, the governors have been used. They've weaponized the power to withhold bills. And many governors have sat for months, if not years, over bills. So it is in this context that the Supreme Court, through the bench of Justice Pardiwala, had passed that judgment, which had given a time limit of 3 months. Now, the point is that when a judicial order is passed, can you circumvent that by, instead of filing a review or seeking a curative, can you circumvent that by actually making a reference under Article 143 of the Constitution, which is the advisory jurisdiction of the Supreme Court, where the Supreme Court advises the President on matters of law. Now, the law is very clear that the advisory jurisdiction can only be used to differ on view of the law, but an actual binding decision can't be altered by this. And even the Constitution Bench judgment given yesterday by Justice Gavai's bench says so, that we are conscious that we cannot review the decision. We are not altering the decision, but we are going and we are looking at the point of view, the view of law. And after saying that, the entire judgment actually goes through everything and says the entire decision is erroneous. And this, unfortunately, this judgment does not take into account the realities of the day. And just to briefly end, courts have often, in times of need, like, for example, when Article 356, President's rule was being misused, the courts have creatively used the law, like in the Supreme Court in Bombai's case, and they creatively ensured that the rule of law and the Constitution is preserved. And you recall after that judgment, which made the exercise of President's rule judicially reviewable, the number of instances of President's rule came down drastically. So this, I'm sad to say, will have a political fallback.
Let's go across to Mr. Gopal Jain. Mr. Gopal Jain, that is an issue. The Supreme Court giving the opinion that there can be no deadline for governors or president is now inviting political reactions. Opposition rule states are now saying there's a need for a constitutional amendment to take things forward. Your assessment of this opinion that has been granted by a bench headed by Justice B.R. Gavai?
So let me first start by saying it's been a very smooth and stable regime. The last 6 months have gone like a breeze. And I was fortunate and privileged to appear on his very first day when he was appointed to the Supreme Court, and he delivered a judgment on that very day. So he started off on a good note by delivering a judgment, and that's what he seems to have done on the penultimate day with this reference which was answered. Second, it's a reference which is made to the Supreme Court by the President of India, and they've just brought clarity saying the scope of judicial review is very narrow and restricted. You can't give a binding dicta to saying that something has to be done in a particular timeline. Yet they've said if the circumstances are grave, the court can examine it. So I think it strikes a right balance between giving sufficient leeway to the president and governor, but keeping that window open that should there be a compelling or a grave circumstance, the court can have a look in. Of course, all these judgments, because the role of governors, etc., are fairly politicized, will get political comment. But I think when 5 judges of the Supreme Court answer a reference, it gives a viewpoint, an advisory opinion. And I think that's very important in a situation of the kind which was created, or the impasse, to have complete clarity. And it doesn't touch the judgment because that's a settled legal position that this is not a substitute for a review. So this is really the advisory role that the court wears versus the adjudicatory function which it did when it delivered the judgment. So I think we
you're
should
telling
see
us
it in
that that's a
that context
balancing
and
act
perspective.
that you're telling us that the Justice B.R. Gavai-led bench has done a balancing act. But another criticism that Justice B.R. Gavai received is that under his tenure, we started to see intra-court appeals. So whether that's the issue of the Justice Pardiwala, again, judgment imposing a 3-month deadline. Again, Justice Pardiwala's judgment, which had asked for all stray dogs to be removed. We again saw back and forth on that. Also on the AGR issue, you, of course, Mr. Jain, have been a fundamental part of that litigation before the Supreme Court. These flip-flops have given room for criticism that there is perhaps an intra-court appeal underway in the Supreme Court. Mr. Jain.
Yes. So let me start with the telecom issue first because it's very dear to me. I think the court opening the hands of the government to see if there was any arithmetical or mathematical errors is a very positive sign. Nobody has reversed the judgment which was passed by the court. But I think having a second look sometimes, if there are compelling circumstances or mathematical or computational errors, only the Supreme Court can do it. So I think I always look at it in a forward-looking lens, that that's a practical and pragmatic view, that whatever were the consequences imposed by the judgment may be right, but it never intended to impose a consequence of a computational or a mathematical error. And therefore, the licensor, namely the DOT or the government, is best placed to address that issue. Don't feel tied in. Do have a look at it. So I again put it in the same medium that you only opened and paved the way to government to consider. You've not given a verdict as to what it should be. Second, you mentioned the other aspect, calling it inter-court appeals. I again say that it was a 3-judge bench which looked at what a 2-judge bench had done. And that's very much part of our constitutional discourse, that a larger bench can look at an issue of a 2-judge bench, and the bench of 3's view will also have sort of final say or the final word. So I think some of these issues, especially because there was a lot of agitation and there was a lot of consternation, and so having a relook or a re-examination in compelling circumstances is not necessarily something that we should style by saying, oh, it's an intra-court appeal. On a lighter note, whenever we go for medical advice, you always say, can I have a second opinion? So think of it like that the larger bench looked at the issue more holistically and taking into account perspectives.
Right. Mr. Ghosh, taking that same question across to you, again, this issue of some of the reversals that we've seen being a cause of concern, being a cause of criticism?
Absolutely. As Ashmit, I tweeted this morning, I said the Supreme Court judgment should not be like a one-way bus ticket, good only for the day. And, whether it be arbitration, whether it be environmental impact assessment, whether it be land acquisition, whether it be now stray dogs, and now you have the governor's issue. So you are having so many contradictory judgments. One of the things of a Supreme Court is to be certain, and to be certain for a long period of time. So therefore, the time has come, and a lot of people are discussing about this, that the Supreme Court needs to speak in one voice. Gopal will agree with me that there are many people who say that there's no one Supreme Court. In fact, the Supreme Court judges themselves joke that there is no one Supreme Court, but there are several Supreme Courts. And that is not good for a nation. The nation needs a certainty of law, needs a certainty of direction from the apex court. So time has now come to actually split the court into two, as in many jurisdictions, as you have in France, as you have in Germany, where you have a constitutional court. Let's say the 9 senior-most judges form the constitutional court and they sit en banc. En banc means they sit together as the United States Supreme Court. 9 of them sits together and decides together. And the remaining judges can form the appellate court for all the civil and criminal cases as a final court of appeal of civil and criminal cases, nothing to do with the constitutional issues or major legal issues.
Sure. So an interesting, diverse array of opinions as far as Justice B.R. Gavai's tenure. I'd like to thank both of our panelists. We've completely run out of time as far as Justice Gavai and his legacy is concerned. Clearly, this will have far-reaching implications, as is visible from some of the work that he's left behind for us to ponder over. But speaking of the work that we're looking at, the Supreme Court recently has struck down provisions of a central act that limits terms of tribunal members to 4 years. The court ruled that it violates judicial independence and criticized the centre for what it calls legislative overruling of binding judgments. The court also said that it was unfortunate that the centre was not accepting the court's directions repeatedly. Joining us now to discuss the implications of this ruling by the Apex Court is with us, senior advocate Porus Kaka. He was one of the advocates who represented one of the applicants in this case. Mr. Kaka, thank you so much for joining us, being a part of this conversation. I remember that in the course of these proceedings, the cases that have been filed by the Madras Bar Association, the lead petitioner, they started to become known through their acronyms, MBA1, MBA3, MBA4, MBA5. That, to me, just appeared to be a case of the same issue being agitated repeatedly, which now the Supreme Court is looking to clamp down on. Mr. Kaka.
Absolutely, Ashmit, and thank you for having me. If you will see, we have now ended with MBA 5. So we have 5 judgments, some constitutional judgments of larger benches, some of division benches, some of 3-member benches of the Supreme Court in a period of not less than 7 years looking at the same issue. I think if it had been an individual, probably this could have been an issue of contempt. But I think it's extremely strange that the same provisions that the court repeatedly strikes down are reenacted practically verbatim, as you will see the judgment quotes, with minute changes. And I think this is unfortunate because ultimately we are setting up institutions. The tax tribunal is an institution that's existed since 1941. In 15 years, we will complete 100 years. With all its faults, it has served the country. And I think that can be an example of how you should perhaps manage and incorporate the provisions for other tribunals when you want to make an omnibus reform.
Sure. Let me ask a follow-up question that as far as some of these provisions are concerned, like, for example, a 4-year cap on the tenure of a member of a tribunal, the Supreme Court expressed its shock as to how an ordinance was struck down with the identical provision and then it was reproduced as a part of a new legislation passed by the Parliament. Is this a clarity that the centre will now have to sit with, will now have to make peace with, that, look, undoing or overruling a Supreme Court order through a legislation in the Parliament is no longer possible?
Well, I think that was always been the law. Today, you can go around, or that's perhaps not the right word, but you can amend your provisions and take away the underlying defects in case a judgment is against you. But you can't simply reenact the provisions without taking away the underlying defects. Between the Ordinance and the Reforms Act, nothing was done except repeat the exact same wine in the same bottle, to quote Justice Chandran, in fact, in the judgment. So really, it is that cannot be done. I mean, that is clearly barred by our Constitution, and that's what the court upheld. And ultimately, really, it's an issue not only of judicial independence, but also an issue of integrity of the institution, which you want to protect from the interference by the executive. And you must remember, in most of these tribunals, the government is the main party litigant, either the appellant or the respondent. For example, the tax tribunal. You certainly want to insulate that tribunal from interference by the executive. And I think this, as I said, is a larger issue. And I would appeal to the government to take the guidance and the sage advice of the Supreme Court while enacting any further reform.
My final question to you, Mr. Kaka, that as far as this guidance that the Supreme Court has given, that stop re-agitating same issue repeatedly over and over again, does it now have implications beyond just the Tribunals Reforms Act? We've seen criticisms of the centre, like in the case of appointments to the Election Commission, where there was a formula proposed by the Apex Court that was undone by a formula enacted through a legislation. Again, not going into merits, but is this a larger message that can go now to the centre above and beyond just the Tribunals Reforms Act?
Well, I think at least as far as the reforms for the tribunal go, this is not a larger message. This is a message that has been repeated 5 times in 7 years. And I think that's enough for any executive to look at and accept that, look, this is going to be the view of the court. And I think perhaps looking at what is the guidance in that judgment to reform it. We cannot simply keep reenacting the same thing. And I think at some point in time, the Supreme Court may have to become even firmer than it's already become under this judgment.
Right, Mr. Kaka. I'd like to thank you for joining us and sharing insights on this landmark verdict by the Apex Court. The Supreme Court expressing its frustration, its displeasure, calling it unfortunate that despite very clear directions and orders being given by the Apex Court, the centre is trying to undo them by passing its own new set of laws. With that, we're now heading into a very short break, but coming up next, US sanctions on Russian oil firms have come into effect as of today. It is estimated that nearly 48 million barrels of Russian crude is stranded on the high seas. We discuss the impact of the sanctions on India and China and who were once top importers of Russian crude. Stay tuned. Welcome back. You're watching News Center. Now today, US sanctions on Russian oil firms have come into effect. According to Kepler, about 50 tankers heading towards China, India or smaller ports carrying nearly 48 million barrels of Russian crude could be stranded at sea, as most will be forced to look for alternate destinations. The sanctions target leading producers Rosneft and Lukoil in an effort by Washington to pressure the Kremlin to end the war in Ukraine. According to US Treasury Department officials, the measures are already working, contributing to a drop in Russian oil volumes. India and China, once major buyers of Russian crude oil, are actively importing crude from other sources. Meanwhile, India's oil imports from the US jumped sharply, rising to 10.7% in October 2025, up from 3% in 2024. Today, the US Department of State sanctioned 2 Indian individuals and entities for their involvement in the sale of Iran's petroleum products and funding Iran's nuclear program. To understand the impact of these sanctions on India and the oil markets at large, we have with us Christoph Ruhl, Global Advisor with Crystal Energy. Christoph, thank you so much for joining us. Tell us, these sanctions take effect as of today, but the fact that the sanctions will take place and the messaging from Washington has been clear for a very long time. Give us a sense, has there been enough time for readjustment for India to reconfigure its oil supplies, or are there risks, or are there at least price constraints that India will now have to work with?
Well, as you described, we are in the middle of the adjustment process, and the oil market is a huge, big beast, and it moves very slowly, but it does move. And what we see at the moment is this 48 million barrels at high seas of oil, which has left Russian ports, and where it is not quite clear what the destination is. A lot of it goes towards India, a lot of it goes toward China. But it's safe to assume that this is an adjustment phase in which these ships will find new routes and new ways, possibly with what they did before, reloading it to other ships, switching off the transponders so that they're hard to trace. That my guess is that after a few weeks, these new routes will be established. Now, one point which has not been discussed very widely, which is important in this context, is Russia has a double problem if it doesn't manage to reroute these ships, because the winter is coming and oil production in Russia is, as you can imagine with these temperatures, weather sensitive. So if the sanctions succeed in really shutting in some of the Russian oil so that it cannot be exported and affects production volumes, then Russia has a problem, because it will be very difficult to ratchet that up later on when it freezes over, when the systems cannot be kept alive and through the winter.
Sure. From an Indian perspective, Christoph, help us understand what are the alternatives that India is looking at. Very recently, we saw an announcement that 10% of LPG will be procured from the United States. That's clearly an indication, messaging from between Washington and Delhi. So going forward, what direction do you think India's alternatives will take? What are the options that India has on the table?
Well, at this point, one has to make two distinctions. One is between what's actually happening and political messaging, so such as we will in future import everything from the US. The other is very important, of course, between crude oil and refined products. And what we have here is that India has, since the invasion of the Ukraine, ratcheted up its crude oil imports from Russia, so that's raw oil, tremendously, and has then started to put that into its refineries and refined, as you know, part of which was consumed domestically and replaced crude oil, which was before imported mostly from Asia. That's from the Middle East. Sorry, not from Asia, from the Middle East. And part of it was re-exported and sold with the little profits, which had the Americans so upset. What we are seeing right now is a concentrated move from India to rent ships, shipping capacity at driving prices up very high now, from the Middle East in order to replace some of this Russian crude oil. So that's a clear indication that substitution is taking place, that India is not just talking about it, but is taking crude oil from the Middle East to replace Russian crude oil. On the front of refined products, we have seen that the crude oil prices globally are under pressure, partially also because there's all this Russian crude oil still coming out, still floating around, but not having a home yet. Whereas on the other hand, refined products, in particular mazout, this is diesel from Russia, which was one of the biggest, if not the biggest global supplier, has increased in price because of the Ukrainian attacks on Russian refineries. So there one has to distinguish, and India is there not in a particular advantageous position because...
Christoph, I just have one more follow-up question. That while India is managing these alternate options, what happens on the pricing front? How much significantly of a premium will now India have to shell out for buying non-Russian oil?
So at the moment, during this adjustment process, the discount for Russian oil is, of course, much wider than it was. But in general, the global markets are so well supplied, and before the latest round of sanctions, the discount for Russian oil had almost evaporated, so that I would not expect the bill for India to go up significantly if it replaces the Russian crude oil or most of the Russian crude oil with Middle Eastern oil.
Fair enough. And one final question to you. There are efforts underway for a resolution of the Ukraine-Russia crisis. There's a US-backed plan that's underway, involves Ukraine giving up some territory. Any traction on the ground that you see for the peace plan? And are the oil markets accommodating that, factoring that in?
Yeah, that's the thing between political messaging and what actually happens. I don't think it's an accident that the sanctions start on the 21st of November, and on the 20th of November, the leakage occurs that there is a new peace proposal being made. I see two things. I see this as a signal that sanction enforcement will be pretty lame in the tradition of the Trump administrations all along, that they are not prepared to take hard measures against Russia. That's also visible in the peace plan. And I see that another step in this chewing gum, this long drawn-out process, which will not lead to a lasting peace, because the new plan, which has been leaked, is containing a lot of provisions the Ukraine will not be able to accept, such as the withdrawal from land which is currently still holds.
Right, Christoph, thanks so much for joining us. Multiple moving parts there. We'll, of course, keep track of those developments within India and outside as well. Christoph, thank you so much for joining us, being a part of this conversation. But that's all that time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here on CNBC-TV18.
Purpose-led, performance-driven and future-ready. That is the mantra of the Mahindra Group. And under the Group CEO, Anish Shah, the Group has done very well. It's seeing significant momentum across all of its businesses over the past 5 years. Consolidated revenue has doubled, while net profit has grown 10x, making M&M stock one of the best-performing stocks in the Nifty 50, with market cap up 13x from the lows of 2020. The Group, in fact, added nearly 1 lakh crore rupees in market value in 2025 alone. The company's growth gems have seen a 7x growth in value in the last 5 years, even as its core businesses fire
fire on all cylinders. So what is the growth plan for the future? Joining us today is in the entire top team of the Mahindra Group, starting with the captain, Dr. Anish Shah. Thanks very much for joining us here. Let me introduce all the others to you as well. Amarjyoti Barua, the CFO at the Mahindra Group, Raul Rebello, Mahindra Finance, Vijay Nakra, the farm sector at Mahindra, Suman Mishra, Mahindra Last Mile Mobility, Amit Sinha at Mahindra Life Sciences, Avinash Rao at Mahindra Sustain, the new addition to the team, so to speak, Rajesh Jajurikar, of course, needs no introduction here on CNBC-TV18, Abanti Sankar Narayanan, Mohit Joshi at Tech Mahindra, Vinod Sahai at Aerospace and Commercial Vehicles, Asha Kharga, the Chief Brand Officer at the Mahindra Group, Manoj Bhatt, who's created headlines this morning, so we'll come to you on Mahindra Holidays, and Nalin Kant Golkunta at the Automotive Division. Gentlemen and ladies, thank you very, very much for joining us. Anish, as I was saying, this is the playing 14, so to speak. If I were to start with a cricketing analogy, you and I have spoken very recently. You continue to be fairly confident, not just about the growth outlook for the group, but also for the Indian economy in general. Given that, what are the headline numbers that you've asked these people to chase from here on?
So, Shireen, it's great being here with you. And I will start with saying that this is an incredible team. And the performance that we've driven is essentially all thanks to their efforts and the efforts of all our associates. We have been able to deliver some fairly incredible numbers, but the aspirations we have are even greater. And as we look at aspirations across our businesses, I will start with the headlines from today for holidays, being the #1 leisure hospitality player in India. We've been the #1 vacation ownership player in India, but that's obviously a sub-segment of the leisure market overall. And Manoj has some fairly aggressive plans for growth for this business as he's transforming the business, not just in terms of getting into a new area of Mahindra Signature Resorts, but also taking our current membership base and creating much greater value for them. As we look at our auto and farm businesses, they've continued to grow extremely well. As we talked today at our Investor Day about key metrics for each business through the decade. And auto and farm have revenue growth of 8x and 3x respectively. That translates to a higher profit growth and hopefully a higher market cap growth that comes with it as well. If we look across our businesses, Mahindra Finance has promised a 5x growth in AUM this decade. And has...
he's smiling very sheepishly as you say that.
He's achieved a lot in the last 2 years already, because we've got the difficult part behind us of getting to a better asset quality, of getting to a much stronger customer experience with technology, with data, and now it's a pivot to growth for Mahindra Finance. So in some ways, a lot of the hard work has been done, and it hopefully should be an easier path going forward. Tech Mahindra on a good track has promised a clear path to margins and more coming after that. And as we look across our businesses, Sustain has won a lot of significant deals already, is on track to grow 5x this decade. Life Spaces, Amit has promised a plan of 14x growth this decade in pre-sales, has achieved more than half of it already. And as he has been saying for some time now, that's a low target, I need to increase that target. That's him saying it, not me. Suman has done a fantastic job in electric three-wheelers. We are the largest in electric three-wheelers by a good margin now. And the business has grown, again, fairly dramatically. If you look at electric three-wheelers alone, it's 65x growth, yes, of a small base. But electric is now more than 30% of the entire three-wheeler market, and soon to be 50% as well. So we've got a set of very, very strong leaders. Avanti and Asha have been focusing a lot on purpose. As you said, we are purpose-led. We start with purpose. And we've got Vinod, have sort of kept him from a business standpoint last, but our aerostructures business is, I would say, among the most promising businesses we have. And Vinod will talk about why, from a quality standpoint, he really feels that we stand out versus others, not by our perspective, by perspective of our customers who are global OEMs. Aerostructures has promised a 12x growth in revenue this decade. But if we just look at the order book, and one metric I will say is from Airbus alone, for many years prior to last year, we'd gotten orders of 150 million. Last year alone was 1.13 billion in orders. That's a reflection of what the business has done from a quality standpoint. And our helps keep everything together in terms of making sure that discipline is maintained across a business.
Well, thank you for very comprehensively setting that up. And I think it also gives people a very clear indication that the Mahindra Group is much more than its auto business, which is traditionally how it has been perceived, or at least in large measures continue to be perceived that way. And in fact, just to bolster that point with some data, because I know that this is something that we've spoken about in the past, the auto contribution, both in terms of cash generation as well as to profitability, has come down considerably, given the fact that you've seen your other businesses grow quite significantly as well. Auto now, what, in terms of profit, about 25%, cash generated about 25% as well. Services, much higher. The farm sector division also much higher, about, what, 35% today. So the Mahindra Group has outgrown its auto business?
No, auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly. And farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to the M&M shareholder. And that's where you see the real value creation. And what we did talk about at our Investor Day is much of that value is not even captured because analysts don't give too much value to unlisted entities. And that's something that you will see in a value unlock going forward.
Well, I'll come to the value unlock in just a second. But since you brought up Mahindra Holidays as being the big headline maker this morning, let me go to Manoj. And Manoj, congratulations on Signature Resorts and the move and the foray into leisure hospitality. What gives you the right to win in that space, which is fairly competitive, and you already have large incumbents? What will be the key differentiator for you?
Thank you, Shireen. So as we looked at the market, clearly the first part I would talk about is what we have built over the last 27, 28 years is this whole association with family and creating, almost defining family holidays in India. And as we looked at the broader space, we felt that there's a wide space there where nobody is focusing on in creating premium family holidays, and that's one of the space we want to occupy. And that actually combines some of the strengths we have historically. Secondly, of course, we are a very large chain. Today, we are number 3 in leisure hospitality by rooms. And so clearly we have the expertise to actually scale up and run at scale. So that's the second point. And lastly, I do feel that experience is going to be the new currency. And if you look at experiential holidays, I think in a survey, 80% said that they would want an experiential holiday rather than a normal holiday. And as we think about that, if you look at what we do today, experience is embedded in what we do today also. I think that's the third leverage which we want to bring into this business. And clearly this is a positioning which is different from whatever everybody else is positioning as. And that's what I think will help us win.
And 1,000 crore rupee capex plan as far as Signature Resorts is concerned. And I just want to get some more numbers from you. So about 5,742 keys across your properties today. You're targeting, what, about 10,000 keys by 2030?
I think when I add both the brands, which is Club M and Mahindra Signature Resorts, we are targeting 12,000 keys.
Okay.
So it's a doubling of inventory from here. The split is 10,000 in the Club Mahindra brand and 2,000 in the new brand. And in terms of the capex, I think the capex is for Mahindra Signature Resorts. And the way we are thinking about it is the first few resorts probably we will invest, but as the brand develops, I think there are so many capital light models available today that we should be able to scale up with relatively less use of capital as we go forward.
And any plans on M&A in this space as well?
I think everything is open because I think as we scale up, I think whether we build, whether we buy, whether we lease, or whether we do management contracts, all avenues are open. So something we'll keep looking at.
Okay, something you'll keep looking at. I'll come back to you with more on just that. Rahul, let me come to you now as far as Mahindra Finance is concerned, because the articulation was very clear that this was a business that required turning around. Where do you feel you stand today in terms of that turnaround plan? AUM has grown about 13% year-on-year. Profitability, though, still flat at about 2% year-on-year. So take me through where you find yourself today, how comfortable you are, and what the growth plan and the ambition is.
Thank you, Shireen, and great to be here. We've kind of reflected on the last, actually more than a decade, because we've had very specifically 3 eras. And the first era after listing was a high growth era. We went through some challenges in the COVID and the demon period. But what's given us a lot of confidence is the last 3 years, because in these 3 years, our asset quality has remained quite pristine. We have kept GNPAs under 4%. And more importantly, a lot of the underwriting that we're doing now is giving our early book a level of stability that we will see will be good in across cycles. I just want to correct some of the figures on profitability. We had a pretty good year. In fact, in end of Q2, we grew above 45% in terms of profitability. Our loan book growth, you're right, has been a bit flattish. And flattish, 14% is not flattish, but it's lower than the peer set. But what gives us a lot of confidence in just drawing from what Anish put out as a target for Mahindra Finance, 5x in a decade. Just to give you context, we were about 60,000 crores at the end of FY20. That 5x would mean 3 lakh crores.
Yeah.
I would have felt extremely constrained if the playbook was just the auto and farm lending. What we have done is now we've expanded the lending book to 2 other big categories. So we are actively going to chase the mortgage opportunity and the SME opportunity. These 3 together to get to a 3 lakh crores is a CAGR of about 20%. So we feel much better equipped today that we have widened our participation. And the headroom for growth in these 2 segments, auto is still a big player. But the headroom for growth in these 2 categories is extremely formidable, and it's all about execution now.
Well, speaking of execution as well as the context of technology, and we're seeing that implemented across the sector now. What are the forays that you've made there, and how comfortable you feel in being able to deal with some of the execution challenges, especially as you attempt to scale?
Yeah, so our business model, Shireen, was because we were very, very decentralized. We depended a lot on last mile judgment. For a player who's now 1,30,000 crores, in close to 95% of the PIN codes in the country, we had to create a very decent centralized engine to understand how each of our branches was operating. So in the last 3 years, I'm very, very comfortable now that we use some of the best in category underwriting tools. We have a loan origination system, which is one of Salesforce's best system, which is used in the country today. And of course, TechM also powers us in a lot of our tech and digital. Mohit called out only his $20 billion club. We are slightly under that. But we use a lot of TechM's acceleration for our digital journeys. But Shireen, more importantly, because our customers range from progressive farmers to small entrepreneurs, we are not force-fitting digital. We are accelerating their digital maturity and kind of getting them up to speed, while also accelerating a lot of our assisted models, because 25,000 employees, they actually bring in a lot of new to credit customers, and using technology there as an enabler rather than getting somebody, intimidated by technology. That's the kind of deft walk that we do.
But Mohit, let's talk about what's happening as far as Tech Mahindra is concerned, because that was part of the other turnaround story that Anish had laid out. How comfortable do you feel today at Tech Mahindra with the way things are turning around? And more importantly, in the context of AI and what AI is being able to do, how much it's going to disrupt, what are you seeing on the ground?
Sure. So look, I think we've had a very good start to our journey, right? We announced our plans on the 25th of April, 2024. So it's now been 6 quarters in a 12-quarter transformation journey. And we'd announced our plans in terms of what we do for revenue. So we said we'd focus on our top customers, and our top customers have grown faster than the rest of the organization. We said we'd focus on large deals that made sense. We had a 57% increase in large deal sort of volume over the past 12 months. We'd said at the end of FY27, we'd be higher than our peer group average, and we were at the absolute bottom of the peer group when we started. We have climbed up from being at the bottom to now being middle of the pack, right? And so that journey is continuing. We spoke about a plan for margins and productivity. And when we made that plan for 15%, when we said we'd do 15, we were at 7.5 in terms of exit. We have now had 6 quarters of expansion from a margin perspective. We'd said we'd build a plan for the organization for the future. I think we've built a remarkable team from a ratings perspective, apart from the investor ratings, which just in our last earnings calls, we got 3 rating upgrades. But if I look at the industry analyst ratings, we've gone up from being in the top 2 quadrants in 60% to now being in the top 2 quadrants in 90%. And because you spoke about AI, the most important rating in that regard is from Gartner. And Gartner has rated us as a leader for AI and Gen AI. But in terms of the future vision for AI, we're number 1 globally, right? Ahead of all of our Indian peers, our American peers, our European peers. So I do feel that we've made good progress over...
When you say you're number 1 globally, what do you mean exactly?
So they have 2 axes to measure performance, right? One of the axes is, one is current functionality, where we're in the leaders quadrant. But the second quadrant is future vision for AI. What can AI accomplish for enterprise clients? And there we're number 1 globally. So I feel that, in 6 quarters, it's a very good momentum. We feel very confident, and we're completely committed to our F27 goals. And then beyond that, we'll sketch out vision for, for the next 3 years.
Yeah, so give us a glimpse of what the vision for the next 3 years could potentially look like.
I left my crystal ball at home, unfortunately.
Take us through, especially on the aerospace side, because that is the big opportunity that Anish was talking about as well. And also in the context of the larger plan for the government with the indigenization process, what that means for the business going forward.
Yeah, so Sharon, this is a business we started around 10 years back, and it's a very difficult business to get into it because the safety standard in making an aircraft is the top notch, and there is no compromise at all. And we have built the business in a manner that in 10 years we have earned the reputation in terms of our quality delivery and business excellence performance, where we are already rated amongst the best in the world. And we keep saying that we are punching far above our weight in terms of our reputation, and the business has to follow now. And it is indeed following. So the amount of business we won in the first 10 years of our existence, 6 times of that we have already won in the last 15 to 17 months. And God has been kind with our reputation. We have a huge pipeline we are working on. And Make in India is a huge support. So while the first assembly line of C295 has already come in India, and a helicopter assembly line is going to come, what's more important is that we have got the contract for being the sole supplier for the entire fuselage for the fastest selling helicopter of Airbus. And we will be supplying not just for the Indian assembly line, we will be supplying that fuselage for all the global assembly line of Airbus. And that's the faith Airbus has put on us, that if we fail, none of their assembly line can work. And hence, that's the reputation with which we are building the business. As we speak, we are already expanding capacity in our current factory. and we are running out of space over there. Yesterday I was with one of the state ministers requesting for land for setting up our new modern integrated large aerostructure factory, where not only we'll be there, we also will like to bring a couple of our co-vendors. Together we can start doing much bigger packages in India compared to the journey with which we started 10 years back. As I said, when we started, we were making parts which could fit in our palms. And today already we are making the assemblies, which are 5 meters in length, and which actually comprise of thousands of such parts which we make, we assemble, we machine, and then we supply the full assembly. So that's a very promising business, and globally the outlook of the industry is very, very bright for next couple of decades. So,
running out of capacity is a good problem to have, and that's certainly something the finance minister would be very happy to hear, because she's been urging industry to set up fresh capacity and kick off private sector participation in the growth story. So leave us with the headline numbers there in terms of capex and capacity expansion.
So we are looking at 12x growth in revenue. The board has already approved close to 1,000 crores of capacity enhancement capex, which we are going to use not only to increase capacity for the current factory to cater to the new orders which we have won, but part of that will also be used for setting up the base level factory for the new one. And of course, the investment will keep adding in that larger facility as we get more and more business.
The possibility of more joint ventures, etc., because again, this is a space that a lot of people are looking at Indian suppliers as becoming tier 1 suppliers for their global supply chain. Is that likely to also sort of be possibilities that you're considering at this point in time?
So as Manoj said, we are open to all ideas.
All options.
and as I said, there is a possibility of doing some packages together. Some of the capabilities we have very strong on metal side of our structures. We don't have composite capability right now with us. But if someone comes and together we are able to do a package which involves both aerostructure on metal side as well as composite sides, and together we can supply that part to a large OEM, we would be certainly open.
Certainly open. Amar, lots of people here are deploying a lot of money to enhance production. As far as the capital allocation is concerned, given the ambition and the aspiration that the group has, you're putting the guardrails in place to ensure that everyone works as per order. So take me through how you're looking at capital allocation at this point in time.
Sure. Before I talk about the financial deployment, though, I do want to emphasize that, this is always seen, it takes a lot of effort to create value. It takes one bad headline to destroy value. And that's first and foremost on my mind. Right? Whenever we are looking at what can the group do, we are also looking at what are the pitfalls that can come in the way and making sure we have guardrails. So while Anish has set a lot of strong processes in place for capital allocation. A lot of what we are trying to emphasize right now on is, as we go on this 15x, 20x growth, we don't fall into some of those pitfalls, right? So that's a big part. As far as capital allocation is concerned, the key is there is a business case for everything. And one of the things we do now very well is track how we are doing against the business case. And that doesn't mean that you can't deviate. It only means you use the deviation to learn and then come back on track. Or if you have to pivot, you pivot. So that's the big discipline we have brought in. As you know, the group operates with a structure of boards in all of its subsidiaries. The boards have a corporate nominee on them, and we use the nominees to drive a lot of that discipline, especially around the capital allocation. And every one of these leaders knows that there is there's a strong process for asking. Like Vinod worked really hard to get his 1,000 crores, and so is the case for everybody else, because it's a matter of choices, and you must, have a very strong business case to be able to realize that choice.
So who has made the strongest pitch to you at this point in time?
Actually, all of these leaders who are here are because they've, I think, made very compelling business cases for whatever they've asked for. I mean, the Signature Resort wasn't an easy sell. It's a big change from what was comfort zone for us, right? And to move away from comfort zone and go into 92% of the market that is underpenetrated, in our view, and is going to grow faster than the 8%, is something that requires a lot. So everyone, I mean, the farm business you saw has been generating a ton of cash, but the farm business also needs to grow internationally. So they've been working very hard to create a strong business case for where to go, how to approach it, what have we learned from some of the missteps in the past, and using that to do it differently this time around. So each of these leaders, I think, has done a remarkable
And I'll come to Vijay on the international expansion plans as far as the farm sector is concerned. But the man that we talk to most often after Anish is Rajesh Jejurikar. And he's, Rajesh, as I pointed out, you've been on the channel virtually taking us through what is happening as far as the automotive business is concerned. And we had you on post the GST cuts. And the expectation was that the demand, pent-up demand, would continue to be sustained even after those GST cuts and the festive season was over. What do you now see on that front at this point in time?
Shireen, thanks. And as Anish has said earlier, and we have to, that GST revision has really been a landmark decision by the government, and it should propel the overall economy on a very high growth trajectory. It will be seen differently in different sectors, but I believe the sectors which will see it most tangibly and are seeing it most tangibly are ones where there are commercial operators at play, and where people are using either vehicles or tractors for commercial benefit. Example, tractors or the LCVs in our portfolio. There, a 10% reduction in selling price has a tangible impact on total cost of ownership. And a lot of that, combined with interest rates coming down, has significantly improved the value, to use your term or Ramar's term, or business case for the operator or the tractor owner. So that's where we see the most immediate and tangible benefit. But the benefit continues even in SUVs. So we've seen a big upswing through the festival period.
Yeah.
The post-festival drop that is normally visible is not anywhere near what it used to be, which one can attribute primarily to the fact that there is momentum coming out of GST. So overall, we think GST is going to be a game changer. You saw that today we've announced, and Vijay will probably talk a little bit more about it, the long-term 5-year industry forecast for tractors, we moved from 7% to 9%. And one big contributor for that is GST, because the affordability of the tractor goes up, which when compared with cost of labor, starts making it a more viable proposition. So we do see a very strong growth momentum that will sustain in all the vehicles, including passenger vehicles, tractors, and commercial vehicles.
You're right in pointing out that GST has been a structural change as far as the auto sector is concerned. But, Rajesh, if I were to ask you specifically as far as the ICE portfolio is concerned, 4,500 cars at this point in time, you have a capacity of 8,500 cars. What's the expectation now in terms of run rate?
We have 2 new cars coming up, which we'll announce next week. Till now, everyone was expecting one, but Nal just a few hours back said that there's something else that's going to happen on 26th evening as well. So it is actually 2 launches that we're doing on the 26th, 27th. We have believed, Shireen, that the EV portfolio has a lot of learning, and we have to calibrate the organization learning as you're building a category. And the last 6 months has been, and which is the reason why, even though we were ready with some of the other products, we decided to phase it out. So that we build learning in the channel, the back end of the organization, quality, software, all of that. And I think we are at a stage where we're ready to ramp up. And hopefully Jan onwards, we should see the numbers go up. And that's how we had planned it, which is why when we announced the first 2, we had said the initial capacity we are operationalizing is about 4,000 to 5,000 a month.
You said that you intend to do 2 launches now. That's on the EV side. What about ICE? Will ICE largely continue to be a refresh story, or is there likely to be anything fresh on the ICE side as well?
So 15th August, if you'll remember, we revealed the new platform that we're doing, which is a new IQ platform. It's a multi-energy platform, so it will have ICE. The first lot of products which will come in 2027 are ICE products, and there's some really exciting products which we've shown media on 15th August, and today we're showing all the 4 concepts
to the investor group as well. So if you have a little bit of time, we'll walk you around those.
Let's talk about what's happening on the farm sector side as well as, and Rajesh's point and Anish's point and Amar's point about you looking at the international space and the international markets also.
Yeah, so Shireen, let me first begin by saying that the strong domestic position that we have in the tractor business is what helps us have large aspirations for international growth. And like Rajesh mentioned, with some structural changes with GST coming down, and also what we've seen in terms of horticulture and cash crop, the sowing intensity of that increasing, and the profitability for the farmers going up by about 5 to 7% in our regression model going forward, where both these factors account for almost 30% weightage in the regression. That analysis allows us to now revise that estimate of last year of 7% CAGR growth between 25 and 30 to now 9%.
Amit, as far as life spaces is concerned, the aspiration of being pan-India, and more importantly, what's the outlook now as far as the business is concerned?
Well, Shireen, this is a very local business. The national market share doesn't matter.
But the national players are moving into your markets.
Yes. And we'll welcome them with open hands and very good competitive pressure. But I think what we want to do is we want to be the top 5 player in our core markets. This is a very local market where you have to play the market share game at the city level. So Mumbai, Pune, Bangalore. So we have consolidated our presence from 6-7 markets that we are operating in the past. So these 3 markets. These markets are really large.
Okay.
Like Mumbai is 3 lakh crore, huge market. Our market share is 0.5%. The largest player's market share is 6%. So that, we need to play that game really, really smartly. The shift is happening towards quality players. So the unorganized sector players, unbranded players carry 70% market share, right? So we have a significant opportunity to actually take share away from unbranded guys, which have lost the ability to attract customers. Their funding costs are high. So we have significant room for capturing market share in each of these cities. So we're going to focus only on 3 cities and capture the fair market share that our brand deserves. So that's our plan is.
What do you see as opportunities opening up even within these 3 cities is concerned? Redevelopment, of course, is a big aspect of one of the potential opportunities for the sector.
Yeah, absolutely. And as you know, let's take Mumbai as an example. The infrastructure upgrade that we have seen is a once in a lifetime and actually lifeline for Mumbai real estate, Mumbai job creation. Many of the companies that never thought they can have employment in Mumbai, they're coming back to Mumbai. So IT companies, tech companies, GCCs, etc. This infrastructure unlock is significant. Now, combined with that, when this is happening, but most of Mumbai does not have vacant land parcels, right? So society redevelopment or joint developments or other forms of redevelopment becomes a key part. Our aspiration is to be number one in society redevelopment in Mumbai. And when this opens up in Delhi and other markets, we evaluate them very, very, dispassionately. But Mumbai redevelopment, society redevelopment, we are going to be number one. We already have had almost 8 to 10 wins so far against stiff competition. We have a strong team, and we are going to play a big role in society redevelopment.
A big role, and at least you've given us a very clear number as far as your aspiration for the Mumbai market in the redevelopment space is concerned. But I'm hoping that unlike your peers, you're going to leave me with a number on what you believe you're going to be able to do over the next few years in sales.
Yeah, so we have publicly now announced that we are targeting in this decade 14x. But if I have the support from capital, we can do more.
How much capital do you need?
This is like, every time I would go for a meeting to Anish, I was reminded of Subhash Chandra Bose. तुम मुझे खून दो मैं तुम्हें आज़ादी दूंगा. So I was like, तुम मुझे capital दो मैं तुम्हें return दूंगा, right? So that's.
How much money do you need?
So I have clearly outlined a plan for 4,000 to 6,000 crore. Keeping in mind what Amar said, that this is a business. One mistake can actually destroy significant value. So we have to be very, very clear about how we keep our balance sheet healthy, what kind of projects we sign, and that's something that we are going to be very, very diligent. We want to track each of our projects from an IRR perspective, and we do great projects which will give us financial returns.
He made a pretty good pitch, Amar. You're not signing off on the 4,000, 6,000 crores that he's asking you for.
The rights issue is a reiteration of the faith we have in that business. And I must mention, in terms of what we spoke about, the discipline that we're trying to drive around what is committed to what is delivered, the Life Spaces business has been an embodiment of that discipline. So that's why they got the rights issue, and there'll be more to go.
He's clearly Oliver Twist. He's asking you for more. But
you did say Anish.
But Suman, what's the headline that you're chasing after?
See, fundamentally for us, we need to ensure that this category, three-wheelers and small commercial vehicle four-wheelers, they electrify fast.
Yeah. So
that is our primary goal, to electrify the last mile of India. And while doing so, retain the #1 position in that. Today, we hold about 39-40% market share in the retails, and we would like to hold that as we continue forward.
Regulatory risk is perhaps one of the key risks as far as your sector is concerned. Do you see that is relatively benign at this point in time, given the fact that we've gone through a fairly volatile back and forth in the last few years? And more importantly, what would you see as being the big challenges that you have to face?
Yeah, thanks, Sharon. And lending is all about balancing between growth margins and risk. I think if you look at the regulatory arbitrage between banks and NBFCs for the last 5 years, that's really gone away. So the expectation from the regulator for at least the top tier NBFCs has been quite high, which meant that our practices got elevated to a bank-like status for the last 4 odd years. What that does from a resilience standpoint is it makes us kind of employ practices which will, for cyclical businesses, keep us in a good stead even when, let's say, there are credit cycles. I mean, liquidity was a constraint. Even the risk weights, that has, kind of been again addressed. So on balance, I think NBFCs were earlier a little bit more shaky when cycles were down. With what the regulator has done in terms of inherent practices and what a lot of us have done just to be much more resilient and swap in bank-like practices, control functions, very much like a bank. If you look at, the risk function, which looks at operating risk, credit risk, market risk, if you look at some of the compliance functions, all of that has really helped us understand that even in a down cycle, we will be much better off.
Okay. Mohit, one of the big risks, not just for you in specific, but for the industry in general, and that once again, existential question is being asked of the Indian IT services sector. What will AI do to the business model for the Indian IT services sector? How do you address that? More importantly, what are the capabilities that you believe you will need to bolster in order to make this shift and this transition?
Sure. So look, Shirin, if you look at it, right, every single technology transformation over time has been initially a headwind, but in the long term, a huge tailwind for the industry. And I almost see that we're seeing that transition again. From 18 months ago, AI will kill the IT services business, to 6 months ago, okay, maybe it won't kill it, but it'll clearly impair growth, to now maybe AI will actually be a huge tailwind for the industry. So we've seen that transition for every single industry technology cycle, right? Whether it was cloud or before that it was digital. And so I have no doubt that the narrative again is moving in the right direction, which is AI will be a huge tailwind for the industry. At the end of the day, our clients have very complex technology estates, right? They're hugely fragmented. So starting off with data, with applications, with infrastructure, they need to be simplified, they need to be modernized by people who understand networks very well, by people who understand, let's say, industrial and process manufacturing or insurance, underwriting, claims. So I have no doubt that it will be a huge tailwind for us at TechM. From a capability perspective, I think the first thing we need to do is obviously make sure that we're building out the platforms that allow us to use this technology effectively. We already, the first global SI to build a large language model from scratch. We're now doubling down on building a trillion parameter model now. We've also built out, a very significant platform with Nvida called TechM Orion in the agentic AI space. We're building ecosystem partnerships. We're building industry use cases. And now I think very excitingly, we're building a new model that allows us to price for human labor plus token consumption. So a completely transparent model, depending on the kind of project you're doing, data migration, application modernization, infrastructure. What is the combination of human labor plus technology tokens we will use? And I feel it will be, it'll be transformational for the industry.
Speaking of that transformation, Abanti and Asha, let me get you in on this as well. We're talking about making all of these strides and as far as accelerating growth across these businesses. But going back to the initial opening comment about purpose, how all of this ties up with the Mahindra Group's purpose, what it means in terms of your people, not just internally, but also externally, what it also means as far as the efforts on being sustainable as well. Abanti, I'll start with you.
Yeah, thank you. Pleasure to be here, Shireen. So I want to actually start with reiterating what Anish said at the outset, which is really that we stand on the shoulder of giants in the Mahindra Group who came before us. Because this is a group which had purpose in its DNA as it started out more than 75 years ago, and several industry firsts to its credit in the area of sustainability, long before sustainability and ESG became the buzzword today. So where we are today is we have a very clear strategy. Just as all the businesses have a strategy, we have a very clearly laid out planet positive strategy at the group level. And what is exciting is that each of the businesses, all the business leaders sitting around and many outside, actually own the strategy along with their teams and are driving it.
Asha, you want to add to that?
Thanks, Shireen. I just want to start by saying that last month, exactly 80 years ago, we released a print ad in the Times of India. I know this is CNBC, but it's a print ad. But yes, that ad actually spoke about values. It did not speak about products or services. And the point I want to make is that these values are actually in existence across all businesses even today. So when you look at ethics, when you look at dignity of individuals, when you look about excellent business practices, Amar spoke about governance, those values are all there in the companies, in all our leaders, and that's what we bring to our work every day. The second point I want to make is that these values actually are the short form or become the bedrock of RISE. And when we think of RISE, we don't think of it as just a purpose statement, but it's really in the actions.
You know, Anisha, 14 companies that we're speaking to today, is there enough on your plate, or like insurance, is there anything new that you intend to move into at this point in time?
We did mention to investors that we would look at one new area in the next 12 months with a very high bar. We had exactly the same slide that we put up a year ago. And at that point, we had said insurance is one area we would look at. We have gotten into insurance in a space where we feel we can create very meaningful value for our shareholders. And similarly, if we find a space we can create meaningful value, we will look at it. We do play in 70% of India's GDP growth over the next decade. And therefore, our current businesses have huge room to go. And you're seeing that room to grow with holidays. You're seeing that room to grow with many of our other businesses. We've also talked about organic growth. Organically, we've grown 25% a year for the last 5 years across the group, despite being in some tough industries as well. And we plan to grow 15 to 40% organically for the next 5 years across businesses.
So is there anything at this point in time that you are remotely excited about, that you feel that you could look at getting into at any point in time?
We have a long list of things that we are looking at.
Have you shortlisted? Have you shortlisted anything? Is there a top 3?
There is no top 3 at this point. When there is, we shall have that conversation.
You're the harder customer to deal with, right? Or the hardest customer to deal with as far as these CEOs are concerned.
I'm learning from the best.
Well,
I'd say that's a good thing.
It certainly is a good thing, and perhaps also learnings from the past that you're putting in place. I mean, which is why they're having to make to really sort of hard sell their businesses to each one of you.
I started the Investor Day today by a token of gratitude to our leaders from the past who really built a very strong foundation and reminded everyone that M&M has been the best performing stock in the Nifty from 2002 till 2018 and has regained that spot as being the best performing stock for the last 23 years now. But that doesn't happen easily. And the investments that our leaders have made at that point in time have enabled us to be who we are today. So we clearly owe them a huge token of gratitude. Yes, there are some lessons from the past, and the basic lesson is we have to drive profitable growth. We have to play in areas where we can scale up. What we tell our teams, think big, do less, and execute flawlessly. And that's essentially what we're following here. The real estate business has shown a tremendous amount of focus on profitability. And that is what we were looking for. As they've done that, we've opened the coffers to say you will get more capital. And there's more capital coming from the outside. There are multiple folks who effectively wanted to partner with us. They are eager to give us more capital. We've held them at bay for a while to say we need to be convinced the business is profitable. The business has shown that. We're now opening the doors for that. So there are many pools of capital available.
So where do you see the external capital coming into soonest?
I would say real estate first. There are multiple conversations underway where folks want to come into specific projects.
Private equity?
There have been huge wins. It's a set of folks who are looking at long-term, who are pure equity partners, and who like the story that Mahindra Lifespaces has today, because it's very well positioned from a brand standpoint. And Mahindra, for example, is a 37-acre plot of land in Mumbai. There is another 35 to 40-acre plot of land in Thane. There is a 120-acre plot of land we're looking at. There are other smaller, what we call world cities that we're looking at. So there's a lot of excitement in life spaces. Key is maintaining profitability and delivering what we commit. As long as we do that, there's plenty of capital available.
So would it be fair or an unfair question to ask you, are there favorites here on the table for you? on the back of the potential that you see?
We have done the pruning where we exited 15 businesses. So at this point,
each one of them is a favorite. So let me quickly go around the room, and Rajesh, I'll start by asking you vision for 2026 and the vision over the next 5 years. What do you hope to complete?
We can't call 2026 a vision. It's almost a budget. So yeah, Shireen, we don't put out guidance, but we have this time to say that our businesses are going to grow multiple times in this decade, and we are very, very positive and optimistic on every business that we are in. The SUVs is doing very well, and there's a lot of upside. The LCVs as well.
And tractors, we put out some specific industry numbers, and we stay very positive about the next,
I like the
next 5 years.
Industry-specific numbers.
Well, we're not going to lose market share, so we'll grow at least that much.
You'll grow at least that much. Mohit, I know, try and manifest a little bit before we say goodbye to you.
I'm going to put up the vision board. Look, I think, we put out a very clear plan for FY27, right? At the time we put it out, candidly, most analysts didn't fully price for it because they said, look, this looks really, really difficult in terms of margins, in terms of growth. But over 6 quarters, we have demonstrated resilience and performance towards the goal. So if you think of it, as a plane, we were taxiing, now the wheels have left the ground, and beyond FY27 is the time to go supersonic.
Go supersonic. You're going straight from taking off to going supersonic, and perhaps that's the best segue to come to you, Vinod. How quickly do you believe you can go supersonic with your business?
So, Shirin, as Anish said, we are sitting on a huge order book right now, which we have won in last 1.5 years. And the priority for F26 is very clearly to industrialize those packages, which in this industry takes a couple of years. And once we industrialize, then the revenue starts kicking in. And the most important thing which we are right now doing, which we are actually paranoid about, is that we are on one hand, we are delivering the orders which we already have executed. On second hand, we are doing industrialization. And we have to do both very, very well without losing the reputation we have built. And that's clearly is our priority for 26.
That's the priority. Manoj, of course, Signature Resorts, I would imagine, is going to be the key priority as well as the key ambition.
Yeah, so of course we are in a growth market, so I think Signature Resorts is one new foray which we have articulated. But really, I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously it will take a lot of time and attention, but scaling the core remains important too.
Nal?
F26, I have a must-do target, Rajesh said he. So we have to do mid to high teens growth in our SUV portfolio and high single digits and not lose share in the LCV portfolio. But over the 10-year period, we have a 8x target in terms of revenue top line for the auto business.
8x target. Amit?
So we have F27. We are pre-sales 4,500 to 5,000 crore. We are at 2,800 crore, so significant jump. For F30, 10,000 crore sales, which we'll try to accelerate sooner, which will be over a period of decade, will be 14x from where we were in F20.
BJ?
Well, I think the focus will be on 4 growth vectors. Create a fortress around a domestic business, scale up international, scale up farm machinery, pioneer technology. Do all of this to deliver a 3x growth in revenue and meet our aspiration of impacting farmers' lives globally by pioneering technology. And do this through think big, do less, and execute flawlessly.
Suman?
Over the last 3 years, we have delivered 5x EV volume growth and put 300,000 EVs on the market. Our aspiration is to close the decade with 1 million EVs on the market. Okay. So that's across all the categories.
Across all the categories, 1 million of EVs on the road. That is the aspiration and the target as far as you're concerned. Avinash?
I think it's execute well on the projects that we've already won. Focus on winning new bids, especially more complex ones that are able to deliver peak power using batteries. And then ensure that the projects that we have built focus rigorously on quality and then recycle capital so that they can go back into new projects.
Rahul?
I'll draw from Anish's slide today where he positioned TechM and Mahindra Finance under unlock full potential. So clearly there's a pivot to growth. I think that growth will be on a couple of pillars. Number one is defend our vehicle business. Number two is grow our fee-based income. And number three is build adjacencies in mortgages and SME.
Okay. Amar, which is going to be the most crucial metric that you're going to be watching closely and chasing after over the next 5 years?
I think for us, the growth momentum is there. I don't think that's going to be, I think Anish already laid out a 15 to 40% growth metric across all our businesses. So the growth metric is there. I think the profitability and the ROE must stay to what has been committed externally, the 15 to 20% growth in EPS and the 18% ROE commitment that we have made, because that's the discipline that will make. For me, the big thing going into the 30s is going to be, there are a lot of Indians who are admired for being CEOs of big global brands. We want Mahindra to be the Indian brand that's admired globally. Right? And I think that will all come from all of this that you've just heard today.
Well, Anish, the pressure is clearly on you.
The beauty here is the leaders we have here are absolutely incredible. And therefore, that makes it much easier. We are building on a very strong foundation. And we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade, from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespace is 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
Well, as they say, success is on the back of strategic decisions and strategic choices that leaders make. And each one of these leaders here has articulated very clearly what they're chasing after, but more importantly, what they don't intend to go after as well. Thank you very much to each one of you for joining us here today, for giving our viewers and, of course, investors a very clear indication of the road ahead, the map ahead as far as the Mahindra Group is concerned. We wish you all the very best of luck as you fulfill the promises that you've made here to Amar, more importantly, and to Dr. Anisha. But thank you again for joining us. With that, it is time for us to wrap up this edition of On the Record with me, Shireen Bhan, from here, from the CNBC-TV18 team. Thanks very much for watching. The news will continue right after this break.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Ritu Singh. These are the top headlines from the startup world. Online trading platform Grow reports a 12% jump in profits as lower employee expenses offset higher marketing spend, but revenue and active clients decline year on year even as market share expands. Semiconductor startup Sofrosine Technologies raises $2 million in seed funding. Round was led by Blue Hill VC. Startup recently cleared technical diligence and was awarded METI DLI grant of $1.2 million. Proceeds will be used to accelerate its transition from prototype silicon to full-scale development and global OEM engagement. Ola employee death probe moved to Central Crime Branch after family seeks independent, time-bound inquiry. Bengaluru engineer's 28-page note alleges workplace harassment, unpaid dues and heavy pressure by senior officials, including CEO Bhavish Agarwal. AI video startup Luma AI raises $900 million in new funding round led by Saudi AI company Humane. The two companies are also partnering to build a 2-gigawatt AI supercluster dubbed project called Halo in Saudi Arabia. Luma AI is now valued upwards of $4 billion. Bitcoin falls to its lowest levels in the last 7 months, dropping below the $86,000 mark. The entire crypto market has shed almost $1.2 trillion in value since October. Investors are reducing exposure to riskier assets amidst fading expectations of another Federal Reserve rate cut next month. Those were the headlines that we're tracking for you this evening on What's Brewing Today. Online trading platform Grow's profit jumped 12% in its first set of earnings after a stellar listing last week. This as a 9% fall in employee expenses offset higher marketing spend. However, revenue fell 9% and active clients declined year on year, even as the company's market share expanded. Vivek Iyer is here with the key highlights of the firm's numbers. Vivek?
Well, that's right. So 60% higher since listing, and all eyes on India's largest discount broker as to how exactly quarterly numbers would pan out and whether they could live up to the kind of stock performance that's actually come about. Now, immediately post the results, the stock actually popped up 5%, but it has cooled off since then, and let's understand why. First up, number one, when you're looking at the results on a year-on-year basis, the revenues have actually gone down almost 9% on a year-on-year basis, and this is a bit of a concern. However, aided by lower operating expenses, aided by lower costs, actually you're seeing the operating profit. Now, operating profit here is measured without the interest cost. That has actually improved both on a year-on-year basis as well as on a sequential basis. In fact, both year-on-year as well as on a sequential basis, the operating margins have actually jumped up higher. And profitability on the back of that, both year-on-year as well as sequentially, has gone higher. But the key thing to watch out for is the fact that during the time of listing, the management told us that FY26 is going to be a year of growth, and they're expecting to see a top-line growth in the range of 25 to 30%. But at the end of H1, it's actually been a bit of a degrowth as far as growth is concerned. So there's a lot of heavy lifting to be done as far as H2 is concerned in order to go ahead and meet the management guidance. Also, when you're talking about cost, the management had said in tandem with the growth that they're expecting to see on the top line, they're expecting operating costs also to go higher. So it'll be interesting to see how exactly H2 pans out, and also what the management guides for, especially as far as the investor call is concerned.
Right, Vivek. Many thanks for those details. Now, moving on, Pivot.ai, an insurtech startup focused on building trusted AI for the global insurance industry, has raised $7 million in a Series A round led by Stellaris Venture Partners with participation from Y Combinator and Arali Ventures. The fresh capital will be used to scale its flagship underwriting platform, Cure, which automates the entire underwriting workflow, from intake and document processing to research, risk analysis, and decision-ready outputs. In an industry struggling with rising submission volumes and limited underwriting talent, Pivot.ai says its system delivers up to 85% faster underwriting cycles, higher gross written premiums, and sharper risk selection. Joining me now to discuss this further is Akash Agarwal, the founder and CEO of Pivot.ai. Akash, thank you so much for taking time out and being here with us on Startup Street. You've raised these funds. What does this fundraise milestone sort of mean for Pivot.ai's growth journey and your mission to build trusted AI for underwriting? If you could take us through what you're basically solving for.
Yeah, thank you. Thank you so much for introduction. I'll quickly walk you through the problem statement first. in commercial insurance underwriting, it's completely broken. The underwriter don't have tools. The data are present in silos. Still a lot of manual data entry, which is happening across the entire workflow, which is impacting the operating margin for the insurance company. If I give you an example, for example, if you're a media house and if you need an insurance policy, you go to insurance companies and there is an underwriting team who will ask for a lot of documentation from you. It can be documents around your employees, it can be documents around your sites, it can be a documentation around the claims you made. They ask for all these documents over an email where you attach all these information and send it to them. Now, from an underwriting angle, if you see, there are a lot of documentation they need to manually review, scrape the data out of it, and feed into their actuary models or the pricing models they have built. The problem with this entire process, it is like hundreds of attachment attached to an email where it takes like weeks to do it. And the secondary problem is there might be information which you have not shared with an underwriter. For that information, they either need to come back to you and ask for these information, or they need to go to a third-party data sources and get those data. The second problem is like if data is inaccurate, and if you are sending inaccurate data, they are taking decisions on the top of inaccurate data, which creates a bad decision.
Sure.
They will have an impact on it. So this is what Cure does. This is what we have built, which is a centralized underwriting risk environment, which automates from the application you shared to an underwriter.
Absolutely. Right. And how will this new capital sort of accelerate development, adoption of your Cure platform across the insurance industry? And which segment of feature right now is seeing the strongest demand from carriers and MGAs?
In terms of capital, I think we have built a different set of we have solved a different set of problem across the entire workflow. The most demand comes around the accuracy of the data, because this is very critical for the insurance company. So the way we have built the entire system is more around a trusted AI, which will make sure the data, whatever we are sending to the insurance company, is highly accurate. We are finding we are getting interest on the entire workflows. Even like there are smaller companies which is asking for a one module where we can automate, let's assume, data extraction or might be a risk analysis for them. And there are bigger companies who are actually looking for the entire set of product which solve end-to-end problem.
Yeah, and if you could kind of take us through the kind of customers you're currently working with and the impact that you've already driven for them, and how are you sort of helping insurers scale efficiently without, compromising accuracy or trust?
Yeah, so in terms of customer, we work with every company which does underwriting in commercial space. In terms of our trustful, the way we have built our entire trustful AI is one, we have made entire AI very specific to the commercial underwriting, so it will give very high accuracy on the like when we are sending a data, it is very highly accurate. The second, what we have built is we have built an agentic platform. What it does is it does automatic QC, and it also does automatic correction, and which is fueled by underwriting services. So at the end, whatever data we are sending back to the customer is super accurate, and they can trust on it. They can take decisions on the top of it.
Sure. And, if you could quickly tell us, you're also looking to deploy the funds towards deeper data partnerships to make your offerings more adaptive to new lines of business and emerging risks, right? Could you take us through what the plan is here quickly?
So we will going to invest a lot in R&D, where we are building more risk models for the emerging market. So there are a lot of new market where the risk is not yet placed and there is no framework around it. And the industry would need very high accurate data on the top of it. So we are building more and more risk models, which they can use for the emerging risk also. And also in terms of deployment of the capital, we are working on distribution models where we can go to upmarket, bigger customers. And we are also scaling in terms of our entire team size across different departments.
Right. Yeah. And, what about revenues? If you could take us through what you're currently clocking and what's your biggest market? Because US is where you're primarily at. What's the plan for India? Any other markets you're looking at to expand into?
Right now, we are super focused on the US market, but definitely this problem exists across globe. So Europe is one of the next market we would have, and India is also growing in terms of commercial insurance space. So definitely we'll start looking at those markets. But right now the super focused is on US market. Once we achieve it, then is the time when we start looking for the other markets also.
Sure. And where are your revenues at, and where do you hope to end this year?
We are trying to grow 3x in terms of revenue every year. So the next year plan is like 3x, and that is what we are preparing for now.
All right. All right. Thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much.
And moving on, it is Friday and it's the time to take stock of all the deals from the startup world. According to Venture Intelligence, this week saw a total of 19 deals worth $99 million. Some of the notable deals include rural vehicle platform Tractor Junction, which raised $17 million from InfoEdge, Omnivo Partners and others, while battery tech startup Loham got $15 million from Bearing India, Singularity AMC, Asiana Fund and others. Logistics tech startup Pidge bagged $13.63 million from Haystack Investment, Mountain Partners and a whole host of others. That's not all. Digital freight forwarder Agraga got $11.27 million from Bajaj Finserv, Ivy Cap Ventures, while financial ops automation enabler Blue Copa raised $7.35 million from Bloom Ventures, Dallas Venture Capital and others. According to Venture Intelligence, this year has seen a total of 838 deals worth $8.5 billion. And on that note, it is time for us to head into a short break. But coming up next, Shiprocket's top boss, we put him on the hot seat as he outlines the firm's path to Dalal Street and its next phase of growth. Stay tuned.
Welcome back. You're watching Startup Street. Now, it's been a busy season on Dalal Street with a spate of IPOs, consumer and tech companies lining up to come to the market. And the latest one to join that queue is Shiprocket, with the SEBI recently approving the 2,300 crore rupee plus IPO. So today, we put its founder, MD and CEO Sahil Goyal on the hot seat. Sahil, welcome to Startup Street and thanks so much for your time here. Let's start with that IPO question itself. Why now? What made this the right time for Shiprocket to come to the market?
See, I think Shiprocket is building a platform which is built like Rails for e-commerce. And we have been at it for over 13 years, right? We've tried various parts of this and continuously have been building the invisible layer on which, marketing, payments and shipping runs. We believe that this is a business that compounds with India.
Yeah.
Because if you think about the coming e-commerce market, which is going to be tenfold in the next 10 to 15 years, we believe that newer forms of commerce will take place. So we think that commerce will become more hyper-local or quick. It'll become more personalized, right? More many-to-many vernacular. It'll become agentic now with AI.
Yeah.
So with this kind of fast-changing world of commerce and India's transformation, I think it's very difficult for one to put a monolithical idea to say, okay, this is how the future of commerce will work. Instead, we are trying to build our business like a box of Lego blocks, where we're saying, look, I'm going to build all the blocks to do marketing, to do payments, to do capital, lending, to do returns, to do all of these things. And then people can build on top of us, right? So no matter what kind of commerce comes to India in the next decade, we'll be there to power, right, the back end of the thing and to become the backbone, essentially. So for this kind of model, right, our build is a long-term build. And we believe that, this is something which needs to be kind of institutionalized and immortalized and put into the mix as a disciplined 100-year, vision company. And for that, I think for the last 2-3 years, we started thinking about the IPO, and we felt that the best way to align shareholders, customers, everyone with the same goal is to take the company public, right?
So can you give us a sense of what kind of timelines you're looking for, for your IPO?
I think we're pretty close. So you should see us in the next year.
Well, next year is 12 months long. Any more specific timelines as to when we'll see Shiprocket get listed?
Early next year.
Sahil, while I understand you cannot comment on the valuation yet, would you weigh in on the debate, especially with the recent listings? You were last valued at about $1.2 billion in your, private fund raise. What is your expectation on that front as you do go public?
See, I think our expectation is not on a certain valuation number, to be very honest, because this is not an exit event. This is not a liquidity event. This is a new start in a way where, there have been supporters, shareholders who've been with us for a decade, and they're going to be supporters, shareholders for the next decade. The company is growing up. It's a teenager now, and going into this next phase, right? It's really the beauty is in the eye of the beholder. That's the only thing I can tell you, because valuation isn't something I think that we are not aspiring for that. We are aspiring for impact. We today are about 200,000 merchants strong. We want to be 1 million merchants strong, right? Create 1 million profitable businesses by in the next 5 years maybe. And then in 10 to 15 years, we want to power 10 million businesses in India out of the 60, 70 million that are there. To do that, whatever it takes to kind of, whether it's about going public, whether it's bringing the right partners, whether it's raising more capital, whether it's doing M&A, whatever it will take to get to that journey is what we'll do, right? So to me, it's just a means to an end. Like it's a way to actually get to the next step. I don't think it is the goal, right, at all.
Well, let's talk financial, Sahil, because Shiprocket has been able to narrow its losses to about 74 crores for FY25. Is that trend sort of sustainable as you go public? And how soon, before the company is able to report a full year profitability?
See, I think Shiprocket understands the meaning of profitability, right? We turned profitable as a company in 2019, 2020. And, our core shipping business has been profitable since then. We're delivering double-digit crore EBITDA, right, in that business today. And what we did as a, box of Lego blocks is we built one, took like 7-8 years to build it, scaled it, became pretty, meaningful in the market, and then started building the other blocks. And then we didn't build one, we started building 3 together, 5 together, 6 together. And now we have this playbook to say, look, this one business generates a ton of cash, right? We invested back into generating future growth engines, right, which can grow at 2 times, 3 times the speed of the main bigger business. And if we can keep doing this, we have an unlimited, growth life, we have an unlimited profitability, we have an unlimited kind of runway as a company, right? Because this model allows us to be prudent about where we put our dollars, right? Allows us to actually act like capital allocators, right? Which I think comes later in a company's journey. I think we've been lucky to be able to have, found very strong PMF in one product, which is now scaling and growing and generating cash, and have the liberty and the luxury maybe to be able to invest behind newer products. So I think the answer, whether we expect to see full year EBITDA or not, I think it's already there in the way it's designed, right? It is really up to us in some ways and our shareholders, right, to figure out that, okay, where do we trade off cash for growth? When does it make sense, and in which things does it make sense, right? So would you do a gross margin negative business and put cash into it? Of course not. I don't think it makes sense. But if you could do something where you could invest ahead of time in building capability, building the infrastructure, building the digital rails and so on, that can compound over time, because we've seen it with one business. So I think it's a long term, is the company going to make money? Of course, right? It's obvious.
But how do you weigh in on that debate of growth versus profitability? What can you guide your investors as the company goes public?
See, I think if investors are looking only for profitability and not, so I think they're looking for growth, right? Ultimately. And they're looking for growth which is sustainable, right? And I'm saying we'll do whatever delivers the best result there. If you ask me that, will you optimize for EBITDA or optimize for growth? Again, I think the answer is there, right? At a sustainable level, always optimize for growth, because that's what, that's what the whole world's about at this point, right? And if it's unsustainable, then definitely do not find the right business model and then go behind it, right? So I cannot give guidance in saying, oh, you know what, we're going to now start delivering profits. Honestly, that means we are not able to then invest in growth. And there will be a point when that happens, and it will be organic. Like, I don't think I can time it. I don't want to time it, right? It's something where we're saying, look, we're continuously investing behind, solving this huge problem that affects millions and millions of people, right? We've done one part of it. There are 10 parts left. We've got 10, 15 years of execution. Where do we use our cash and how? That is the question, right?
Sure.
And I think it'll emerge, right? As we go through these motions, it'll emerge where do we put what? And does it mean that, we deliver stellar EBITDAs in the first 2 years? Or does it mean that we deliver stellar growth in the first 2 years? And then how does that change every 2 year set, right?
Okay, all right.
Hard to be able to, put it out there as a fixed answer, because then I'm being unfair to the market and to even shareholders, to be honest.
Well, let's talk about the revenue mix as well for Shiprocket. I mean, 80% of your revenue still come from your core businesses and about 20% from your emerging businesses, which is a mix of, payments, lending, cross-border and whatnot. How will this mix evolve once the company goes public over the next few years? And what do you believe will be the faster growing verticals?
See, I think our mix will continue evolving in the favor of emerging becoming bigger, right? The reason for that, I mean, again, can't give you a percentage as such, but it's 20 to 25% today, and it's inching up, right? The reason for that is that, the way I describe the business, the growth engines itself are obviously growing faster. That's why they're taking in investments in building today. And we think that, there will be breakouts. Like, if, for example, there are 3 main parts of our growth engines, or the emerging business as we call it. There is the omni-channel logistics bit, which includes, so think about brands who become bigger with the core shipping business. They start needing, let's say, 2-day delivery, Prime-like experiences. They now need dark store, they need hyperlocal, they need all of these kind of non-traditional e-commerce, let me call it. So that business got built 3 years ago, 4 years ago, starting with a warehousing network, and it's become meaningful number now and growing, like I said, very rapidly. Thanks to the tailwinds from quick commerce, thanks to all kinds of new innovations happening in commerce. The second one is our marketing stack, which includes our fraud engine, trust engine, checkout in payments. It includes our multi-channel marketing automation stack. So there's a bunch of features inside it that again is an essential part of any merchant's journey. And what we realize is that all the merchants who actually ship with us, they are running these other parts of their business somehow as well. So it's not even like we have to go and acquire them. A lot of these customers are running marketing in thousands of crores. They are spending money in trying to do logistics outside of commerce, outside of courier. And that's where we are trying to actually go and attach and to say, look, we can do this for you. We've done one part. And when it all comes together, it actually works better, right? It affects both the shipping as well as the newer parts. So marketing is an essential part there. And then cross-border is something we've been, very excited about. I think lately there have been some macro changes in the world where there have been some, some level of uncertainty, let me say. But at the same time, that business, I think, is just well poised in terms of the rails that are getting built, the unique networks that are getting built, the partnerships that are getting built. And I think in the long run, as India starts developing into a manufacturing hub, into an export hub, we will definitely be beneficiaries of that in the long run.
So what would you say would be the growth engines for the company, so to speak, going ahead?
See, I think we power a certain percentage of India today. So let's say if India is 70 billion, 80 billion in e-commerce, let's say 70 billion, we are about 4-5% of India, right? I think the vision is to be able to power 10% of the future of India. And the future of India looks very big. So if you look up the numbers, there's anything from 700 billion to 1 trillion in the next 10 to 15 years, right? Just from news. As being able to power 10% of that is a very meaningful number for the company in like 15 years, 10 years. So I think that is the ultimate vision. And we see commerce developing very differently. Like, I'll give an example. We've got merchants who are not using a storefront at all. They might be using a YouTube ad or a YouTube video, like an influencer video. They put a phone number there, people DM them, and then they process their orders on cash on delivery. So this is happening in tier 3, and it's not small, and it's happening more and more, right? So the thing is that we can't imagine, like after 5 years and after 10 years, what does e-commerce look like? Well, I don't know, right? All I'm saying is we can't imagine, I can't imagine, and we also can't imagine what a high GDP per capita makes the country look like. And I think it is this lack of imagination or the inability, let's say, for us as humans to be able to sort of imagine this well, which stops us from imagining the future well, right? But the reality is, if you put facts together and you think about it, if the market's going to 10x, right? Is it just going to be this? Like if the landscape looks like something today, where you've got marketplaces, you've got a couple of other ways of doing commerce. This was done in a low trust India, right? Which we are still evolving from. But I'm saying 10 years out, are we going to be low trust? Are merchants going to be non-digitized? Are consumers going to still kind of, so I think if you think about that and you think about who's going to be buying in 10 years, who's going to be selling in 10 years, and then what do they need? I think the picture starts to emerge, right? In terms of, what are the opportunities available. So I think it's a huge market, and, we will be very, very present, right? Maybe invisible many times because we're kind of the backbone, but we will definitely be present in many, many aspects of this market, and will be a large spread.
All right, Sahil, we'll leave it at that, and we wish you the best with your upcoming IPO. Thanks very much for your time here today.
Thank you so much. Thank you for your wishes. Thank you.
Okay, on that note, we're going to wrap up this edition of Startup Street. Many thanks for tuning in. It's a goodbye from all of us.
Hello and welcome to a special Market Masters edition that coincides with the end of the second quarter earnings season. The question we're asking our guests is whether the results season shows a clear recovery in Indian earnings, and hence, will the foreign investors return? Our guest today is Timothy Moe, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs. We have invited him because Goldman Sachs has just turned overweight on India from their underweight position almost 13 months ago, since October 2024. Timothy, thank you very much for coming into our studio. That's
thank you
making
very
it
much.
all the better. Okay, well, straight away, why have you turned overweight on India?
Really, Lata, the reasons are that the causal factors for engendering our downgrade 13 months ago, as you mentioned, have dissipated and look as though they're turning aside. So to be specific, we downgraded for two main reasons. One, that a lot of India's good news got priced into the market valuation in September, October of last year, when the market was trading about 25 times forward earnings. So we've been very positive in India, as many people have been, but felt a lot of that was in the price. So that was number one. And number two, we had a developing conviction that there would be what we were terming a mid-cycle slowdown in the economy and in earnings. And as I'm sure you're aware, when you have a richly priced stock meeting a downgrade, you tend to get some hyperactive move to the downside. So we just felt, look, let's step back here and take our foot off the accelerator and take our view down. And we're fortunate that our timing was reasonably apt. And since then, India has underperformed by the most in a decade or two, particularly compared to China, which has come out of its doldrums and has had a very good year. So if you look at the scorecard for year-to-date market performance, China's up 35%, and India just recently was up only 2-3% in dollar terms. And that's MSCI India, but Nifty pretty much the same. So what we figured, to your question, is, well, number one, there's been some moderation in valuation. Not colossal, but the market was coming down to maybe 22 times. So it kind of grown into its valuation to some extent. Number two, quite clearly, the economy had slowed down, but was showing signs of stabilization. And in fact, even has printed above expectation numbers for second quarter of calendar year, first quarter fiscal year. And we've been toning up numbers overall. And then at the market level, there's clear signs that the persistent downgrade cycle for earnings has really stabilized. If you look, for example, at a measure of breadth, number of analysts downgrading versus upgrading, and this is your zero line, we got to really, really deep. Almost everybody was downgrading. Now it's basically flat, and even there's a touch of upgrades. And if you look at the most recent quarter, which you mentioned, the expectation coming into that was about 9% year-on-year growth for the full market. It's actually going to come out more like 14, about 5 percentage points above. So it really, there are signs at the earnings level that things are coming into play. So you put all that together, and we just feel that the risk reward for India is now turning more favorable, especially because foreign investors have sold, since they started selling last year, about $30 billion US in this downgrade, this down selling time, which is the second largest in absolute terms and relative to market cap on record. And even year to date, there's about 16 billion in net selling, which has gone on. And so if you've got lighter foreign positioning, you've got an economy which is stabilized, looks like it's picking up a little bit. Earnings, we think, will grow on a compound basis, maybe 13, 14% next couple of years. Market valuation is still rich, but acceptable. We did a bunch of work on that. We just feel risk reward looks better for India. So we figured it's time to pull the trigger.
Very good. That suits us. But do you, which sectors are you impressed with? Are you impressed mostly with consumption? Because that's where the government has given everything it can. Rate cuts, tax cuts.
Indeed, Lata. So we very much like the mass consumption theme. So I'll answer your question this way. There are a number of themes that we particularly like, which, as I said, to start with your question, would be mass consumption, because obviously the underlying dynamics, demographics, large population, per capita incomes are rising, people's consumption habits change. This is your classic sort of developing market or developing economy story, and we think that India has much to play for in that regard. Additionally, we like the theme of self-sufficiency, and this plays into defense, into energy sufficiency, and so forth. So there's a lot of aspects there. Our analysts just did a very large report, 140-page report on initiating on the Indian defense sector. And defense is a theme which we've liked regionally and globally, and I think for many reasons, which I'm sure we'd all agree with. Yes. In a fractious geopolitical environment, which we find ourselves in today, the theme of defense is one that's played very well, and we think India has some catch-up to go in that. And so we're quite excited about that theme, along with the theme of energy sufficiency. We also like the theme of the new economy. This is leaning into the digital economy and more delivery.
E-commerce.
Correct. Yeah, e-commerce, fast delivery, all that sort of stuff, where you see a transition from your analog to digital economy. It's not a theme unique to India, but there's a lot to play for in that regard. And then just simply the theme of high growth, where we find there are many companies that are offering good growth opportunities, particularly in the smaller mid-cap space, where you've got early emerging companies that tend to do better. So we like those four themes. And then from a sector perspective, that will be manifested in a number of the consumer areas in terms of durables. Some of the financials, the banks have particularly come out of a period of credit constraint. And so we actually initiated an investment view of longing financials versus Nifty. We thought that was an interesting catch-up performance trade for the banks. And then some select higher growth areas as well. So that's sort of our view within the market.
Okay. Just zooming out, what would be your pecking order, since you specialize in all of Asia? What's the pecking order in terms of countries in Asia?
Well, it's a great question, and frankly, we're a bit spoiled for choice here, because we like a lot, and I think the trouble we're having in terms of finding things that we don't like as much is, I think, an indication that the broader appeal and potential for Asian equities actually still looks pretty good, even after a very strong year. MSCI Asia Pacific ex-Japan Index is up 25% this year, and 40% off the lows in early April. And so we think that can continue into next year for reasons we can explore a little bit later. And as I said, we're somewhat spoiled for choice. So to be more specific, we've had a very positive view on Korea, which is the superstar this year.
Because of the AIs.
Yeah, stratospheric performance. It was up actually up 90% nearly in dollar terms. And it's had a bit of a correction, but still up roughly 80. And one might think, well, after that, it's probably going to cool off. But even with that significant performance, Korea is still trading at 11 to 12 times earnings. And a good part of that is that, number one, the earnings delivery has been very strong because of the AI theme and so forth. But also, we're having a re-rating structurally of Korea because of better corporate governance, which I can get into further if you wish. But the point is that this rally in Korea started literally from 8 times earnings. So even if you're up a lot, you've only reflated to 11, 12 times earnings, which means there could still be plenty more to go for. So we like Korea. We like China. We just put out a view that over the next 2 years, we think China can go up 30% in price terms, maybe another 5% in dividend yield. And again, we think there's some structural reasons there. Taiwan, which are market weight on, but also looks good because you've got a very strong AI component there and some broader tech elements. So North Asia, we think, still looks good, including Japan, by the way.
Okay.
But then India, we like also. Maybe it's a bit early, and maybe it's going to take a little bit of time to catch up, but we like India as well. So those would be our top picks. To balance that out, in an Asia perspective, we're underweight Australia because it's richly valued and doesn't have as much growth. Not that we're necessarily outright bearish, but think it still will perform less well than the others. And then trying to be underweight as much of ASEAN as we can. These are the smaller markets, Indonesia, Malaysia, Thailand, Philippines, and so on, because they just don't have as much of that tech-focused driver.
Yeah. Clearly a developed country choice more. But, the start of this year, not start, maybe after the Liberation Day, after February 1, announcements from Trump, economists actually turned very negative on global growth because of uncertainty. You won't know where to invest in which product because you don't know when you will be hit by how much tariffs. That was the narrative we got. But in your report, you'll have upgraded growth forecasts for practically every region, for the world, for the US, for parts of Euro area, and of course for Asia, in a big way, even for India. Yeah. Why did it change?
So great question. So first of all, we and many other economists are upgrading our forecasts on a fairly dynamic basis, given the information which comes in. And so the point of reference that you took just after Liberation Day was the nadir, the worst part of the forecast, because at that point we were looking at very, very elevated tariffs. And of course, there was this sort of tit-for-tat escalation between the US and China, where you had such colossally high tariffs that it basically was equivalent to an embargo in trade. And of course, that would have been very, very damaging for both economies. So we marked down our growth views dynamically quite aggressively. And just to give one or two numbers, we started this year, taking China as an example, with about a 4.8% GDP growth forecast for the full year. And that got marked down to about 4.1 in early April. But then, of course, as some of that tariff increase was walked back, and in China's particular case, we saw exports doing much better than we had thought, and I think consensus, we progressively marked up our numbers, so much so that today we're actually standing at 5% GDP growth for this year. And we just did the biggest upgrade to our China forecast in probably a decade, adding 50 basis points and 70 basis points to our 2026 and 2027 numbers. Now, because of this leaning into high-tech manufacturing and China's export competitiveness, and also the leverage they've got through rare earths. So the point of all this is that we've seen kind of a walking back of some of the worst fears, number one. Number two, to your question, that sort of reduces at least some of the uncertainty and makes it a little bit better environment for investment. Number three, a lot of that investment has come in, particularly in the U.S., in hyperscalers and AI, which is really separate from the whole tariff area of concern. And then number four, just if you look at the data which has come out, just empirically, the world seems so far to be doing better than one would have thought, given the higher tariff levels. So people are just learning to live with it to a better degree. So all of that contributes to that increase in the growth forecast.
What do you think will be the catalyst that other foreign funds will wake up to the change in sentiment over India? Do you think this catalyst could be only the trade deal? Unless that happens, people are not going to come in?
So I think it's a few things like that. So if there is an announcement between the U.S. and India, as seems to be rumored, of course, the market would look at as a good thing, because if this extra, for example, 25% tariff surplus is eradicated, and maybe there's even agreement to go to something along the lines of what both Korea and Japan have arranged bilaterally with the United States, which is about a 15% base case, with maybe, in each case, Korea or Japan buying more from the U.S. and then also investing more in the U.S. If there's some sort of agreement along those lines with that sort of flavor, I'm sure the market would take that well. Now, I don't think that the full 25% additional tariff surplus has been fully priced in, because most investors thought, well, it's probably not going to last for a long time. But the market has certainly expressed and priced some sort of concern over that. So if you know for sure that's not going to be there, that's going to be a positive. So I think that in terms of near-term catalysts, that's one which we can look to. But the other ones, I think, from an India-specific perspective, really would be delivery of growth, because I think the broader picture for India is that valuations are full. I mean, 22 times earnings, hard to argue things are on sale. We did a big piece which looks at valuations from a variety of different perspectives, and the punchline is that we think that these valuations are defensible, but we're not calling for an increase here. We think there may be even a little bit modest decrease, but roughly speaking, we could hold on to the current level. Ergo, in order to really power India and to rekindle foreign investor interest, India earnings have to come through. So I think it's really earnings delivery as we go through time will be the catalyst to get interest coming back.
A final question, and this is a macro market conflict I have in my head. India's macros have improved. We were a country up until 2013 with a 6% inflation on average, and because we adopted inflation targeting and went after it, now we have constrained our fiscal deficit, and inflation is averaging about 4%. That is reflecting in lower nominal GDP and probably impacting earnings. But that's a good reason why earnings and nominal GDP are lower, because we controlled inflation. Don't you get brownie points for that? Or do investors like you only look at the earnings number?
No, it's a great question. I concur with you. I think that if you have an environment where you have better real growth or very good and solid real growth and inflation under control, that is a much healthier environment. And I think full credit to India for the fiscal consolidation which has taken place, but it's been done in a gradual manner, so you kind of thread the needle between wanting to be more prudent fiscally without doing so much that you then hurt growth and have a negative spillover effect. So I think that the policymakers have done a very commendable job in that regard. I think that the silver lining, as you said, in that slight cloud of lower nominal GDP is that a lower inflation environment certainly allows the RBI to be more accommodative. And I think it also may calm fears about currency weakness. So if you get a more stable rupee and lower interest rates, well, lower interest rates are obviously good for markets through valuation. So I think that there's that positive pass-through effect from lower rates, which may mitigate the lower.
No, you're right that the inflation differential narrowing so much between India and the US is not reflecting in the currency just yet.
Correct.
But do you think the rupee's worst is over?
So our overall view, as I mentioned earlier, is that the US dollar should weaken on a structural basis. India's had some challenges this year, and the rupee's been on the weaker side, along with the Indonesian rupiah. But we think here it's sort of probably roughly range traded stable. So we don't think it appreciates as much as some other currencies, for example, the Korean won, which I think is very undervalued here. It should rise, and the Taiwan dollar as well. But we think it can sort of hold its own. So I think from a U.S. dollar investor perspective, you're probably okay in U.S. dollar, keeping score in U.S. dollars. And then the real heavy lifting will have to be done by earnings delivery and growth.
Thank you very much, Timothy Moore, for your views and for dropping into our studio today. I do hope other funds follow Goldman Sachs' view and change their view on India and rate it overweight. Well, we have to take a break on that note, but I'm back with another guest on our Market Masters edition. Leif Eskison, the chief economist from CLSA, will join us after the break. Welcome back to Market Masters. So, the show where we are asking if India is on the cusp of a re-rating. My guest now is Leif Eskison, the chief economist at CLSA. Leif, good morning, and thank you very much indeed for joining us. Well, let me start by asking you that India's second quarter, what we call second quarter, July, August, September quarter, GDP number is due in a week. Has there been a recent upgrade from CLSA? What's the number we should be prepared for?
Yeah, so if you look at the current fiscal year we're looking at growth coming in just a hair below 7%, so 6.9% to be exact, right? So relative to the first quarter of the fiscal year, it does, you can say, imply some slowdown in growth during the remaining 3 quarters of the fiscal year. That sort of slowdown, I would say, is sort of driven essentially by 2 factors. One is because the government has to sort of rein in to some extent, you can say, spending. meet the deficit target. We think there'll be some sort of slowdown on that side, maybe sort of government-led infrastructure type investments. And then also the sort of, should we say, lagged effect of the higher tariffs that got imposed on India from the US, and also a slowdown we're seeing in global trade in should we say, in coming quarters as well, would be the two factors that will drive that. I guess if we start to see the effect of some of the GST reform, that could provide a bit of a lift to the consumption side of things, right? So that's why the slowdown we are looking at in the remaining of the fiscal year is not that significant. So as I said, full year fiscal at 6.9%.
Would you put an upward bias to that 6.9 because of the GST cuts and the probability of a trade deal with the US?
Yeah, I mean, certainly, I think the chances of a trade deal have gone up, right? I mean, Trump has certainly indicated as much, and the two sides are still negotiating on that front, right? So whether it happens in this calendar year or in the beginning of the next calendar year, so the last quarter of the fiscal, we will have to see, right? But I suspect that we could move towards a deal, right, where maybe the tariff rate that's imposed on India lands at something similar to what we're seeing for other Asian economies, to say around 20% thereabouts, right? And then, of course, there'll be some give and take also in terms of purchases and opening up for certain sectors, etc. That would be part of that broader deal, sort of in similar fashion, but not quite the same as we've seen from some of the other Asian economies, right, where they've entered deals with the US.
Okay. Well, is there any, I mean, this is not really an economist's question, it's more your equity strategist question, but do you see the global view on India changing? We've seen the largest amount of foreign investment outflows from India. But now, as you know, the GST cuts and the income tax cuts in India work in and earnings improve, and probably the trade deal comes in, do you see the movement of funds back into India? I mean, a lot of the rupee depends on that. That's why I'm asking.
Yeah, I mean, so I think, given our view on, should we say, U.S. equities being quite frothy, right, and should we say a little bubbly, if you will, right? I mean, we do also see a relatively high probability of a correction in U.S. equities, and that also would imply, should we say, more of a sort of less risk appetite, more broadly speaking, globally, right? So I think it will be hard for Indian equities to sort of buck the trend in that type of environment. But if you look, should we say, beyond that potential correction, and if there's also maybe some further correction in India in the context of that as well, right, and valuations are maybe somewhat less, should we say, challenging to the extent they are now, then maybe there could be a bit more scope if we start to see the GST reform adding to the growth impulse in India, right? And if growth holds up relatively well, that there could maybe be some resumption on the other side of this of equity investors coming in, right? But I think valuations still are quite high. I think positioning domestically is still quite long in the tooth as well, right? So I think that is still something that does pose, I guess, challenges from the point of view of foreign investors in the near term, right? So maybe a healthy correction could be a good sort of starting point, right, for seeing flows coming back in.
Okay. Well, just a final word. How many rate cuts do you see from the Reserve Bank? Is it just one in December or, more?
So we currently have two, 25 basis points in each of the two following meetings, right? So we're not buying it. We're not looking for 50 basis points in December, which I think came up after the latest inflation number, right? But I think what you need to look at is, if you look at core inflation, right, in India, still added around the target, right? So I don't think there's necessarily a case for cutting by 50. So 25 basis points in December, and then subsequently another 25 basis points.
Okay, got that. Thank you very much, Leif Eskesen, for joining us and giving us a view of both the US economy, the global economy, and where Indian rates are headed. Thank you very much for joining us in this special edition of Market Masters.
Hello and welcome to On the Record with me, Shireen Bhan. We're here to talk about a journey that's been steady, exciting and in many ways disruptive. 40 years on for Kotak Mahindra Bank. Joining us now to talk about the road ahead is Uday Kotak and Ashok Vaswani. Gentlemen, congratulations and many thanks for joining us. Mr. Kotak, I want to start with you. Starting with 30 lakh rupees, a small NBFC, 40 years on to where you find yourself at Kotak Mahindra Bank. What is the most gratifying aspect of this journey so far? But more importantly, what's the ambition from here?
I'm excited about the fact that India has transformed so dramatically in this 40 years. But when I look at the journey from here and the future for India, the financial sector and Kotak, I'm even more excited. So this is just a point in time in history. 40 years may seem a long time. For me, it seems like yesterday. And it is exhilarating in terms of the opportunity ahead.
But, speaking of the opportunity ahead, what is it that you foresee in terms of where you believe the bank will be, in terms of pecking order, in terms of your loan book, in terms of your global aspiration? Where do you foresee the bank? I'll come to the execution aspect with Ashok in just a second.
I would love to see Kotak as one of the leading global scale financial institutions from India. And that's my dream. It's not about just how large we are, but also how good we are and how we are keeping pace with the times and demonstrating that we can break the glass.
Well, break the glass ceiling, Ashok Vaswani. It falls on your lap then and your table in order for you to deliver on that promise. But, he says 40 years feels like yesterday. It's almost 2 years for you here at Kotak Mahindra Bank. Feels like yesterday?
Oh, it definitely does. It's been an incredible ride. And I'm so happy I made the decision to come back to India and take on this assignment. That was a good decision.
A good decision, but to build on what we just heard there from Mr. Kotak, world class, but also world size. So let's talk about the ambition in terms of how much you intend to grow your loan book, what you believe it could potentially look like over the next few years. Today at about 5 lakh crores, Axis Bank just above you at almost 11 lakh crores. What is the aspiration on that front?
So, Shireen, actually it is about an ambition on profitability, which is obviously linked to balance sheet, but essentially profitability. How, as a group, can we become maybe the third largest, most profitable group, financial services group in the country amongst the private sector kind of banks, and more importantly, really serve our customers and become, the kind of most valued franchise from that perspective. And that's the journey that we're on.
Well, speaking of that journey, and you just unveiled this One Kotak sort of campaign and One Kotak ambition that you've put out there as far as customers are concerned. How should investors read that from an unlock and a monetization perspective? Could we potentially look at some of your businesses being unlocked, being monetized in the near future, or is that not a consideration at this point in time?
So, Shireen, think about it. Kotak is the broadest financial conglomerate in the country. There's nothing that's like the Kotak financial conglomerate. This conglomerate allows us to take advantage of whatever changes may be happening in the financial services sector, whether it's in saver to investor, whether it's corporates going from bank balance sheets to corporate bonds, capital markets. We can serve these customers across the group. That is the power of this group. This also allows us to identify customer segments that we want to really go after, bring together products and services relevant to them, and build out propositions. And where we've done that, we've got really, really good results, whether it's with the private bank, our recently launched Solitaire program, our 811 program, the SME segment, or institutional clients for that matter. That is the power of Kotak, of being able to bring together and meet the holistic needs of the customer. That embedded value is growing. Why would we monetize it early?
No, early, but at some point you will? Or intend to?
Right now, very early. We'll see what the future holds. But frankly, I honestly don't see the value of monetizing it right away.
At this point in time, I ask you this also in the context of what you're seeing happening around you. I mean, things like the Grow listing, an 8-year-old company listing in the manner in which it does that kind of tempt you to look at what's happening in the market?
Not at all. The embedded value of Kotak is growing at a compounded rate. And there really is no reason for us to kind of list at this point in time.
So no departure from that at this. Mr. Kotak, an overarching view on this aspect, because I'm sure that this is something that you discuss and debate very often at the board level.
Shireen, I think the financial intermediation space is undergoing transformation. One is thanks to technology. Second is the move from saver to investor. Third is the flexibility across the intermediation space, which is expected by customers. And therefore, to create inherent disparities between different segments is inconsistent with the best way to serve customers. Therefore, think about yourself. You may be a saver and an investor in one. Therefore, as a financial intermediary, we cannot think about ourselves as a bank or asset management company or as a broker. We got to think about wherever the intermediation moves, the group is there to serve you. And therefore, if that is the basis, the theme about One Kotak is an extremely powerful theme where the newcomers rightly start with a vertical. But ultimately, the challenge is how do you serve your customer in totality?
You know, you talked about the fact that the banking space is seeing a big disruption and a transformation, and you believe it's going to get harder for banks to be able to get deposits. It's going to be harder for banks to grow in the manner in which we've traditionally seen them grow. So that creates a challenging environment for you. But, you know, on the back of that, what do you believe is the big challenge for banks in general, but also for Kotak Mahindra Bank in specific?
I think that's where the challenge is essentially twofold. One, how do you keep up pace with technology? Because larger deposits are going to market instruments or market platforms like mutual funds. And therefore, the ticket sizes of deposits which remain with banks will reduce. However, there is a large population which needs to have basic payment and banking facilities. The cost to serve in the physical world is much higher. Therefore, how do you create a business model which is commercially viable at the keeping in mind the reality that large ticket lazy money which remain with banks in current and savings accounts will not remain or will not remain to the same extent. Second, how do you capture these flows which are still within the financial system within a group? So combine this, I think, an integrated financial conglomerate with a focus on excellence in the verticals is the key to the future.
Well, speaking of that being the key to the future, and I'm using his words that banking has been lazy, how do you unlazy banking?
I think he talked about lazy deposits
yes.
and inertia. And that's true, right? With technology, inertia is going to go. And that's exactly the point, right? You need, first of all, the ability to serve a customer in different places. So in this case, it would be, let's say, the bank, as well as, let's say, Kotak Securities or Kotak Asset Management. But even within the bank, Shireen, it's about what are the customer segments that you're targeting and how do you provide products for that? So go back to what Uday said about a vast majority of people who are looking to get basic banking facilities, our ability to acquire them digitally, service them digitally. With our 811 proposition, that's exactly what we're doing, right? And that builds granularity of deposits. That gives us the confidence that we will be able to grow our deposit base to meet our growth needs on the asset side.
But you said that profitability is going to be the focus area for you. So given what we've seen as far as the last quarter is concerned, do you believe that we're perhaps, as far as profitability is concerned, do you feel like you've peaked, or is there something that you can operate by way of levers to do better in terms of profitability? And is the era of 5% kind of NIMs behind us as well?
No, so Shireen, I think we should, looking at one quarter may not be the best way to look at it. Longer term trend, right? I think from here on, NIMs will stabilize and even potentially improve unless there's another rate cut, which is a completely different conversation. I think in our case, you're going to see, like we said at the quarterly results, credit costs kind of moderate. And we are spending a lot of time and effort automating and digitizing Kotak, which is allowing us to get really efficient on costs, right? So I'm optimistic that we can kind of grow our profitability. Last year, capital markets was a very, very good time. We're having a great year. This year, not such a great year. But that again is the beauty of Kotak, right? We fly on 4 engines. Sometimes 3 engines are flying, sometimes 2. The day 4 fly, it's really, really soaring.
When do you believe or anticipate all 4 could fly together?
It's a function of the macroeconomic environment as well. But I really believe we're very well poised to have all of them kind of kick in together and move fast ahead.
The macros, Mr. Kotak, and you said we'll get into the rate cut debate later. So let's get into the rate cut debate. Record low inflation. What's the expectation? Rate cut as early as December or sometime early next year?
Shireen, look at the rate cut syndrome in 2 parts. One is the short term, okay, which has an impact on short term money markets and interest rates in the short term economy. But long-term rates are more sticky. Therefore, you've seen 100 basis points drop in rates at the short end, but at the long end, the drop is barely 20-25 basis points. So the marketplace actually is saying something. The yield curve, which was flat, is now getting to be positive. And therefore, markets believe that these rate cuts are not going to lead to sustained low rates for the long term. Otherwise, they would reflect in the 10-year bond.
But do you anticipate a rate cut in December or early next year?
I believe between December and February, there's a fair chance of 1 rate cut.
25 basis?
Yes, that's what I feel.
Ms. Vaswani?
Look, honestly, it's up to the RBI and how data plays up. The data definitely is skewing more towards another rate cut. But let's see how it kind of plays out.
Speaking of factors that are impacting sentiment as well as impacting flows, I want to address what we're seeing happen in the banking sector. It certainly seems to be the flavor of the season as far as FDI is concerned. Large deals happening from IDFC Bank to RBL to Yes Bank to Federal Bank as well. Mr. Kotak, what do you make of this? I know you tweeted saying that it's a welcome sign, but you hope that it will create a level playing field. What do you make of this?
I think, Shireen, first you have to distinguish between private equity and strategic. So out of the deals you mentioned, there are 2 strategic deals.
Yes.
One is SMBC into Yes Bank, and the second is Emirates NBD into RBL. That is very different from
BlackRock
and Warburg into IDFC and Federal Bank. Those are financial investors at the core. Maybe they are playing for some strategic to buy those banks in the future. So who knows? They're in the business of producing financial returns. The strategics are taking a long-term commitment into India. And frankly, I would welcome it as long as we have consistent rules for similar financial institutions across the board.
Because at this point in time, it's case by case. But the fact that we're now looking at the regulator giving the go-ahead to control deals, what does that signal as far as the willingness of the authorities on this front?
I'm glad that India is feeling more secure and bold. We saw competition come into investment banks where majority was allowed in early 2000s. You saw it in securities, asset management, life insurance. So banking was the last bastion, and I'm glad that the policymakers are confident that Indian financial sector can withstand the onslaught of global FDI and still maintain the ability to remain truly Indian and become world class.
A strategic investor in Kotak Mahindra Bank, you don't need it, but is that even up for consideration?
Last time I saw the cap table, that strategic investor was Uday Kotak.
So not on the table.
Certainly not.
But how do you see it from an operations point of view? 2 strategic deals being done, private equity interest. What is it? Does it change anything in the marketplace?
It's actually quite fascinating, Shireen. On the one hand, yes, we talk about, obviously, there's kind of covered the deals that have happened. On the flip side, we've had foreigners also leave. I mean, Citi sold its consumer franchise. Deutsche has put up its business for sale. We bought the Standard Chartered personal loan portfolio. And so it's just an interesting kind of phenomena. Let's see how it kind of plays out. Honestly, competition is welcome. It keeps us on our toes. And we just got to get smarter, better, and move faster ahead. And that's our goal.
Smarter, better, bigger. And I'll ask you this in the context of IDBI Bank, which, it's been 10 years now since ING Vysya. The question is whether you still have the appetite to do IDBI Bank. I know you continue to be in the frame, Mr. Vaswani. So let me direct that question to you first before I get a broad picture there from Mr. Kotak. IDBI Bank, how serious is Kotak's ambition there?
So, we've had this conversation before. Yeah. Look, we look at every single opportunity there is. Obviously, our goal is to transform for scale. So we look at it. If it makes strategic sense, then we go to the valuation and see whether financially it kind of makes sense. And if it makes sense, yes. Also, you got to say that we are on a certain path, right? We're on a certain path, transformation, or they talked about the changes in financial services, how technology is changing a whole bunch of stuff. And therefore, what is our priorities? What is our management mandate? Where are we going to really spend our time? Is it going to be spending time in integrating HR and payroll systems, or is it going to be really transforming the business? So those we kind of take into balance and see whether a thing makes sense. Obviously, we can't comment on a particular kind of
Okay,
asset.
Allow me to read between the lines of what you just said, that given the fact that, as Mr. Kotak pointed out, we're in an environment where banking itself is being disrupted on account of technology, would it make strategic sense to go in for an IDBI bank, which is largely a legacy bank, and at the same time, forget the valuations, does it even make strategic sense for you, given your aspiration of wanting to be digital first today?
Your words, not mine.
So would that be a fair assumption?
I kind of laid out the case, right, Shireen? We look at every single thing. We see how, and we take a very, very balanced and a thoughtful view.
You haven't shied away from inorganic deals in the past, Mr. Kotak. As you look at 40 years, or forget 40 years, 10 years on, and I know you can't talk specifically about IDBI Bank, but what is the inorganic aspiration? How crucial do you believe that is going to be for the future?
You have to look at your model in terms of what makes sense. And I'll give you our out of the box. Not many people recognize that in 2014, we took a 15% stake in MCX. At a valuation of 450 crores for 15%. MCX market cap today is 50,000 crores. And we've just been patient investors. We strategically took a call that financial infrastructure space makes sense. We also took a bet on KFinTech, which is in the registrar space for mutual funds and others. And we took a 10% stake there, or 9.99. So then we took stake in NSDL. We have taken stake in Clearing Corporation of India, because we are great believers in long-term financial infrastructure space. For we are always ready to think differently. And when I look at the future, I look at the future very different from what we have seen today.
So a bank may not necessarily be part of the future.
I'm not saying that. I'm saying that we will build the future on the basis of what makes sense. And since you're talking about the bank, you have the two greatest examples in front of us. One, the largest market cap company in Brazil is a bank with no branches, new bank, $80 billion market cap. Largest market cap company in Brazil, not in finance. Revolut is now larger market cap than Barclays Bank. It's in front of our eyes. And I'm not saying we are going there, but for us to ignore all these trends would be an issue which we have to keep in mind, especially when the money is moving from saver to investor. Therefore, larger pools will move as money in motion, Therefore, we got to capture it as flows rather than necessarily as being storage. And in that context, what are we going to do to build a future which is going to distinguish us from the rest of the crowd with 25 banks?
You know, the trends that Mr. Kotak spoke about there, and obviously, as he pointed out, we're not talking about no branches in the foreseeable future, at least here in India. But what does that mean in terms of your branch expansion plans and eventually what it means as far as your operating costs are concerned? Because that, as you pointed out, is a key priority for you.
Sure. So, Shirin, just one more point. When we talk about inorganic, I'm just going back to our previous conversation. Look, we're not only looking at the bank, we're looking at other parts of our business as well. We're super excited about asset management. We like our life insurance business. We like our broking business. So opportunities, you know, they could well come up there. And, you know, we would look at them like we would look at any other opportunity in the bank. Coming to your question around...
You mean from a strategic investor perspective?
Or acquisition, you know. Coming to your branch question, again, this is something that we've kind of talked about pretty consistently. We really believe that if we can blanket out the top 70 to 75 cities of India, that's adequate branch coverage. That would take us to roughly 3,500 branches, give or take, but in that ballpark. And that's the kind of rhythm we are on. And if we can get there in the next 3-4 years, I think we'll be in very good shape. Of course, we'll have sales offices, of course, we'll have digital, but we think that's an appropriate network for a bank branch, and I think that'll hold us well.
And keep what Ashok said is very important, because some of the larger banks are now in 10,000 plus branches or around, or getting close.
Or getting close, and you're saying that you don't have any plans to go down that road. But Mr. Kotak, coming back to what you said about the landscape changing and the environment changing as far as banking is concerned, I want to link this to the transformation from a nation of savers to a nation of investors, and what you believe that opens up by way of opportunities for the sector generally, but also more importantly for the bank and for your subsidiaries specifically.
Think about I think you have to really focus on verticals. Just think about brokerage industry. The dominance which Zerodha and Grow have shown. They were nowhere. How are financial institutions preparing themselves for being disrupted? The challenge for Indian banking is most banks have assumed that they're in a comfortable moat with regulatory protection. In my view, the underlying business model is undergoing a structural and transformational change by the customer. The customer is changing the rules of the game. The customer will decide what to buy, what to do, where to put the money. And we as financial intermediaries, rather than calling ourselves bank and getting into a comfort zone, we as financial intermediaries have to go with the flows.
You know, you said that Zerodha, Grow were nowhere, and look at where they are today, not just in terms of size, but also in terms of profitability. Is that a disappointment, not just for you specifically, but also for large incumbents?
I think the challenge for incumbents is complacency of success. And it needs to be shaken. It's true for a company. It is probably true for countries. The biggest danger for countries is to believe that we have arrived. There's somebody out there who's eating our lunch. And a sense of paranoia is the core to building sustainable business.
What are you most paranoid about today, and how do you play catch up in an environment where your lunch quite literally is being eaten by somebody else?
No, Shirin, I'm completely in this camp of only the paranoid can survive. And I think Uday and I share that quite a bit. Now, having said that, I think there are waves that kind of come along. And if you catch a right wave, you can ride to the top. And I really believe technology is something that could provide a great wave, which allows us to kind of jump forward. And if we get that right, that could be a very big deal. I'm very proud of the fact of what the team did during the technology embargo. We just didn't, solve the problem. We really went and said, we're going to get this right. And continued investment there and continued focus there to help us drive that as a competitive advantage. Not easy to do, obviously, but it's something that we're very focused on. And I think that is something that could be a wave that we could catch.
So, you said that you're proud of what the team managed to do during the tech embargo, which was, of course, put in place by the RBI and the restrictions that you had to deal with. But as you see the future today, and whether it's AI or it's agents and so on and so forth, where do you believe you are? Are you on the first chapter of this AI book, or do you believe that you've been able to move further?
It's such uncharted territory.
That you don't know which chapter.
It's impossible to say chapter 1 or chapter 10. But are we spending a lot of time thinking about it and actually putting stuff into place and starting to see what's possible? Yes, definitely so.
Mr. Kotak, how do you believe that this is going to play itself out for the bank, but also for the sector over the next few years?
I think AI reminds me of two historical realities. One was railroads in the US, and the second is electricity companies. If you think about electricity companies, electricity invention changed the world. And it's a reality today. We take it for granted, but when it happened, it was a game-changing event for the world. But almost none of the original electricity companies survive today. Therefore, AI is game-changing. But how to play AI is still early days. The question for our country and each institution is, are we going to be the original creators of AI the way the US and China seem to be doing? I think we have missed that original bus. It's gone to these two countries. We are more likely to be users. But who knows, ultimately, smart usage with adoption may turn out to be a better model than having to spend trillions of dollars in building the base. So you do not know the future, but in any case, the first round of the battle has gone to US and China.
But I want to link that to the point that you made about being early investors in the India financial infrastructure story, because you believe that that was in fact going to be beneficial for you as a financial institution. As you look at this AI wave and what it could potentially do, could that be the next leg of investments that you choose to make?
I think the bank will have to do what makes sense for it within the technology and financial infrastructure and financial services area. Therefore, I'm sure the bank will look at within the financial services space if things make sense. However, broader AI investment is not necessarily like angel or venture, is not necessarily that bank has done a lot of till date.
You want to stick to your knitting, right?
Yeah.
What we understand is financial services. That's why the investments that they made in MCX, KFIN, all those ones you talked about have paid off so rich. We understand that. We know that India is on a growth path. These will grow. Now, AI, yes, if there are applications of AI which we see which are going to be game-changing, we would be very interested. But are we going to invest in, semiconductor companies, or are we going to invest in production of GPUs? I doubt very much we'll do that.
The only place we may play with that is through our alternate asset funds. And that is a separate business. It's a fund management business. The bank puts in some sponsor capital in that, but it's run as a separate business. And there the opportunity space is much wider.
Speaking of the opportunities, and I want to understand what signals you're getting from the market at this point in time. You, of course, have flagged the pain in the CV space as well as the MFI space. Does that continue to be a significant cause for concern, or do you believe that perhaps the worst is past?
So, Shane, clearly in MFI, the worst is past, at least for us. We had always said Q1 would be the peak. Q1 turned out to the peak. Our Q2 results demonstrated that, and it's fast coming back to kind of normal. For about 2 quarters, we've said that the CV space is going through a bit of stress, particularly in the retail CV space. That kind of continues. I think that whole industry has gone through quite a significant transformation, and we'll see how that plays out. But that's very consistent with the commentary with our Q2 results.
But, we've seen the GST cuts coming in. The hope and the expectation is that this will now be a sustained pull on consumption. What are you seeing on that front at this point in time, and how confident do you feel about that?
Yeah. So, Shirin, when they made the announcements right to the time that the cuts happened,
there was a pullback.
There was significant pullback. And therefore, in the last week of September, we saw a major surge. Now, some of it was because of the cuts, some of it was pent-up demand kind of flow through. We've seen October hold quite nicely. And frankly, across consumer expenditure, across OEMs, across into the rural economy as well. I suspect that, because of the pent-up demand, there'll be some leveling off. But generally speaking, should this lead to further consumption? I would say yes.
The demand environment here, domestic as well as what we're seeing happen as far as the global environment is concerned, and that uncertainty continues. How do you see both the global and the local mix playing out for the larger economy, but also for the markets, Mr. Kotak?
My sense on the macro is rural is doing quite well. In urban, the higher end urban is doing well. The lower end urban may be under some pressure. On the global side, of course, there is a Mr. Tariff world. So we have to see how that plays out. I would like to believe that India, which seems to be in a penalty box with the United States, with a net exports historically, which has been net $50 billion plus, how much of that gets impacted and how much of the impact on GDP, and when does the embargo on India with reference to tariffs linked to Russia go away. But if I look at the US tariffs at some point of time, sooner rather than later, I hope, come back to between 15 and 20% range, India can withstand that quite easily. 50 is tough, but between 15 and 20, if we settle, I think we have a pretty comfortable zone. And there is also a very big positive, Shireen, on the structure of our current account. Thanks to sustained low oil and oil's mix in the total GDP dropping, India is in a much better structural current account position and a current account deficit which is much more easily financeable. So that's a big plus for the Indian economy on a structural and sustained basis.
But what was all of this going to mean, Mr. Kotak, as far as the currency is concerned? And we've seen, a significant move on the rupee. Now, assuming that the deal goes through and we do have an agreement and we see a reduction in tariffs, which way do you see the rupee headed? And if we don't see that scenario playing out, what do you believe the currency is likely to see?
Current account, I don't think is going to be the main pressure on the rupee. The rupee is determined much more by FDI and FPI flows. And that is where, if you look at March 25, net FDI into India was almost zero. And there has been a boost to FDI now. And I'm glad that even banking is now seeing positive FDI. Keep in mind, private equity is classified in the FDI bucket. So some of these efforts by the government to encourage FDI or allowing 100% in insurance are efforts to ensure that India's net FDI remains positive. But against that, private equity for old investments, and including some strategics, have divested at high values. The Koreans realize the value of their Indian asset is more than probably their own asset in their own country. So that's great value creation by India for them. And as strategics also, they are monetizing partly. So is private equity. And till date, for whatever reason, FPI flows have been negative. Therefore, the valuation of the currency is less driven by trade, more driven by investment flows.
You talked about investment flows, and we've seen FPIs make a little bit of a comeback into the markets. What do you believe is holding them back? Is it a valuation issue primarily, or is it also to do with structural issues like capital gains? And, again, we're sort of seeing this clamor build up that's the next reform that the government should act on.
Shireen, I'm sure a lot of portfolio investors are asking the question. There are easy parts in the world to make returns today. The most obvious one is United States. And we discussed this. US market cap is close to 70% of global market cap. and the kind of returns US markets have given over 5 years and sustained, and with earnings coming to the large companies, are pretty enormous. Therefore, there is a fundamental view of the shrinking size of emerging markets in global market cap. And that, along with valuations, which are reasonably rich, make global investors ask the question, is the best place to put money in India or Korea?
So do you think capital gains move will actually help? Do you believe it's needed?
In my view, the issue really is back to what's a fair play. Okay, you have a situation where on interest earnings, Indian taxpayers are paying 39%. And on capital gains, Indian taxpayers are paying 12.5%, or with surcharge and everything, 15%. And then you have global investors who have been brought at parity at 12.5%. So how do you draw a sense of equilibrium across the different classes of taxpayers? What is fair play? And even today, one of the main reasons why you're seeing so much Indian investor flow into equities is clearly tax arbitrage between capital gains and interest income.
Well, you know, speaking of this tax arbitrage, as well as the flows that we've seen from the domestic market, domestic savers into the equity markets, Mr. Vaswani, I mean, you know, what does that tell you about the opportunities that it opens up for the bank going forward? I mean, you know, who would have thought that we would have seen so many of these new age companies list back-to-back listings, and while one can quibble and argue about valuations, still being able to do well? What do you make of that, and what does it signal now as far as priorities for the bank are concerned?
No, Shireen, this goes back to where we started, right?
Business Hour, I'm Shireen Bhan. The headlines we're tracking for you this evening. Artificial intelligence-related stocks get a jolt as investors worldwide sell. Stocks stumble across Asia and Europe after a $3 trillion wipeout on Wall Street overnight. The Sensex declines over 400 points. The Nifty manages to hold about 26,000. All major indices end in the red. The rupee sinks to a new low. $1 now costs nearly 90 rupees. Weakening risk appetite and uncertainty over the India-US trade deal weigh on sentiment. The government ushers in a new labour law regime across India as the 4 new labour codes take effect. 29 existing laws repealed or rationalised. Gig workers get legal recognition and social security. Women are allowed to work night shifts across all sectors. U.S. sanctions on Russian oil take effect today. Reliance Industries stops importing Russian oil. The U.S. imposes sanctions on 2 Indian entities and individuals alleging the involvement in crude oil trade with Iran. The Mahindra Group is looking to grow in multiples and not percentages, says the Group CEO Anish Shah. The heads of 14 group companies come together on television for the first time. On their annual Investor Day, Anish Shah says the market value of the growth gems has not been captured, promises big value unlocking in the days ahead. That's an exclusive. A Tejas fighter jet crashes during an aerial display at the Dubai Air Show. The Indian Air Force confirms the pilot has been killed, orders a court of inquiry. The incident marks the second crash involving a Tejas aircraft in less than 2 years. The Airports Authority of India kicks off its largest modernization drive, plans to revamp 65 airports with modern equipment and air traffic control towers at an estimated cost of 17,000 crore rupees. That's an exclusive. Ukraine's President Zelensky says he's ready to work with the US on their plan to end the war with Russia. The plan requires Ukraine to make some painful concessions, including giving up some territory and downsizing its military by 40%. The Chief Justice of India, B.R. Gavai, bids farewell after a 6-month tenure draws to a close. He was India's second Chief Justice from the Dalit community. Justice Surya Kant will take charge of the Apex Court from Monday. Donald Trump Jr. tours Vantara, the wildlife rehabilitation initiative led by Anant Ambani. Trump Jr. also visits temples in Jamnagar along with Anant Ambani and Radhika Merchant. Well, let's start with the global market action where fears over AI valuation sparked a sell-off worldwide. Asian markets slumped in trade this morning, dragged lower by tech-led sell-off, worries over AI valuations growing. The Nikkei down 2.5%, the Kospi down almost 3%. 4%, and the Hang Seng lower by 2.5% as well. So Asian markets feeling the pain, and that was reflected on the back of the steep drop that we saw on Wall Street overnight. The Nasdaq, the S&P 500 all declined about 2% each, wiping out nearly $2 trillion in investor wealth. Tech names including Nvida, Oracle and AMD have suffered the steepest decline. The global sentiment weighing on our markets as well. Both the Sensex and the Nifty finally closed about 0.5% lower. The Midcap index was down by about 1% or so. However, the markets are up over 1% for the week, with the Sensex and the Nifty gaining for a second straight week. So positive close this week, not today though. But let's talk about the rupee, because it's hit a new low of 89.49 to the dollar after a flurry of late trade. Dealers are largely blaming the absence of the RBI as the reason for the rupee's fall. In fact, some dealers say the RBI reappeared and sold dollars in late trade. Lata joins us now to take us through what really has happened as far as the money market action is concerned. Lata, what went on with the rupee today?
Well, that's the guess in the market. Around 240, in a matter of a minute, the rupee depreciated from about 88.70 levels to 89.49 level. The explanation for the market is that the Reserve Bank was always expected to come in and support that 88.79.80 mark. They have been doing that for the last several weeks. Usually what happens is when you notice the Reserve Bank protecting a level, people start writing options at that point. You sell the dollar at that level. In fact, there is a widespread belief that the rupee has already depreciated a lot. It's depreciated more than the fair value. You normally measure it by the REER and NEER terms, which is real effective exchange rate and nominal effective exchange rate, comparing rupee's inflation to the inflation of its trading partners. By that standard, the rupee is, devaluated much more, about 2-3% undervalued. The expectation in global markets is that people are selling the dollar versus the rupee, because when the trade deal comes, the rupee is expected to go to about 87.50 or 88 levels. Therefore, the market was not prepared for the crossing of 89. Once that happened, all those who were sitting short had to immediately come and cover because their stop losses were triggered. That created a natural momentum of dollar buying, and that took the rupee very quickly to the 89.50 mark, at which level people believe the Reserve Bank has come. Now, one logic in the market is probably the Reserve Bank was testing. Since everyone is saying fundamentally the rupee is undervalued, why not wait to see what is the natural level? Let's not intervene. But usually the central bank doesn't stay for 70 pice or 1% of the fall. So there is a lot of anger against the Reserve Bank for not coming in earlier, for not allowing a gentle depreciation of the rupee. At the moment, 89.50 is seen as the new Lakshman Rekha, the new level which the Reserve Bank might defend. But its sacredness is all of half an hour. We have to really wait and see how things pan out. At the moment, the rupee is clearly undervalued, but it can still fall. Who is to say if the Reserve Bank doesn't come and support?
Well, will it fall? Can it fall? Is 89.50 the new Lakshman Rekha? Will the RBI step in and intervene at that level? Lata, well, those are the questions that we will help answer. Thanks very much for joining us. But back to the market. Sentiment around AI appears to have turned in the last few days, especially after big tech promised to pour nearly $400 billion this year. Rachna is here with what's sparking this AI sell-off in the US markets. Rachna.
Well, a big part of the nervousness surrounding AI is the sheer scale of spending. Microsoft spent $34.9 billion last quarter, with nearly half going into GPUs and CPUs. Alphabet is planning over $90 billion in capex next year. Meta expects up to $72 billion. When combined with Amazon, the total AI infrastructure spend across big tech now tops $380 billion. This makes the AI race intense, but also very risky. The costs will escalate and squeeze the profits if revenue growth does not keep pace. With valuations already high, even minor negative developments can trigger big corrections. There's also concern about how concentrated the rally has become. The Magnificent Seven now make up 37% of the S&P 500, which leaves the market more exposed if the sentiment turns. And another pressure point is the circular economy emerging around AI. Big tech companies are striking deals that feed back into their own ecosystems. Microsoft's partnership with OpenAI, but then it also joined hands with Amazon-backed Anthropic, and Google's deals with Anthropic along with OpenAI. These all involve cloud credits, compute commitments, and long-term usage guarantees. There's also Nvida, which has multi-year GPU supply agreements with Microsoft, Amazon, Google, OpenAI. These arrangements lock in spending, but raise questions if the growth is purely demand-driven. So while investors are not walking away from AI exactly right now, but the mood appears to be shifting, and the long-term potential remains strong, but heavy spending and circular deals seem to be impacting investor sentiment. Back to you.
Well, at least that is the picture as of today. But thanks very much, Rachna, for joining us. And here's NVIDIA CEO Jensen Huang. He dismisses the talk of a bubble in AI. Speaking at an investor call after their Q3 earnings, Huang said he's seeing something, and I quote, very different.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Well, that's Jensen Huang. And on to the crypto markets, where the Bitcoin continues its month-long fall. The cryptocurrency has fallen to its lowest levels in the last 7 months, dropping below the $86,000 mark. The entire crypto market has shed almost $1.2 trillion in value since October. Investors are reducing exposure to riskier assets amidst fading expectations of another cut by the Federal Reserve next month. Now, U.S. sanctions on Russian crude oil take effect today. In a statement, Reliance Industries has said that it has stopped imports of Russian crude oil. Reliance says, and I quote, "From the 1st of December, all oil product exports from the SEZ refinery will be obtained from non-Russian crude oil. This transition has been completed ahead of schedule to ensure full compliance with product import restrictions," end of quote. Reliance has also said that all pre-committed liftings of Russian crude are being honoured since shipping and logistic plans have already been finalised. However, any consignment after the 20th of November will be diverted to the company's domestic tariff area refinery, which is outside the scope of the new SEZ restrictions. The US has also imposed sanctions on 2 Indian entities and individuals alleging involvement in crude oil trade with Iran. Now, the US Treasury Department list includes Maharashtra-based RN Ship Management Private Limited and Pune-based TR6 Petro India. 17 entities and individuals from around the world have also been sanctioned. According to the Department of State, these entities were helping Iran generate funds allegedly for their nuclear program. Back home, the government has ushered in a new labour law regime across India. Now, remember, the legislation was passed. Finally, these 4 new codes have come into effect today. The move consolidates and replaces 29 central labour laws. Timsy is standing by to decode the key contours of the new labour codes that now come into play. Timsy.
India's labour landscape has undergone its biggest overhaul in decades. The long-pending 4 labour codes passed by the Parliament back in 2020 have finally come into force from today. Together, they replace or rationalize 29 existing labour laws, marking the start of a new labour law regime across the country. So what are these and what do they mean? Well, the 4 codes, the Code on Wages, the Industrial Relations Code, the Code on Social Security, and the Occupational Safety, Health and Working Conditions Code. For example, for employees, the government says the reforms bring several key benefits. First, appointment letters will now have to be mandatory, ensuring formal documentation of work terms. Second, universal social security coverage has been expanded to include even gig and platform workers. These codes also guarantee the right to minimum wage and timely payment for all workers across sectors. Employees above the age of 40 will also be eligible for annual health checkups. Women will now be allowed to work night shifts across all sectors subject to safety conditions. And significantly, the Employee State Insurance Scheme will now have pan-India coverage, extending benefits even in areas where ESIC infrastructure is still being built. For gig workers, the new regime brings legal recognition for the first time. Aggregators such as ride-hailing, food delivery and e-commerce platforms will now be required to contribute 1 to 2% of their turnover to dedicated welfare funds aimed at improving social protection. For employers, the government says the codes will ease compliance. A single registration, a single license, a single return will replace multiple overlapping requirements across states and departments, a move that is expected to significantly cut administrative burden for companies. Well, to watch out for now is how smoothly industries transition to these codes in the coming months.
All right, Timsy, many thanks for joining us. The new labour codes now in effect. On to CNBC-TV18 exclusive. Mahindra Group CEO Anish Shah says the group is looking to grow in multiples and not percentages. This as the heads of 14 group companies came together on television for the first time on CNBC-TV18 on their annual Investor Day. Speaking to us, Shah said the market value of their growth gems has not been captured yet and promises a big value unlock in the days ahead.
Auto continues to be a mainstay for us and our most exciting business, as we always see in all our forums. But other businesses have grown rapidly. And farm continues to be a huge deliverer of both profit as well as cash. I will highlight our growth gems. We've been talking about that for some time. When we started the journey on growth gems, collectively they were worth 8,000 crores in March 2020. Today, they're worth 56,000 crores, which is a 7x growth in a little more than 5 years. Mahindra's share in them, because some of them are listed, is 48,000 crores. And the value of our growth gems to Mahindra today is higher than the value of Tech Mahindra or Mahindra Finance to growth gem.
Well, that's Anish Shah, and you can catch the conversation with the entire top brass of the Mahindra Group at 9:30 p.m. right here on CNBC-TV18. A Tejas fighter jet at the Dubai Air Show crashed this afternoon. The plane manufactured by Hindustan Aeronautics went down while performing an aerial display before a large crowd. The Indian Air Force has confirmed that the pilot has been killed. It has ordered a court of inquiry. The Tejas, a single-seat light combat aircraft, is India's first indigenously developed fighter jet. Today's incident marks a second such crash involving a Tejas aircraft in less than 2 years. A Tejas jet went down in Rajasthan's Jaisalmer in March last year. The pilot, however, had ejected safely. Let's quickly take a look at HAL's Tejas order book. IAF had placed an order for 84 upgraded Tejas jets in 2021. Their deliveries were scheduled to commence from 2024. However, we are yet to see jets being delivered. In September this year, the Indian Air Force placed a new order for 97 additional upgraded jets. This takes the total order book to 181. Hindustan Aeronautics has said the delivery schedule has been impacted on account of the delay in deliveries of engines from GE Aerospace. GE Aerospace has also responded and said that they will work with Hindustan Aeronautics to understand what caused today's terrible crash. Online trading platform grows profit, jumping 12% in its first set of earnings after its stellar listing last week. This as a 9% fall in employee expenses offset higher marketing spends. However, revenue fell 9%. Active clients declined year on year, even as the company's market share expanded. In his first letter to shareholders, co-founder and CEO Lalit Keshre said the company has not even covered 1% of the journey yet. He said, and I quote, "As we publish our quarterly reports, you will see us repeat the same themes. We believe in compounding. Products compound, wealth compounds, trust compounds," end of quote. The board of Kotak Mahindra Bank has approved a first stock split in 15 years. The board cleared a 5-for-1 stock split after completing 40 years of operations earlier this month. The board cleared the subdivision of 1 equity share of face value 5 rupees each into 5 equity shares of face value 1 rupee each. The bank last carried out a stock split in 2010 and also issued bonus shares in a 1:1 ratio in 2015. SEBI is reviewing India's short-selling norms and stock lending and borrowing framework. According to sources, the stock lending and borrowing mechanism has been subdued activity since it was introduced in 2007. SEBI is also closely monitoring the F&O data. That's not all. Sources say the market regulator is also reassessing its proposal to unbundle analyst fee from broking charges. The regulator is expected to take up amendments to the stockbroker regulations at its upcoming board meeting in December. SEBI Chief Tuin Kantapande says the market regulator is actively examining including real estate and infrastructure investment trusts, InvITs, in market indices in a calibrated way. Speaking at an event in New Delhi, he said that enhancing market access and liquidity for REITs and InvITs is now a priority for the regulator.
SEBI will work with all stakeholders to facilitate the inclusion of REITs in indices through an appropriate glide path. Based on industry feedback, we are evaluating further ease of doing business measures for REITs and InvITs. We are examining a proposal to expand the pool of liquid mutual fund schemes in which REITs and InvITs can invest while safeguarding investor interests.
Well, that's the SEBI chief. The probe into the death of Ola Electric employee Arvind Kannan has been transferred to the Central Crime Branch. This after his family petitioned senior police officials for an independent time-bound inquiry. The 38-year-old engineer died by suicide on the 20th of September in Bengaluru. The police recovered a 28-page note alleging workplace harassment, unpaid dues and heavy pressure. Company officials, including CEO Bhavish Agarwal, were named in that note. Indigo will invest over 7,000 crore rupees in its wholly owned subsidiary Indigo IFSC this fiscal. The arm will use the funds to acquire aviation assets, allowing the airline to own more of its aircraft. The investment will be a mix of equity and preferential shares infused in multiple tranches. On to a CNBC-TV18 exclusive. The Airports Authority of India has kicked off its largest modernization drive. AI plans to revamp 65 airports with modern equipment and air traffic control towers at an estimated cost of 17,000 crore rupees over the next 5 years. About 60% of the funds go into civil works and 40% into new automation and navigation technology, as well as enhancing cyber security. Air India sold a Boeing 737 last week that had been grounded and largely forgotten for 13 years since 2012. The airline said it didn't even know that the plane officially belonged to them until the airport staff in Kolkata pointed it out and asked Air India to remove the plane. In an internal post, CEO Campbell Wilson said the aircraft had been decommissioned years ago to operate for India Post and was omitted from many official documents during privatization through a chain of paperwork oddities. Donald Trump Jr. spent a day in Gujarat's Jamnagar during his private trip to India. He toured Vantara, the wildlife rescue rehabilitation center led by Anant Ambani. Trump Jr. visited local temples with Ambani and Radhika Merchant, and also seen participating in a Dandiya session at a temple within the Bandara complex. A day earlier, he visited the Taj Mahal in Agra. Well, up next on India Business Hour, Chief Justice of India B.R. Gavai bids farewell after a 6-month tenure, draws to a close. More details when we return. Catch all of CNBC TV18's news and updates on YouTube, Facebook, Instagram, X and Jio Hotstar. Subscribe to CNBC TV18 Access for exclusive stories. Palestinian officials have said that Israeli airstrikes continue across Gaza, with the army violating the yellow line. This comes as Prime Minister Netanyahu said he believes the worst of the war in Gaza is over, but added that Israel may still have to act in the enclave. Israeli forces also killed 2 Palestinian teenagers in occupied East Jerusalem. Ukraine's biggest European allies welcomed the US's plan to end the war in Ukraine, but disagreed with certain aspects of the proposal. The Trump administration's peace plan for Ukraine requires Kyiv to cede the eastern Donbas region, accept Russia's control over other areas. German Chancellor Friedrich Merz, France's Emmanuel Macron, and the UK's Keir Starmer agreed that the current line of contact should be the starting point for any peace talks. Justice B.R. Gavai retired today after a 41-year career and a 6-month tenure as the 52nd Chief Justice of India. He assumed office in May this year. Justice Suryakant will succeed him, taking charge of the role from November 24th. Ashmit recaps the key moments of Justice Gavai's tenure. Ashmit.
Justice B.R. Gavai today hangs up his boots as India's 52nd Chief Justice of India. But while his tenure was brief, the impact of the decisions that he took will be anything but. Justice B.R. Gavai was the country's only second Dalit Chief Justice of India. His term at the helm was just a little over 6 months. He's scheduled to superannuate on November 23rd, and since that's a Sunday, today is the last working day for the chief. So let's look back at the last 6 months of his tenure. His latest judicial decision was the opinion that courts do not have the power to give a deadline to the president and governors to decide on bills passed by state assemblies. This went against the Supreme Court's own April judgment, which imposed a 3-month deadline. It was widely criticized for potentially paralyzing lawmaking in states and encouraging obstructionism. In another key decision, Justice Gavai reversed a judgment that barred the practice of retrospectively getting environmental clearances for projects that are already constructed. Now, some fear that this reversal will allow companies to begin projects, start cutting down trees without an environmental clearance, and get one retrospectively by paying a penalty. Another reversal was on the legacy dispute involving AGR dues of telecom companies. Since 2019, the Supreme Court had passed multiple orders confirming the original AGR demand. But in the latest petition filed by Vodafone Idea, Justice Gavai-led bench allowed the government to recompute the demand and grant relief to Vodafone Idea, citing special circumstances. In another landmark decision, Justice Gavai-led bench struck down the tribunal's Reforms Act of 2021. He reprimanded the government for reintroducing provisions which had previously been set aside. He slammed the centre for trying to overrule Supreme Court judgments by making a new law. Now, before becoming the CJI, he was also a part of the bench that upheld the demonetization exercise of 2016. He also ruled in favor of abrogation of Article 370. He was also a part of the bench that struck down electoral bonds for political funding. Justice Gavai also went viral when he dismissed the petition for restoration of a Lord Vishnu idol by saying, "Go and ask the deity." This caused a lawyer to throw a shoe at the CJI while he was seated in Court 1 of the Supreme Court. Justice Gavai also made the news when the Supreme Court administration issued a letter to the government nudging it to evict former CJI, that's Justice D.Y. Chandrachud, from the formal residence. It has also been flagged how no women judges were appointed to the top court under his tenure. Now, his decisions, comments and actions often made the evening news, and while he may have his plaudits, some of the recent actions have led to strong criticisms and concern.
Well, Justice Suryakant takes over there from Justice B.R. Gavai. Ashmit, many thanks for joining us. And with that, it is time for us to wrap up this edition of India Business Hour. The news will continue right here on CNBC-TV18. Thanks very much for watching. Have a great weekend. We'll see you shortly.